that would be a single largest hotel. So 700 rooms at Navi Mumbai.
Ashish, that is, absolutely. My question was, so you said, right, I mean, market decides the multiple, I'll decide the EBITDA. So give us some sense. I mean, how should we think about this? 26 is over, 27, 28, yeah.
So I think we'll continue to see EBITDA growth in the zip code of high teens to early 20s. That's what we expect the EBITDA growth to be. And that's really two components to that. One is same store. We expect to grow around 13-14% same store EBITDA growth. And then really is the contribution of the new assets of the inventory. So that's what I expect as a very reasonable conservative estimate of EBITDA growth in SAMI, even if we stop deploying any capital, which is really not a fair assumption. So I think we will continue to see high teens to early 20s EBITDA growth for the next several years.
High teens to 20%. Got that, Ashish. So as you scale up, what happens to the margin profile? Because in the past, you've mentioned that the upscale share in the portfolio will probably grow to about, I think you said 60%. And just revisit the timelines as well. You mentioned, for instance, W opening up and a couple of these marquee properties opening up. So what is the share of upscale right now as we speak? When does it scale up to 60%? And then I'm guessing it really pulls up the margin profile, right? So give us some sense on that. You're at about 35% margin now, EBITDA margin.
Yeah, so we are right now at about 42% share of upscale in our total revenues. We would see this go up to 65% in the next 4 years. Now, the whole transformation happens every single year. So every year you will see this 43% upscale proportion grow. Next year when we open the W. This year also we've added inventory to our upscale in Sheraton Hyderabad and High Frequency Pune. Next year we open the W in Hyderabad. A year after that, we have some of the conversions happening to upscale. So I think you will see almost a linear progression from now till, let's say, 4 years from now, 42 to 60, 65%. And I think we'll stabilize around 65, 70% upscale. In terms of margin, we expect right now we are at about 37, 38% reported EBITDA margins. We expect this to stabilize around 40, 41%. We need to bear in mind that we do some assets on variable leases, which are 60 years, only revenue share and no minimum guarantees. And because of the Indian accounting standards, that rent also gets added to the operating expenses. So otherwise, net of that, we would have been about 42, 43%. Otherwise, reported would be about 40, 41%.
Mm-hmm. In terms of your association with GIC and that JV, I mean, is there any plan to transfer more assets to the JV? And how are you thinking of, just that partnership going ahead?
No, listen, I think it's a phenomenal partnership, great partners. We definitely intend growing the partnership. We're currently looking at some M&A opportunities outside. That's really our priority. In terms of whether we need to or we want to transfer some existing assets to the joint venture, there's no such current plans, but it's always an option available to both NGIC to discuss. But at this point, our focus is to really secure some external opportunities for growth.
All right, Ashish, we'll leave it there. Thanks very much for joining us. Good speaking with you, and thanks for being here. SAMI Hotels in focus. Deepan Mehta is with us with what he'd want you to do as we begin a new session. Director, Elixir Equities. Deepan, good morning. Great to have you with us here. Thanks for joining us. New highs aside, and we'll see when it happens. Don't want to preempt and jinx it. But SAMI, if you have a view, I know you have a view on hospitality. I was asking Ashish, he said, well, I'll set the EBITDA, multiple market will set. Market multiple is quite low, 12, 13 times EV EBITDA, compared to a Leela or many others. What's your sense? Have you looked at this one?
Good morning, Prashant, and thank you for having me on your show. Yeah, I think that it's a very nice, piece of statement he made. And many other management should try and use it as well, because clearly that's what's under their control. The valuation is not in their control. That's fine and acceptable. And I think it's a decent company and reasonably good track record. And I would remain invested in a company like this. Its valuation is lower than a lot of its peer group valuations as well. And overall, we are quite positive on the hospitality industry because of, I would say, there is still a demand-supply mismatch in favor of the hoteliers. At the same time, I think, the way the wedding season is shaping up year after year and the way travel and tourism is picking up, I think the industry per se has a very good future. So I would remain invested in SAMI. And I do agree that there's scope for the valuation multiples at SAMI to move up as well. And I think almost a 25% type of increase in capacity certainly will ensure that the earnings momentum remains pretty strong.
Okay, all right. Got that. Deepan, hi. Good to be speaking with you. So let's talk about the durable space, because we're expecting a block deal to take place today, right? It's going to be a big one, lots of excitement, Whirlpool. Now, we don't know if any of the other listed incumbents, whether they'll want to, participate in this at all. But overall, how do you find this space? Any preferences? Yes, just yesterday, the gentlemen in the studio were having a very, invigorated discussion on air purifiers. So clearly, whether it's coolers, ACs, air purifiers, demand is always there. But from a stock perspective, anything you like?
Good morning, Surbhi. Yeah, I think it's a great industry, and a lot of investors have recognized the long-term potential of the appliance and durable industry per se because of low penetration levels. But look, valuations are very rich. And I think that within the space, LG Electronics certainly is a company to watch over there. Last quarter was not that great, and for reasons that we all knew about. But I think if it is able to sustain industry-leading growth rates, it should trade at a premium to Voltas and Blue Star, which it is not at this point of time. So there is a good potential I see in LG Electronics. Having said that, it's a company in which we are intending to invest as a measure of disclosure. And then you have to look for pockets of greater underpenetration, like Eureka Forbes, which is into very niche spaces. Excellent track record and change of management has led to a new growth phase within the company. Again, valuations are rich, so you have to extend the horizon of the investment. But I think on the whole, one should remain pretty much overweight within the sector. Another company which comes to mind, which has disappointed big time but has got good potential, is Symphony. And all Symphony requires is one good, or rather one very hot summer, and you will see the earnings almost double or triple also from these levels, and valuation multiples also expanding. It's a company in which we and our clients are invested in. So I think that as a sector, it's great, but you have to find pockets of undervaluation or extraordinary growth.
All right. Hi, Deepan. Good morning. Good to see you in. And for Eureka Forbes, with regard to that point on air purifiers, I think it's less than 4-5% of the total mix, but there's a tremendous potential. And I was going through the presentation that they put up. The industry size has moved from around 180 crores closer to around 280 crores over the last 6-7 years. But they're estimating it goes to 750 crores by 2030, growing at a CAGR of close to around 18%. That's about the industry. We'll try to get a couple of managements as well and discuss this in further detail. But Deepan, let's turn our attention to the rare earth mining opportunity. We have a scheme that's come yesterday that is for magnets. And that will be, if you look at the value chain, first there is, there will be some mining, then there is a little bit of oxides, and then you have the magnets. So as of now, there's no big listed player that's doing magnets, but the scheme has come about which could help the value chain itself. GMDC ran up yesterday. However, just to tell our viewers that these benefits will come only in the next 4 to 5 years at the earliest. What's your view on a stock like GMDC? It's not for the faint-hearted. It was 650 rupees in early October. Then it corrected to 480 rupees. But yesterday, post that exclusive news piece that we put out from our sister channel CNBC Awaaz, the stock did spike up. What's your view on it?
Yeah, good morning, Nigel. I think from time to time, GMDC has shown its intention to get out of the typical coal lignite mining into more value-added, higher-value products. But I don't know whether that strategy or whether that plan has fructified per se. And as such, as you said, there's no play which comes to mind at scale where you can play this rare earths or magnet investment theme. So from that point of view, I think, you just cannot buy GMDC on the basis that, India intends to manufacture more of rare earths or do more mining. So I would say that a large part of the revenues do come from traditional businesses. And end of the day, the track record has not been that great of GMDC. It's been around for a long time. I don't think that they have sustainably increased the volumes also, as some of the other metal companies or mining companies have done. And at the same time, I think, I think it's reasonably valued. I mean, if you want to go for a mining company, then there is Ashapura Minecam, which does all different types of things. And then there is Lloyd Metal also, which has grown phenomenally over the last few years because they were able to crack a particular iron ore mine. And then there are the actual metal and steel companies which are going more and more to backward integration. So from that point of view, I think there's no play on rare earth. And when it comes to pure play mining, I think there are better stories.
Okay, better stories. Got that. Thanks, Deepan, for that. Stay with us. Let's hop across to Sudarshan. As always, wakes up early, goes through a lot of brokerage calls. He joins in and gives us a few of them. So take it away.
So I'll start with Kotak Institutional Equities, which has initiated coverage on urban company, recently listed company, and that has seen a sharp fall from the 52-week high. 52-week high, if you remember, it was 201, and from that to it's down almost 30%. Now Kotak Institutional Equities expects a further fall, and fall can be of 13% if you go by their target price of 120, and the call is sell. It has factored in steady 17% net transaction value CAGR for India consumer business. And for international business, it has factored in 33% CAGR over FY25-28. It believes that India consumer services business can post adjusted EBITDA CAGR of 38% over FY25-28, but InstaHealth business will require further investment. HSBC has upgraded Bayer Crop Sciences to buy, and target here is 5,200. It believes that company can post an improved results in H2 of FY26, and that can be aided by new product launches. Also, upgrade the stock as worst is behind, and valuation too it finds attractive. Valuation is at 29 times FY27 EPS, lower than the 10-year average multiple of almost 32 times. Jefferies has returned on PB Fin that we known by Policy Bazaar. It maintains buy call, and target here is 2100. It says company has indicated that premium growth will continue to sustain, and that would be around 30%. And despite recent GST changes, company expects tax rates to take rates to stay stable, and premium growth and operating leverage will drive profit and cash flows going forward. So here also positive note for Policy Bazaar.
Okay, all right. So thanks very much for that. So urban company, PB Fintech in focus. Well, we'll take a quick commercial break here. We come back with Sudarshan Sukhani and Mitesh Thakkar on the other side for some technical trading ideas. Stay tuned, coming up. Okay, welcome back. There's 13 minutes to go for the pre-open session. News at the bottom of the screen, and we'll put more context to this. We had reported, there was a CNBC-TV18 exclusive, that CarTrade was in talks for a potential acquisition. This is just, 3 weeks back, right? That there were initial and preliminary discussions with Girnar Software, which is... car dekho, bike dekho businesses in India, which is also a very large player, competitor to CarTrade. The news was confirmed by CarTrade. And now at the bottom of the screen, CarTrade acknowledging that they've been in talks, but both parties have decided to walk away and there is no deal at this point in time. So the transaction is not being pursued for now. That is what's coming through. Stock, by the way, I think from the point that we reported the story, I'm not sure what the stock's done recently, but it did see a big spike in the immediate next few sessions after we reported that. I don't know if Deepan is there with us. Maybe I can just quickly ask him to comment. Deepan, are you there?
Yes, I'm right here. Yeah.
CarTrade, any thoughts?
No, I think it's an exceptional company and I am really quite sorry I missed it. And it's a classic example of how a platform company, when it consistently grows its revenues, doubles, triples, suddenly starts making solid profits. When you look at the last 5-year, 10-year history of CarTrade, it was consistently making losses. When it went public also, it was just about breaking even, no serious money. And now a couple of years down the line, when revenues have moved up, it is solid into black. So this is typically the way a platform company evolves, and that's the journey. And nobody could visualize when it was, 1/3 its price, that this is the potential and this is the kind of profit that it can generate. So it's a template for how we should analyze and invest in platform companies.
Hormuz tells us that CarTrade is up 10 times from the 2023 lows. Oh boy. So that's just amazing kind of move. Even from an extreme, that's exceptional. And of course, fundamentals have backed it, a platform company, and of course started throwing a lot of cash out. Deepan, stay with us. Hormuz actually is with us, right, with the big movers from yesterday and what lay behind the price action with some of these. Hormuz, take it away.
Morning, Prashant. Natco Pharma, we spoke about it during closing yesterday. As the kind of volumes that you saw on the stock yesterday was very, very strong. Along with the price action, the stock was up almost 10%, yes. But if you take a look at the volumes, they were the highest since April. They had almost 2 crore shares that were traded on Natco Pharma yesterday. The 20-day average is only 9.5 lakh shares. But out of those 2 crore shares, only around about 18 lakh shares were marked for delivery. So less than 10% of the shares were marked for delivery compared to a 20-day average of 3.2 lakh shares. And the stock has closed above its important levels, the 100 DMA as well as the 200 DMA. So the important technical levels, the stock has closed above those. Best Agro Life was a 20% upper circuit in yesterday's session, the biggest single-day gain since April of last year. The volumes in yesterday's session for Best Agro Life were the sum of the last 50 sessions put together. Now, of course, the stock was in upper circuit, but could have had much more volumes than that. 16 lakh shares were traded, 20-day average of only 31,500, and out of those 16 lakh shares, 2 lakh shares were marked for delivery. Here too, the 20-day average is only 18,000 shares, but it's been an underperformer this year, down around 45% from its 52-week high of around 660 rupees and down 40% this year itself. The SMS Pharma was a news-driven move in yesterday's session, a 17-18% up move, the biggest single-day gain in the last 5 years for the stock. Volumes on the were the highest in 3 months as well, almost a crore and 20 lakh shares traded yesterday, 20-day average of just around 6.2 lakh shares. So only 10% here too were marked for delivery, only 11 lakh shares compared to a 20-day average of around 1.2 lakh. And Wednesday's turnover close to 350 crores, almost 40% of the free float market cap. And lastly, Fino Payments Bank, Wednesday's volumes was the sum of the last 46 sessions put together. 1.5 crore shares traded, 21 lakh shares marked for delivery, but the stock is down 50% from its IPO price, is Fino Payments Bank.
Okay, all right. Thanks a lot for that, Hormuz. Well, the other big focal point that we're going to be looking at is the rare earth opportunity. And the Cabinet post-market hours approved the 7,280 crore scheme to promote manufacturing of sintered rare earth permanent magnets. The rationale that they put out was to promote rare earth permanent magnets ecosystem on the whole. So a couple of points out there. One is they're looking at us being self-reliant and positioning India as a key player in the global space. The other point that they made was that they're looking to strengthen the supply chain for automotive, defense, as well as aerospace sectors. These magnets ultimately find their use in these industries. And India's REPM, which is the rare earth consumption, is expected to double by 2030 in comparison to today. And currently, the entire requirement is met via imports. So we become self-sufficient in that case. At the cabinet briefing, we had Mr. Ashwini Vaishnav, who said that India aims to become self-reliant in rare earth magnets in the next 4 to around 5 years. So just keep that in mind. And a couple of other points. Remember, the chain is rare earth mining to oxides, to metals, and then to magnets. So this scheme basically is focusing on magnets, which is downstream in nature, but it will encourage miners to focus on the rare earth mining as well as on oxides. So the results will be 4 to around 5 years away. But one play is GMDC, because they have been focusing on the rare earth opportunity. And that's why we saw a big spike up in the stock. But the benefits will come in only in the next 4 years or so. And this scheme is for magnets, which is the downstream product, the end product, while they will be focusing more on the mining part and the oxides part. So that's a stock. Keep on the radar. Core business has been weak, but the street excited with regard to the opportunity. We'll try to get the management as well in the next 10 days or so on the channel. Well, let's get back to the markets then. Technicals, let's focus on. Sudarshan Sukhani of Technical Trends as well as Mitesh Thakkar of Bonanza Portfolio join us on the show. Good morning, gentlemen. Good to see you all in. Today it appears like it's the day, don't want to drink it, but after 14 months, we'll be revisiting fresh all-time highs. Sudarshan, you go first. What's the call you're going to be taking?
Well, I'm very pleased. For the last 3-4 days, I've been saying we are in a small compression. We have to go long. We have to stay long. Our stops are there. And we have to, I've used the words, we have to suffer through this correction. And we have suffered through it. And the point was that when the market goes up, it will go up like a rocket. That happened yesterday. Now, today's trade, should we take it easy? I don't think the market will have the same performance that we saw yesterday. But the trend is up. We are likely to make new highs. And new highs invariably are bullish. So the trade simply is look for minor consolidations, dips, and go long.
Okay, so look for small dips and go long. That's the trade. That's been Sudarshan's trade for a while, absolutely. Mitesh, good morning. So how are you gearing up for what could be a big day?
Good morning, Surabhi. So I think, to me, the idea of getting past all-time highs is a question of when. It looks like that there are stronger possibilities today of making fresh highs and then continuing this upside momentum. So I think tactically the way you approached the index today is that try to take profits around this 26,250, 270 mark. And then if it starts getting past 26,300, that'll be a fresh trigger to take long positions with 80, 90 point kind of a stop loss. And then I believe that, breaking into all-time highs could see the markets on a small-time basis, get past 26,500, but probably attempt a rally towards 26,900 to about 27,000. But yeah, let's not forget this 26,270 in between. So around 26,250, I would suggest people to lighten up a little bit. Good part of their position should be taken out and buy again if you see the Nifty get past 26,300. Okay,
and that's important to keep in mind that that's the goalpost. There's a decisive breakout, and if we sail past 26,300, then, as Mitesh says, then it's all hands, in. Gentlemen, stocks then. Sudarshan, what's on your list?
Well, it's an all-buy list, and since we are already long in the Nifty, it's better to focus on mid-cap. Zydus Life is a buy with a stop under 920. Shriram Finance, and I have positions in this as trading positions, is a buy with a stop under 840. United Spirits is a buy with a stop under 1430. And Dalmia Bharat is a buying opportunity with a stop under 1990. So there are 4 buys, all of them on the long side.
All buys for Sudarshan today. Mitesh, what about you? Stocks?
I have an all-buy list as well. HDFC Life is something which I've been liking for quite some time. It gave a pullback. Yesterday was a big reversal and a bullish candlestick pattern. So buy here with a stop at about 775, just below it, and a first target of 810 should be looked at. L&T made a fresh swing high, so buy with a stop at 40.30 for targets of 41.40. Also a buy on BPCL, which after a few days of correction has pulled back. Keep a stop at 362, look for targets of 378. And Coforge is something which I've had buy calls earlier as well. Now made a fresh swing high, so buy with a stop at 1852 for targets of 1910.
Okay, all right. What we'll do is we'll take a quick commercial break here. We'll come back in just a bit from now with the pre-open rates, and also we'll put the spotlight on oil. especially on the product side. Oil prices are down about 4% in the last 1 week. But there's, of course, I mean, a growing sense with the Russia-Ukraine war closer, perhaps, to ending, that diesel cracks and basically product spreads could come down sharply as well. We'll chat with Prabal Sen for that perspective on the other side. Stay tuned. Welcome back. There's 13 minutes, 45 seconds ticking down and counting down to the market open. Prabal Sen is with us, energy analyst, ICICI Securities. Prabal, good morning. Good to have you with us here. We had the GE Shipping Management with us, and it was not so much about a conversation about, it was basically about tanker rates, etc. I don't know if you heard it, day before yesterday. But we asked the management of GE Shipping what happens to product cracks, etc. And he said, well, they're exceptionally high. Diesel cracks $30, $40, and you can see a substantial fall if the war in Ukraine ends. Your thoughts, Prabal, first up there?
No, absolutely. I think one of the critical issues has been the attacks of Ukraine on Russia's energy infrastructure in the last couple of months. If you look at the kind of refinery capacities that have gone offline, according to, I think, data from certain industry trackers, the overall global refining industry offline was somewhere around 5.5 million barrels a day. In August, that number went up to somewhere around 8.5 million barrels of oil per day in September, October. So obviously that has created a lot of supply tightness in specific products, and that's where diesel margins have really taken off. Having said that, what we've really seen is that in the last couple of weeks, there has been some normalization. At least data that we have suggests that diesel spreads are back to about $25, $26 from highs of $40 that they hit at the beginning of the month. So there is some normalization that's happening. If there is obviously a ceasefire or any sort of conflict resolution, which allows Russia to rapidly rebuild or, sort of repair its energy infrastructure and bring those capacities back online, you can probably see a little bit more softening that can happen and some normalization of those spreads.
Prabal, hi. I was reading a note from one of your peer brokers, and that seems to suggest that on the marketing side, margins have been coming off quite a bit for these three entities. I'm not sure what's led to it and whether it's a one-off. So let's address that. Let's just see. Let's get your sense on how you expect the refining margins to be, whether they can these high levels, whether they'll sustain. And then a word on the cool-off in marketing margins. And then we'll come to the overall picture in terms of what it means for OMCs.
So the way you've got to look at OMCs is to look at integrated margins at the end of the day. What has happened is that absolute prices of diesel and petrol, obviously, given that spreads have expanded, the absolute prices have obviously risen up quite sharply. That reflects partly in GRMs, but GRMs is essentially about just the spreads. But given that crude hasn't moved beyond a certain range, the absolute prices themselves have gone up, and retail fuel prices have remained unchanged. So retail margins collapsing or reducing is not that much of a surprise. That's just arithmetic. Having said that, as you rightly pointed out, GRMs, if you look at theoretical GRMs on a QOQ basis, our sense is that GRMs have probably gone up by around $3.5 to $4 for all downstream players at this point of time in this quarter. So even though blended retail margins, and admittedly diesel is at close to negative levels, but petrol has still held on at about 6 to 7 rupees. So blended retail margins are down about 3.5 to 4 rupees a litre. The balance between these two still means that integrated margins are probably down maybe about 1 rupee a litre at best, against maybe close to 7 rupees that they did on an average. I'm talking about the three OMCs in Q2, to somewhere between 5.5 to 6.5 rupees in Q3 as of now. So the issue really is that as long as integrated margins continue to remain, fairly robust, just a reduction in retail margins is not something that, will worry us. This can easily, as I just mentioned, given that diesel spreads have started to normalize, absolute product prices can decline, and that can once again bring retail margins back to at least some semblance of normality.
So as of now, you're saying that integrated margins have not dipped too much,
No.
barely a rupee or so, give or take. So then from a stock perspective, not talking about stock prices, from what you say, then stock prices don't seem to be at any risk of a sell-off. I mean, overall this year, calendar year, I think between which stock you're picking, the stock price is up 15-20%. So short point, what should we do with OMC stocks?
No, I think we would continue to be positive. We really think that, at the end of the day, as I said, either, the GRMs continue to stay at these strong levels, which we believe is probably, a bit optimistic to think. I think there would be some normalization in terms of product spreads, but there is still supply tightness. There is still a lot of capacity offline that will take its own time to come back into the markets. So some tightness will remain. And at the same time, if crude continues to basically soften, and if news continues to, come through the off-conflict resolution, specifically in Russia, Ukraine, with the kind of supply surplus that's already there, if crude actually softens, then, the absolute product prices will also sort of really come off, and that can support retail prices as well. So our sense really is that consensus earnings or our base case earnings are not really at a huge risk. Yes, there can always be a downside of 5 to 7%. But even after the rally that the downstream names have seen, the fact is that valuations still remain at fairly comfortable levels. Add to that the LPG loss compensation, the reduction in absolute LPG losses for this year against the 400 billion expect to have just about 150 billion of loss in this year. And I think those two factors combined means that marketing earnings can still hold on slightly better than what the pessimistic outlook would be. We would remain fairly positive at this point of time.
Okay, so you're positive on all the OMCs. Not sure if you have a coverage on Chennai Petro, maybe throw in a word there. And Reliance. particularly now that Reliance has stopped buying this Russian crude, and apparently the discount has become as large as $6 to the barrel, just because Indians are not buying. Now, what happens to Reliance? And I'm talking, just the refining business.
As I said, as we have stated earlier, I think on your channel as well, that, if you do the math, even at 40% of crude, which was estimated at coming from Russia into Reliance's portfolio, and I have no way of knowing if that number is true, I'm just making a guess. But even at that level, if the discount earlier was at maybe about $2.5 to $3, you had basically an effective impact of around $1 or so in terms of GRM. Against that, the base margins itself are now up around $3.5, $4 plus, if not more. So, frankly, at least in Q3 and Q4 earnings, even without Russian crude, you're likely to actually show an increment QOQ in terms of your OTC segment earnings. So our sense would clearly be that against the 15,000 crore run rate that they showed every quarter in the first half, second half earnings are still going to be, materially higher if these trends holds, irrespective of whether Russian crude is coming through or not.
Okay, and of course, standalone refiners, will be the worst hit, right? Prabal, as we saw in Chennai, but they've also had massive runs this year.
Again, it's a question of crude cost hit versus the absolute product spreads in terms of how they line up. We don't really cover CPCL and MRPL specifically, but theoretically the same argument holds in terms of where the margins are versus what the crude cost is.
So one name is if you had to buy in oil marketing, what is the top idea from here? Where there's downside is limited.
We would still look at HPCL at this point of time. I think their refining to marketing mix is improving all the time. That provides a natural hedge against volatilities between the two margins.
Okay.
I think they will add a significant amount of decent petrochemical capacity. Leverage is going to continue to go down. And, marketing losses from LPG are also something that are not really a factor at this point of time. Okay. So we would keep looking at that name.
All right, got it, Prabal. Thanks very much. That is very nicely explained on why Prabal is not too worried about this fall in marketing margins and how the spreads are moving up from here on. He's still quite optimistic. Doesn't see, at a blended margin level basis, he doesn't see more than a 1 rupee hit, if at all, on some of these OMCs. Okay, the pre-open has settled and it's 26,261, which is, just 15 points, almost 15, 16 points away from that mark. But we'll see. It'll happen when it happens. For the time being, let's go back to our experts for some final trading ideas. Sudarshan, what's your call?
Well, it's United Spirits. Buy United Spirits with a stop under 1430.
United Spirits going for the high today. Mitesh, what about you?
I'll go with the buy on HDFC Life for targets of 810.
Okay, HDFC Life. Got that, Mitesh. Thanks very much for joining in. Let's get to Sud. He is watching out for a couple of stocks. I think CarTrade is on the radar. What makes it to your radar, Sud?
So it was November 10 that when we had reported that CarTrade is looking to consolidate the automotive business by acquiring to Car Dekho and Bike Dekho, and was in talks with Girnar Software for that consolidation of automotive business. So it was expected to help, or it was a positive development. And November 11 company had confirmed our news break. But now there is a latest update in which CarTrade is saying that CarTrade and Girnar Software have decided not to proceed with that consolidation. Remember, this year the stock has almost tripled. It's now up more than 113% 2025. So how will this new development be taken? It might be taken negatively. Why? Because if this deal would have gone ahead, this would have given the company bargaining power with advertisers. Also, it would have helped and basically benefit or improved incremental revenue per ad spend. So ad spends would have gone down and revenue would have improved. So that might be taken negatively, but it's indicating that stock is opening flat.
Okay, all right. CarTrade is absolutely flat right now, 3177. We'll try and get in touch with the management for a conversation as well as we go along. Urban Company, the brokerage call coming through from Kotak. Mangalam is here with that one. Mangalam, take it away.
Well, another one to the list of underperforms for Urban Company when it comes to initiating coverages. And this one comes in from Kotak. They have initiated with sell a target price of 120 rupees. While, they believe that the overall net transaction value can compound at around 17% for the India consumer services business. They see a higher growth prospect in international business on a low base can compound at 33%. And consumer services business post-adjusted EBITDA can actually compound at over 38%, indicating operating leverage. So what keeps them on tenterhooks when it comes to their call on the stock? It is the investment that would be required in InstaHelp. Remember, even in the quarter that went by, the company reported a loss only because of increased investments in InstaHelp, which is basically the quick commerce version of Urban Company's services, which the company believes is a large total addressable market, but they will have to continue their investments there. So until there is clarity on that, maybe the brokerages are slightly cautious.
Okay. All right. Mangalam, thanks a lot for that. By the way, guys, we were talking about fresh all-time highs, which is great news. But the Nifty Next 50, that is close to around 6% away from all-time highs. And the small cap index is 9% away from its 52-week high. So the breadth of the market really needs to come into play, I think, so for portfolios to feel good. And the other one I think we're looking at is the large trade on Whirlpool. It's opening up gap down. I think our sister concern is, picking up that the size can, the block size could have been upscaled. I think that's what's coming in there to around 11% from around 7.5%, which will be even more interesting. I was expecting a green shoe option yesterday when I saw the book, and it wasn't mentioned, but now it appears that block size has increased.
Names will be interesting.
Very important.
We'll look at it as we get the details. I think we're about very, very close to market open. 9:13 is where we are at, and then we'll pick it up from there. So 56 points higher, 26,261. And I would say let's get it done, right? The new all-time high. So just quickly sort of be wrapping up the stocks in focus as well, right? Oberoi Realty will come up, should come up, and 1%, Brigade, Paytm, 1.5 each there on those two. Studs, which is a helmet company, about 0.7%, accessories company. Patel Engineering, Asian Paints, so 7% on Patel. A big one, right? Big order there. Pidilite, Salazar Techno, and of course, Whirlpool was down sharply. There's a very large block there. And of course, J&K Bank is the other one, which is coming up. So yeah, you've got two large movers. One is Whirlpool, the other is Patel. One up, one down at this point in time. So that's the picture as far as the market open is concerned. So, will we have a new high right at the word go? And will we put it out? We will put it out if it happens, but should be done, right? 26,261 on the Nifty. The Nifty Bank is up about 0.13. The Sensex is up 0.16 and 0.29 on the small cap index. And there we go. After the races, 26,242. Alas, a little. It's kind of flattish, right? Right now, 26,221. So absolutely flat out of the gates, absolutely flat. 18-point change. Nifty Bank is 59,580. Mid-cap index is absolutely flat. The small-cap index will come up on your screen as well, and we'll pick it up from there. I think the Nifty 50 heat map gives you a quick sense of where we are landing in terms of market open across the 15 large-cap names. And it's basically more up than down, definitely. Hindalco, Geofin, M&M on one end, and you've got HDFC Life, Maruti, Titan on the other side of the spectrum. So, there's a bit of a buoyancy, as you can see, 26,244, 41, 40, 38. So, dancing around. Surabhi.
Teasing. But anyway, it's an assortment of stocks, really. Not too clear in terms of trends. Hindalco is up and about. There's L&T, there's M&M. M&M, by the way, is launching, an EV today, highly anticipated. I think it's the EV version of the XUV 700, so watch out for this one. Tata Motors passenger vehicle still continuing its good form with the buzz around the Sierra. 1% on that stock as well. Bajaj Auto is actually also up. So some of the auto names are looking good. ONGC, Bajaj Finance, Geo Finance. These are some of the early movers on the upside. Asian Paints about 0.5% higher. They're looking at expansion in international markets. On the downside, what's keeping a lid on the rise? Actually, no stock is falling too much. It's just the ones that are dragging their feet. For instance, Reliance Industries, absolutely flat, doing absolutely nothing. Let's check the other big boys. HDFC Bank, absolutely flat, no sign of move. ICICI Bank in comatose territory as well. And this is the reason why the market's not able to really make up its mind. ITC is up about 0.25%. Lever is absolutely flat. None of the big guns are firing. Let's check the tech stocks. Infosys, absolutely nothing, 1.5 rupees. TCS, totally flat, 2 rupees. So till these big boys decide which way they want to go, I don't think we're getting that close to the all-time high. So Nigel, the countdown is still on?
Well, that's right. The countdown is still on. A few stocks, though, from the broader markets that deserve special mention. You have Sterling and Wilson Renewable Energy. They have received the second South African project of around 1,300 crore rupees. Explains why that stock is up. You have another one, GMDC, the rare earth opportunity. That's the stock that's in focus, in today's trading session. Yesterday it was up, and today as well, seeing some follow-through buying. The gains will come in the next few years or so, but the street wants to price it in. Remember the stock, 650 to 550 now, even after the 10% move you've seen in the last couple of trading sessions. So that's another one on the radar. What else? I think you've already highlighted a couple of the other names that are moving around. Capillary Technologies yesterday as well, that came up as one of the top movers, and then it slipped from the top, but that one's opening up in the green. The dollar index has cooled off, so that's why you have metal stocks that are participating. Nalco, SAIL, they're all up in today's trading session. And GMDC, besides the rare earth opportunity, it also has this tailwind of being a mining-related play as well. Ashok Leyland is up another 2.5%. So pretty good start, but just waiting for a few more minutes, I think, before we hit the fresh all-time highs.
Okay, I think, we've got the broader market looking much, much better. So about 3:1, like yesterday. So 1,700 stocks are higher, and about 580 stocks are down at this stage, and it's a good-looking screen. GMDC, from the point that we put out yesterday, CNBC put out the story that the cabinet is basically going to take up the rare earth scheme for approval. This is in the afternoon. From that point, the stock's up about 10%. So it's been a meaningful move, 555 on GMDC, and we've got a discussion coming up on rare earths in a bit, in about 30 minutes' time. Excel Soft is a listing from yesterday. It's coming up with just a 2% pop, but it's got very large volumes for this point in the day. What else? You got Sterling Wilson Solar, 3% higher right now. Best Agro, 11%. It was a very large mover yesterday, and it's coming up with volumes right now. Ganesh Eco, the recycler, right? I mean, completely bombed out name, but it's coming up. 8% yesterday, 8% today. It's, I think it was part of...
No.
Okay, I think I'm talking about... no, sorry. I misread it. Ganesh Housing is the one. Beg your pardon. Actually, the price is pretty similar, $900. 8% actually on this one. Yeah, that's the one. Ganesh Eco, the recycler, was the one which was on Nimesh's chatter list and, of course, did very well yesterday. But today is, of course, kind of flattish. SMS Pharma was a big mover yesterday, 326. It's coming up with large volumes at this point in the time. Fino Payments Bank is the other one. Ended 10% higher, I think about 8% by close. But it's coming up. It's coming up with another, I think, 4% pop at this stage. So that's the picture. Whirlpool, of course, there's a large block, 10% lower. It's the number one volume-led loser at this stage, 1,077. Tahir Badshah is with us, Chief Investment Officer, Invesco Mutual Fund. Tahir, great to have you with us here. Thank you for joining us. So I think we will get this new high done. But will that change sentiment, Tahir, a little bit for the better? The written sell-side sentiment has changed on paper. Everyone is expecting a better year ahead, better returns, relatively speaking, after the tough year we've had, especially in broader markets in 2025. What's your sense, Tahir?
Yeah, I agree, Prashant. I mean, the setup is reasonably good at this stage. I mean, when you, all things considered, especially when we are coming out of a reasonably decent underperformance relative to many global markets around the world as well as emerging markets. And I think we've got, of course, some of the macro starting to look a little better, especially given that environment for a further rate cut, both globally as well as in India, is starting to look relatively more brighter. And I think alongside which, last but not the least, and most important, is that we've got some earnings acceleration as well in this quarter compared to what we've been witnessing over the last few quarters. So I think all this, it's not still a cheap market, but it is, obviously stayed in a place for a while and given you some kind of a time correction. So I think it just makes it a reasonably decent setup. And also from the point of view that, globally, I think we have been an anti-AI trade. And if that is starting to kind of come about, even for a limited period of time, I think that just opens up a window for the Indian markets to probably do well over the course of the next 6 odd months. if not more.
Tahir, hi, great to have you with us. You have been known as the mid-cap expert for decades. I mean, a knack for picking out those undiscovered stocks.
Fresh all-time highs.
Oh, it's happened.
Yeah,
Sorry,
fresh.
Tahir. Sorry for that. It's finally happened. 26,280,
Fresh all-time
283.
highs.
Nigel said it's going to happen in November. It
Yeah.
happened in November. And this has been in the making for a long, long time.
Yes.
Painful wait going back to September of last year. Over a year, consolidation, the market testing investors' patience, but investors, and particularly retail investors, have kept the faith in a year where FPIs have sold off more than 150,000 crores of equity from India. But it's the domestic story that's gotten us here, and we're at all-time highs.
If you can just pull up the Nifty from September last year to now, I think it'll give you a great picture, basically, of what has happened. In one snapshot, late September on, I mean, if you can pull up a Nifty chart, I think we have it, right? That's November on, but maybe from September on. So you basically hit this high on 27th of September 2024. And then you had it was a slow grind lower, just sort of recounting what happened. And then there was a sharp-paced fall starting March of 2025, which took us all the way down. I mean, the low in April, the Liberation Day low was 21,743. I mean, absolute, actually, that point looked like panicky kind of moves. And 21,740 or so is the low in April. From there, a very, very sharp recovery in a few weeks to about 24,500. Spend some time there, 25,500 by about August of this year. And then the real painful sort of part began because, August onwards, actually June onwards, the market just sort of, went into a grinding kind of move before this latest impulse move started, which is, of course, early November. We were at about 25,400 and we moved up to, we basically moved up 1,000 points from that point on very, very quickly. As we've crossed those new highs, you're essentially, a lot more stuff is in the green now on the Nifty 50 pack, the heat map basically, as you saw. I think now, Nigel, the small cap index is the last one?
Yeah,
the
small cap index is around 8% away from its 52-week high. The Nifty next 50 as well, that's close to around 6% away from its all-time high. And just a quick point out here, right? We're talking about all-time highs, pulling out the champagne, things are looking good. We're getting into the end of the year. That's due, Prashant. That's, expected during the course of the day. But things are looking good. But just to give you a couple of data points, as you said, Prashant, if you pull up the chart from September 2024 till date, we're just back at where we were. But I'm forget about the broader markets, I'm looking at individual stocks. Trent, that is 40% away from the high that we saw on that day. Bajaj Auto is 27% away from those highs that we saw on that day. Coal India, another 25%. TCS, another 25%. NTPC. So I can see frontline Nifty names that are 25 to 45% away from those all-time highs. Champagne is being popped, but some people have not participated. No champagne, no good snacks, no music, nothing, no DJ.
That's why I asked Tahir, right? I mean, will this really change sentiment? Because actually, I think it rarely happens that the market hits a new high and sentiment actually is low. And you mentioned, Nigel, large caps. But if you go down to mid caps,
absolutely.
I think Nimesh is putting that piece out for ERT, Editors Roundtable, tomorrow.
Oh, lovely.
Looking at the Nifty 500 stocks and what, I mean, it's looking pretty bad. And I'm talking about names, not some two-bit stocks out there. These are stocks where there are large institutional holdings of, single mutual funds owning 7-8% kind of holdings. And where there was frenzy 6, 7, 8 months back, and it's kind of gone south completely other way. And I think that's the reason why, even though we are at a high, and I think we should acknowledge that we are at a high, and we are acknowledging, I think at a portfolio level, it doesn't feel like a new.
And if I were to put a guesstimate just to that Nifty 500, stocks, I don't think, even 300 of those stocks will be anywhere close to those highs. So just putting a guesstimate out there. So for the headline index, there's been a time-wise correction, but for the broader markets, it's been a price-wise correction. We live in hope that 2026 will be far better. And then, in fact, portfolios will gradually start to feel that they are part of the party.
And then we can open the champagne.
So for the mid-cap 150 index, we're about 4% away from that high. If you talk about, obviously, IT, has been the worst performer, has not really participated in this rally. So that's one area to look at. even the defense index, which had such a stellar time, the April, May, June period, from the highs, even the Nifty defense index is well off, about 5-6% off those levels right now. So the rest of the market perhaps needs a bit of a catch-up. And Tahir, that was the question that I was coming to you with, actually. I mean, you're such an expert on mid-caps and small caps. So what's the feeling at this all-time high? And how should investors now go about, refreshing their portfolios, looking at their portfolios? Where do you still see the opportunity of a catch-up rally?
Yeah, so clearly, I think where we have clearly lagged is as far as the broader market is concerned, and more particularly in the broader market, I think the small cap space is obviously something which is very clear, given its recent underperformance, and more probably from the point of view that earnings acceleration has not happened there, or earnings have actually been decelerating, in that space, and I would like to think that is a place which will probably start getting more attention as we get into a scenario where overall, at a system level, we start to deliver more earnings growth. And I think that will be the test. I mean, it's nice to see the new all-time highs, but it needs to kind of broaden, spread to the broader market as well. And I think that will call for this nascent earnings acceleration that we've seen in the last quarter to sustain into the next few quarters of calendar year 2026 as well. And that is when I think we will probably see, relatively stronger risk on sentiments compared to what it is.
So Tahir, I mean, I know, and when we're talking mid-cap, small caps, it's all entirely bottom-up, and I know you can't talk stocks. But in terms of pockets where you see some growth visibility coming back, and there is a nice valuation entry point as well, what will it be? Because again, I'm just going into sectors. Defense, which was such a loved theme, at an index level, it's about 10-12% away from the peak. FMCG, despite the optimism around the GST cuts, obviously hasn't moved. The FMCG index is still 6% away from the highs. Now, different arguments. Maybe, FMCG is not the best way to look at growth in the second half. But again, in terms of themes in the broader markets, which ones will you keep your eye on?
I think by and large, we've kept to the same themes more or less for the last good amount of time. I'll count out things like, healthcare has been one of our favorites, especially domestic hospitals and, some of the domestic pharma companies as well. Alongside which we have been very optimistic as far as banking and financial services, more particularly NBFCs to begin with. And now it is incrementally spreading to the frontline banks, both on the PSU as well as on the private side. I think we've always been constructive as far as the capital markets play is concerned, once again as a section of BFSI. So that's something which is not exactly. I mean, it saw a dip in terms of valuations, and valuations have crawled back up. But that is where growth still continues to significantly stay ahead of system rate of growth. Lastly, I think pockets of consumer discretionary, which by rotation tend to move from one pocket to another. But in general, that is a class which, given all the developments of the last some time, is something where we continue to kind of try to find ideas. Consumer fintech still remains our favorite across many of our portfolios, and that's right up there in terms of our preference list. Yeah, that's pretty much there. And I think IT is obviously been a value play, but it is starting to find its feet. And I think it is quite fair to assume that we will probably get into a bit of an acceleration as we get into the part of 2026.
Yeah. I just have a question. I know, Tahir, I know you can't talk specific stocks, right? But I'm just using GMDC as an example. Let's put it up. And we have a rare earths discussion coming up a little later. This is about the state putting its might behind developing a new industry, right? Now, GMDC apparently has the reserves, and I think Nigel has the numbers and he's been telling us, but it's a long story as we understand it. How do you think about something like this? I mean, earnings are not going to come anytime soon, but here's the government which is sort of prioritized it as a national security industry. What's your sense, Tahir? Something like this, for example, what we saw with, say, railways a couple of years back, it was a different situation. Defense, for example. Now it's rare earths. Shipbuilding is another one. Any thoughts?
So some of these sectors do appeal, especially shipbuilding for that matter, and certain other infrastructure pockets, which are relatively more easy to, they're in our control, and essentially we're not looking at competition from outside. But I think some of the newer technologies or technology related, whether it is rare earths or whether it is even, EVs and so on, and everything to do with the EV ecosystem and so on. I think that part is still a long way to go. And, we don't really have many plays, or we don't have many vehicles to play some of those opportunities. Even I can understand the intent of the government, given the policies around the world. But we also, from an investment standpoint, need the vehicles, which we have in areas such as other parts of the market infrastructure and what are things that you called out, railways, ports, etc. But we don't have an adequate measure in some of the others. So I think that is still some time away. I think for us, India, it is basically the diversity that India offers. I mean, more than so that's why, as and when the attention from AI becomes a little softer, and I don't expect even AI to go away anytime soon, but we get that window of opportunity where diversity comes about, and asset managers around the world start to rebalance their portfolios.
Tahir, before we let you go, our next discussion is on real estate with a real estate company, Prestige. We'll have Mr. Razak join in shortly. But I want to get your thoughts, because this is one more sector that's a little confounding. When you talk to the developers and when you see their numbers, and all of them have had actually pretty solid last couple of quarters, right? Pre-sales have been good, collections have been up, pricing has either increased or has been stable. But the stocks have languished. The Nifty Realty Index is almost 19-20% off the peak. So what's going on here, and what's your sense on this part of the market?
No, absolutely fair. And I think that is another part which I forgot to mention is a reasonably important element of our portfolios as well. And we've lived through it. I think we've enjoyed the fruits of it as well 2 years prior. And the last year has been somewhat slack across the sector, but that's understandable after a very strong rally. But I think generally we feel that this is still a segment which where the growth cycle is relatively more sustainable. I mean, we've seen real estate generally has long cycles, as we all know, 10 years up, 10 years down. That kind of a thing, and we are probably still in mid-cycle zone, and we've a good part is that stocks have corrected. So actually, we will see momentum start picking up once again. There is we from a more longer-term standpoint, we believe that the biggest driver of real estate is essentially the fact that we're going to see a significant migration from low middle-income households to upper middle-income households. As you look at it on the income spectrum, and that is a once-in-a-lifetime event in any country. In any country's history, and India is already in that process, but it is only going to get bigger and bigger. So we are going to see probably almost 20% households move from low middle income to upper middle income, and that is essentially what is going to drive a lot of the real estate demand. And we are also in the midst of an upgrade cycle as far as real estate is concerned. Everybody wants to premiumize as far as the housing is concerned as well. So I think it's relatively more sustainable, and especially in an environment where interest rates are make it more affordable. And so I would like to think that this is something which should come back. That is one of the sectors which we hope will be a cyclical recovery in 2026.
All right. Thanks a lot, Tahir, for joining in. Wishing you a good day ahead. And hopefully the next time we chat up, the broader markets will be participating as well. For today, we're celebrating the Nifty at all-time highs. Well, Prashant, just one quick point on what you said. The state government push, when the management push comes about, a stock like GMDC, for example, we here at CNBC-TV18 had explained the prospects in 2022, June. A viewer's, in fact, just written in. The stock was around 150 rupees. It had cash in its books, but the intent of the management wasn't there. And you couldn't reach the management for many, many years. Suddenly, you had a change in management. Mr. Gupta came in, Mr. Singh came in at the top as well, and that's where the fortunes started turning as well. So the intent to create wealth as well is something that's very, very important, and communication with the street is something that the street tracks.
Nigel, the point is, and I spoke to yesterday somebody, I think Nimesh also tracks this one closely, and the point is, and I think it's still, you got to get this stuff out of the earth, right? Now, the mineral is, the stuff is there under the ground, you got to take it out, right? That's essentially the thing, and that's 3 years, 4 years out. Yeah. Now the point is, rare earth processing is a different matter. Yeah, that is a new industry you got to set up. Yeah, that will take time. Yes. So that, I think we've got a chat coming up, and we'll try and understand. But the point is, can this be fast-tracked with the centre now coming in and putting in a policy that we've got to develop this industry in a big way? I think that is the question for a company like GMDC, and we'll try and understand this, and we'll try and get GMDC, the company, on the channel once again. We'll take a quick break. 70 points higher, 26,275.
I think before we...
I think Hormuz is with us, right? Yeah. He's standing by. He's prepped the data on where markets are, stocks more importantly are, September 24 and where they are now, even though the index is back at those levels. Hormuz, take it away.
They say sabar ka phal meetha hota hai. It's taken 14 months long of sabar to get to where we were back in September of 2024. It's, of course, the record highs for the Nifty in today's session. And from the lows that we made this year, which was on the 7th of April, we are up 19% from those levels. You look at the stock contributors as well, among them, starting from the 27th of September. You look at Eicher Motors, BEL, both of them up over 40%. Bajaj Finance cooled off from the highs, was among the top gainers, still up 30% from over the last 14 months. And making a move also is SBI and Bharti Airtel, gains of 23% each. Now, the list of underperformers also is a list of some big names. Bajaj Auto, incidentally, also made a record high on the 27th of September 2024. It's down 30% from those levels. Trent has almost halved during this period, and also making a move here are Coal India and TCS on the downside, losses of well over 25% each. Now, if you take a look at the movers from the April lows, some similar names here. BEL finds a mention here as well at 53% from the lows in April. Mahindra & Mahindra, Eternal, Jio Financial and Eicher Motors here as well. Gains of well over 40 to 50%. But you look at the sectoral indices over the last 14 months. Banks have been the big contributor to this move. The Nifty Bank already at record highs is up 11% during this period. The auto index hasn't done much. IT, the other big sectoral weight, has somehow offset the moves from the banks. The pharma index hasn't done much, but the bigger underperformer compared to IT has been the FMCG index. That's down 16% over the last 14 months, and the metals index too is up only just 2%. But if the Nifty is at record highs, the broader markets have done precious little during this period. The mid-cap index is up only 1%. The small-cap index, in fact, is down 7% over since September of 24. You take a look at the movers in the broader markets. You look at BSE. The stock has more than doubled, in fact, almost 2.5x from that period. Paytm is up 90%, still, of course, below its IPO price. Muthoot Finance hitting new highs. Indian Bank among the PSU banking names is up 64% during this period, as well as L&T Finance, not an NBFC that we talk about daily, but still up 63% during this period. Among the underperformers, of course, Colgate, IndusInd Bank now out of the Nifty, down over 40% each. Tata Tech, another Tata Group underperformer, down 40%. RVNL, the high flyers of 2023, down 40% as well. And Ireda, another PSU name among the list of underperformers. You look at the small cap names, Laurus Labs, after some quarters of struggle, is up almost 110% in the last 14 months. MCX at new peaks as well. Sagility, a recent listing. Naveen Fluorine, Narayana Health, all seeing gains between 60 to 70%. But look at the underperformers. Ola, that shows the pain in the broader markets over the last year or so. That Ola Electric, Tejas Networks, Jindal Saw, Brainbees, a recent listing, and 50 to 60% of losses. Whirlpool too. Now add more, another 11% too. There's 46% drop as well. So there has been pain in the broader markets. There have been stock-specific winners as well. But the point being today that the Nifty is at a record high.
You know, it's such a different feeling, Hormuz. Thanks so much. That's great data. And, you know, those stocks really illustrate the point why this all-time high is probably one of the most thanda all-time highs we've had in my recent memory, right? And that's exactly what it is. It's not been one momentum-driven market where everything is up and about and there's, you know, there's a raging bravado. It's been almost a, you know, an all-time high of disbelief. And even now the screen is a little thanda. But having said that, I think in the next couple of days we'll have the answer. And some of the technical experts were pointing this out. If the momentum now starts building up, if this level sustains, and if we cross the next 100, 200 points, and something starts building, then maybe we'll be looking at a very different market. But yeah, I mean, as of now, it's been just quiet, thanda. It's almost like a relief. Chalo, finally, ho gaya.
The foreign guys need to come back, and sustainably so, because everything else is there, right? But there's one missing element. Hopefully that changes.
Absolutely. And there's been a lot of sector churn. I mean, the winners are very different. There's been a lot of pain in the stocks that have fallen by the wayside in the last 1 year. So very different all-time high. Anyhow, one sector on which people have been increasingly optimistic, and you just heard Tahir Bajra also make that point, is real estate. So let's get that conversation going. Mr. Irfan Razak, CMD of the Prestige Group, is with us. Mr. Razak, thanks so much for joining in. You know, from a market perspective, and we were just discussing this with the guest who was on earlier. While all of you, most of the listed companies have been sounding optimistic, the numbers have been good, the pre-sales have been good, real estate stocks have been a little quiet and somber, but we're not discussing the stock with you. We're discussing the business performance. Super solid first half. The question is, can this sustain? Can this last? This 8-9% increase in pricing that you've reported, the kind of pre-sales momentum you've reported, is the going continue to be as good as you look at the rest of the year?
I believe, good morning. I believe that the momentum definitely can sustain. It's all about how you strategize and how you work yourself up and bring in the pipeline. And since the going is good, since there is demand, the teams also have been working very well and very hard to see that there is more and more inventory that we create and bring to the market so that the pre-sales can also be managed and the momentum is kept up. Yes, we have reached at certain highs. Now, from these highs, the only thing is that we have to sustain this. We have to make sure that the same momentum goes on. The demand will be there, but the most difficult part is bringing the inventory to the market. What it means by bringing the inventory to the market, land is the raw material, then it's the approvals and all of that. So it's a bit a tough job. But I think the teams have pulled this off in the last 2 quarters. And I think the next 2 quarters also should be pretty strong.
So, I mean, and real estate obviously is a lumpy business. So you'll have some phenomenal quarters and then 1 or 2 quarters, there can be a lull. But if I average it out, I mean, you've been growing at 50%, at least in the last quarter. For this year as a whole, and more importantly, next year, because, your launch pipeline has been huge, 18 million square feet, right? So give us some sense on a sustainable CAGR basis, what's the kind of sales growth you're hoping to clock, not just this year, but going into next year as well? I mean, is 25-30% growth in sales momentum, is that a fair assumption?
I mean, it depends on what base you're starting at. See, now the base that has come up is quite huge. Nobody ever thought that a listed real estate or unlisted real estate company could do more than 10,000 crores in a particular year. Now that got surpassed. Then we talked about 15,000, that got surpassed. Then 20,000 got surpassed. So now we are all thinking that probably we can reach the 30K mark. But then at that level, at that base, for you to grow again 25% will be quite a challenge. But I think it will be fair to assume that we have to keep growth. And a fair growth between 10 to 12% on a very high base should be very reasonable to expect. And I think that's what we, along with the team, should work together to see that that is sustained. And because the market is there is demand, there is a need.
And that you're saying, sir, at the pre-sales level,
yes,
10 to 12% steady state pre-sales growth year after year in the near visible future, right?
Absolutely.
Okay. And this is from here on, because pricing has also gone up in most markets. And we were having this conversation with Pavitra Shankar just yesterday. So pricing is also important to understand, right? And pricing has gone up very smartly. Even for you, I think realizations are up 8-9%. So from here on, this pre-sales growth, will it largely be a function of volume? Or is there some scope to enhance pricing as well, across blended pricing across the portfolio?
No, I think it'll be more of volume. And I personally do not want the pricing to run up much more than what it has. Yes, pricing correcting itself and adjusting itself against inflation that's what is expected. But unreasonable pricing, because land price has gone up, expectations from landowners are more and more, that can't happen. And that should not happen. It's going to be counterproductive because we have to have an eye on the affordability also. We have to make sure the goods that we are producing are also acceptable at the consumer level, and the consumer is as yet able to still buy the product. It should not just go beyond their reach. So if we do a blend of both, yes, there is that niche market, which is the luxury market. That's a separate, I would say, a world altogether. But where the volumes will come from and where the business is the mid-income market, and that's where we need to have our eye on. and keep working towards it.
Okay, all right. Hi, Mr. Razak. Just one quick question, sir. Good to hear that your business is doing well, and I'm seeing your projects coming up in Mumbai as well, which is good. The problem is this air quality is getting bad. And, various quarters of the government are saying that they're looking into it and they'll be sounding off various developers. Anything you have heard on that front and any measures that you're taking? Because the air quality out here is, really taking a bit of a hit. So your comment on that.
I think in whatever work that we do have to keep an eye on the environment, including the air quality. It's just not the developers who are responsible for the bad air quality. It's a combination of many things that happen. But I don't want to shrug that off. We as responsible developers would definitely like to take steps and measures that will not allow dust pollution to go out of our sites. There are many things that we can do, including, we have to have that proper shielding of all the dust that goes out of the property.
Okay.
We have to do, trucks have to be wheel washed when they go out. So all this will help. Even small measures do help. And at the end of the day, that is what is going to protect the environment and protect the air quality. And collectively, if it's done, it'll have an impact.
Sir, quick last question. That's air quality, and we're really dealing with it. I mean, just never imagined that a city that's next to the sea will have issues similar to the national capital, which is landlocked. But that's the unfortunate part we're in. Quick last word on the labor code, sir, and whether that impacts the real estate industry in any way. Do you see costs going up? Because now it's all getting formalized. A lot of the additional benefits would perhaps be coming through.
I think labor is of late in the last few years has been a concern. Unfortunately, there's migrant labor that comes in from the eastern part of the country. It's who comes and settles down here and works really hard and produce again to churn the wheels of the economy. And they need to be protected. They need to be paid their wages correctly. And I do believe that labor has to be, one thing is skilling needs a lot more focus on. And we need to bring more and more quality of life for the labor so that they come and take these trades and they keep producing. Because
what is the cost increase, sir, if at all? I'm not sure, because there are 4 different codes and one of them deals with working conditions, health and safety, etc. So have your teams right now worked out if there is a cost implication, any increase?
There will be a cost implication, but I think it is for the good. And they will be, because see, I believe labor is the last person in the line, and their lives also need to have a quality of life. And we should be the first to see that we protect that. And I think the cost increase on labor, just that component of labor, should be anywhere between 10 to 15%.
Okay, so labor costs could go up by 10 to 15%. That gives us a sort of ballpark working estimate. And of course, like you're saying, it's for the good. So it simply has to be sort of taken up. Thank you very much, Mr. Razak, for joining in. Good to get all of that perspective from you. You have a good day as we go forward. We'll take a break. And are we still retaining the all-time highs? No, we're not. We've actually slipped 26,243. After the break, we get you a special discussion on India's big push on rare earths. Rare earths, they're mining, taking it all the way to creating those magnets so we do not face a crisis like the one that the industry was in just a couple of months back. Back with that discussion in just a bit. Welcome back. Okay, that's a really important story that's breaking on your screens. It seems Tata Power's Mundra UMPP, the ultra mega power project, could resume operations by, well, December. And Vivek is picking up more details. Vivek, this has been stranded for so long. Those power purchase agreements that just don't get signed, and the whole tariff issue. What's the latest?
Well, that's right. So it's an important development as far as Tata Power is concerned. What we are picking up from our sources is that Tata Power's, almost 4,800 megawatt ultra mega power plant, which currently is stranded. It doesn't have any long-term PPAs with any of the 5 state governments, and also it is not currently operating under Section 11, that is the Emergency Act, where power was being procured on a cost-plus basis. But what we are picking up is that now the plant is in a state of readiness, and as the management had alluded in its Q2 conference call, the company as well as the Gujarat state government have reached an in-principle agreement to go ahead and sign a supplementary PPA for this particular plant. Now, this actually will end almost over a decade of an overhang as far as Tata Power's Mundra facility is concerned. And this PPA, we understand, will be reflective of the current cost of the coal that is being imported. Now, also, the important thing is that in the conference call, as well as what we understand from our sources, is that all of the 4 other states, will actually use the Gujarat model as a precedent to go ahead and sign PPAs in case this does fructify. It's an important development. We reached out to the management and we've been constantly getting their feedback as well. At this point of time, they're not responding. But an important point to note is that in the Q2 conference call, in a pointed question that both we asked in the media call as well as the analyst call, the management said that while they could not run Mundra under section level, they are in discussions with the government of Gujarat to finalize and they expect that the conversations which are in the last stage should be done by the end of December itself, or they are hoping to close it by December. Just to note, in 2007, Mundra signed PPAs with 5 state governments, which is Gujarat, Maharashtra, Punjab, Haryana, as well as Rajasthan. Now, just to give some perspective as to how important this particular development is for Tata Power, when the plant was operating under Section 11, Q4 FY25, now the company reports this particular segment as a cluster of Mundra, coal, as well as shipping. So it includes also the Indonesian coal mines. It reported a profitability of 171 crore. And for FY25, on a base of almost 4,500 crore of PAT, this particular segment contributed over 1,000 crore. So it's an important part of the total financials. Now, in the 2 quarters where the company did not have the plant operation, Q2, the company actually reported a loss of 362 crore in this particular cluster. So any kind of relief, any development, or any positive action, especially from state governments, when it comes to Mundra, is an important development for Tata Power, and we'll be tracking this particular development closely.
All right, thanks a lot for that, Vivek. Well, let's move on then to the next important discussion. We have the Union Cabinet that approved an incentive scheme to promote domestic manufacturing of rare earth magnets with an outlay of around 7,280 crore rupees. To help us out with what this means for the industry and the way ahead, we're joined by Mr. Mohanty, the Director of Finance, IREL, and Mr. Panda, the MD at IMFA. Good morning, gentlemen, and thanks a lot for joining in. Well, Mr. Mohanty, let me come across to you first. I believe that you all had plans to set up rare earth magnets plant in Visakhapatnam, if I remember correctly. What is the capacity, if you could tell us, and how do you look at the cost competitiveness post the scheme that has been announced by the centre?
Good morning to all. Actually, the point is rare earth permanent magnet are 2 types. One is from the samarium cobalt, and then another one is NDFE boron magnet. This samarium cobalt magnet IRL has already set off in Visakhapatnam. That is for the purpose of strategic use and not for the commercial use. The NDFE boron magnet, which is the scheme has come up with the initiative of the Government of India, which is a landmark step towards strengthening the domestic REPM manufacturing ecosystem. And this will definitely add technological self-reliance for the country. And this will bring the price disability currently around 43 to 44% is existing. This scheme will trying to mitigate that gap so that all the investors will come forward and this ecosystem for manufacturing of magnets will be developed in India, which is missing since long.
Mr. Mohanty, I just have a question on how the scheme is going to function. And I'm just quoting what the release said yesterday after that cabinet meeting. So the total scheme outlay is 7,280 crores. It has two parts. There is a sales-linked incentive, which is 6,450. And this is for 5 years. And then there's a capital subsidy for 750 crores. So can you help us understand how these sales-linked incentives will work? What are the thresholds? What is your understanding of the scheme? And it's open to all players, private and public. So will you be working with private players, or will you be largely doing this, setting up some new capacities on your own?
Particularly, this scheme is the intention of the scheme is to invite private players to come and invest in this sector where there was a price disability. So for this, the government is looking for now particularly 5 different manufacturers to come, where the maximum the subsidy will be given for 1200 ton of magnet making. And minimum is around 600 ton something they have kept. So once the 1200 ton magnet making will come per ton sales basis, this there will be a one expression of interest, and based on that, each bidder has to quote what will be the maximum benefit they want, the maximum subsidy they want from the government of India. So on that basis, it will be worked out, which is envisaged to be 1,290 crore per annum. For 5 years, it will be around 6,450 crores.
So will you be, again, the second part of the question, sir, is whether you will be partnering with private players, or will you compete with private players in setting up these rare earth facilities?
It can be. Actually, the situation is wide open. The private players, if they have got the tie-up with different magnet technology providers, so private players can join with IRL, can do it, or IRL can take the technology from others and can set up, or IRL per se is responsible to supply this this NdPr oxide, which is the new rare earth elements, which is required for manufacturing of these magnets. So IRL will be,
yeah. So you can partner, you can do it alone as well. Just a couple of basic points. This subsidy, etc., is for actual magnets, not the mineral out of the ground. It's not about how much you mine, but it is about the magnets themselves.
Yes, exactly.
Okay, which means that there is a processing capacity, etc., which needs to be set up for you to do this.
Yes.
I remember in our conversation earlier, just to go back to the basics, you said that we have lighter elements in India.
Right.
The total reserve is about 7 million. Heavier we don't have, and that's the issue.
That is the issue.
How does that work against I mean, how does this resolve that?
Actually, I'll tell about that. India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having, but we require dysprosium and terbium, which are required for the this coercivity, or to have this high remanence, which allows the retain high magnetization and coercivity in the magnet. So if that is not there, then this manufacturing will be difficult. In Indian resource, it is not there. So it has to be imported. This is available. Out of China, it is also available, like Malaysia and Australia, it can be sourced. At the same time, India is also looking for this source from the carbonatite source, which is available in Gujarat as well as the Rajasthan Siwana ring, where ample quantity of this dysprosium and terbium is available. Around 5% of the rare earth oxide available there is available, but this is at the exploration stage. Quickly, it is in government of India is.
This is with GMDC.
Yes, GMDC is Ambadonga, and the other one is Bhatikara. Is again,
so you're saying some element which is required to enable the magnets to be made is available with GMDC, and another.
GMDC, the GMDC, the facility has not come up. Right now, this dysprosium and terbium has to be imported. And on top of that, there are technology available like Protorial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
Right.
So, sir, what's the, and this is really important. So, while the intent is fantastic, we want self-reliance in these permanent magnets because of their widespread industrial use and auto use. But the success seems to depend on GMDC finding reserves of the certain, or you get a technology partner from, say, Germany, as you're saying. So can you tell us from your perspective, Indian Rare Earths, are you looking to set up these facilities for the magnets? We're just trying to understand the competitive landscape. Will you then, are you assured of certain supplies from GMDC, or have you started a tech transfer conversation with the Germans, say?
It is not exactly German. German is there, one of them. Then Japanese, like Hitachi, which is Proterial now. The Proterial is there, and Sensex, which is the largest magnet manufacturers, they are also all available. So technology transfer and other things has to be examined. Once this scheme has come now, then a lot of private players as well as foreign investors are showing interest. Okay. And IREL per se is the provider of this NdPr oxide. Okay. So the NdPr oxide will be provided by India, IREL. And this GMDC particularly, right now, they don't have dysprosium and terbium. So this has to be definitely imported right now. And we are also looking for those technology which doesn't require dysprosium and terbium. And if it will be required, very, very minuscule only. Okay. Only around 0.5% of terbium and 1 to 3% of dysprosium.
All right. So just keeping those chemical compositions aside, just to understand simply, the scheme is for magnets, which is more downstream in nature, and the chain is rare earth mining to rare earth oxides to metals to magnets. Is that correct?
Yes, absolutely.
Got it. So let's bring in then a potential player. Mr. Panda has been waiting by patiently. Mr. Panda, you have excelled in your business, the only miner here of chrome ore in India and backward integrated with regard to ferrochrome. How big an opportunity it is for your company, and what is your comment with regard to this? The scheme has come out 7,000 crores. The center clearly is encouraging players to come in there. Exciting enough for you?
Well, it's certainly a very, very significant scheme, Nigel, because not only are rare earth magnets important in themselves, but look at the broader picture. This is, as you just mentioned, it covers the entire value chain from mining all the way through to magnets. Yes. Number one. But it is a scheme which has implications and impact on major initiatives like Atmanirbhar Bharat, because you cannot look at self-reliance in manufacturing or many of the sectors where, without having control over rare earth magnets. And equally, that has then an impact on your Viksit Bharat ambitions. And finally, if you look at net zero, because rare earth permanent magnets have have usage in defense, in EVs, in semiconductors, etc. So there are multiple sectors related to your net zero ambitions. So from that perspective, I think this is something very significant. And what you mentioned about IMFA in particular, we of course have decades of experience in mining, in processing of ores, etc. Now I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain, as it is at the moment, going through the details and looking at what is there on offer. Mm-hmm. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
All right, and well explained, Mr. Panda. So there's an opportunity out there. We'll have to wait by for the fine print, and then in fact you'll take a call. But will you have to look for technology partners as well? If you could give us some kind of a sense in terms of partners that you'll be looking at, particularly on the technology front.
So I think two aspects are important. I was reading up on the scheme a little bit, what is available in the public domain at the moment. So it's both the sourcing of the rare earth oxides, and that's where IREL is an option. But I believe one has to look at some imports also, at least in the initial stages, while we focus on more sort of exploration, etc., to look at other resources. But this is where I think the government will come into play, both from a point of view of sourcing of the raw material as well as technology. And again, as Mr. Mahanti was explaining in his detailed intervention, that IRL itself could be a source of technology, but I believe there are other technology providers out there. So one has to look at it and look at it from I think this is something clearly one has to look at, not just from a commercial perspective, but also from a national, interest perspective, which is to, the intent of this scheme is to bring about, greater reliability to the supply chain. So I think every decision that one takes, whether it is sourcing of the raw material or the technology supplier, etc., I think has to have a national interest element to it, which I can't say overrides commercial interest, but is as important, if not a little more.
Okay, no, absolutely, very well explained, Mr. Panda. Mr. Mohanty, so to you, for investors who are watching, I think you should list IREL. I think that'll be the.
Is there a plan?
Are you thinking about it?
Actually, IREL is a strategic unit. So far we are exempted from getting listed. So the options are open.
Okay. So
but has that gone up to Deepam at all, Mr. Mohanty? Any discussions?
Nothing has happened so far. It is all we are evaluating.
Okay. So it's not out of the question, but
yes,
of course,
yes, definitely.
I hear you.
Definitely.
Mr. I know this is an unfair question to ask you, Mr. Mohanty, but maybe let me put it to you since we have you and you've explained the entire value chain and so well. From a GMDC from a GMDC perspective, you said, well, they don't have production of this now. In your opinion, with this push from the center, how far out is production when we see meaningful output from the mines that they have, Mr. Mohanty?
I think 3 years down the line, 3 to 4 years down the line, that will take.
Okay, 3 to 4 years down the line.
Right. Okay. Because actually it is on the exploration stage, and now from the exploration to they have to the flow sheet and other things must have been developed by now. They have to invite the tenders, put of the plans, statutory clearances and other things are there. So that itself takes a little bit of time. Other than that, setting up the plant and getting the production 3 years down the line, and considering the scheme, whatever is there, and the kind of interest shown by private as well as the government sector, so it seems 3 years, 4 years down the line, 2030, India will be definitely self-reliant.
Got it, Mr. Mohanty. Thank you very much, Mr. Panda. Appreciate you joining us as well. Very useful and insightful discussion, and we wish you both the best of luck as the scheme tries to help in this building out this ecosystem. Sensex has hit a new all-time high as well. So we've crossed 86,000 for the first time. Nifty, of course, 26,300. So records all along this morning on both the Nifty and the Sensex coming through. I mean, the small cap index, of course, now some distance away. The Nifty next, of course, is also close by. What we'll do is we'll take a quick commercial break here. We're going to come back. We'll just look at commodities and what's top of mind with Manisha. Stay tuned. Coming up.
Welcome back. Fantastic morning for equities, all-time highs. Let's see what's happening in commodities. Manisha, over to you.
Thank you for that. I'm making it a sweeter Thursday for you because I'm talking about sugar right now, where we have seen the prices gain up in the international markets. We've crossed above 15 cents a pound, and that is a one-month low, one-month highs coming in for the sugar prices. So when you look at the overall move that we've made in case of sugar, it has gained up by nearly 5% for the month of November. YTD, we still seem to be holding on to those gains of around 21%, as you can see on your screens. And this is going to be a second straight year of negative moves coming in for the sugar prices. Well, the reason for this is that almost all countries seem to be producing more sugar. So last year, we were dealing with a deficit of 2.9 million tons. But this year, the new season, that is, we have a surplus of around 1.6 million tons. This is what is coming in from the International Sugar Organization there. Having said that, we are looking at higher production, not just from India, but from Brazil, which is the largest producer of sugar, and then Thailand, which is the third largest producer of sugar. So between these three countries, we are looking at higher sugar production this time around. Having said that, India will also export 1.5 million tons in the global market in the new season. That would mean more sugar entering the international markets there. Interestingly, when you look at the new season there, almost all agencies which have come out with their numbers yet, whether it's about ISMA, NFCSF or CRISIL, are all talking about 35 million tons of sugar this time around, which is nearly 18% higher from what we had in the previous year. Reasons for higher sugar this time around is one, higher cane acreage. The second is about favorable weather. And we also are looking at higher yields this time around. The India sugar industry has a lot of concerns, though. So even as we are looking at higher sugar production this time around, the MSP revision for sugar has not happened since 2019. At that point in time, the sugar prices were set at around 31 rupees a kg. That is where it stands right now. While the cost of production has increased to 41 rupees a kg, that is because you have seen constant hikes in sense of FRP from 275 to 355, but it also has been about the state advised price, which is SAP, which has been increased. Add to that the bonuses as well. So the price that the mills are paying to the cane farmers is much on the higher side, but the sugar realizations not so much. The other thing really is about the ethanol prices, which also have to be revised for a third straight year. We haven't seen a revision in that. And this season is started, markets are anticipating could happen in the next fortnight or so. The other thing is about the concerns that the sugarcane distilleries are working at less than 50% capacity. So when ethanol blending was started and the whole plan was put out, it was to ensure that the sugar goes into this. But if you look at the rotation, or rather the ratio right now, that stands at 30 to 70. So 30% is what we are seeing coming in from sugar, and 70% of ethanol right now is coming in from grain base. A bit of a heartburn when it comes to sugar industry there. If you look at the global prices, they have declined by 22% in this year. That doesn't augur well as well for the exporters right there. And then it also has been about volatile production trends, compensation from the, competition from the good and unorganized Khansari sectors as well are some of the challenges that sugar as an industry seems to be facing on.
All right. Thanks very much for that. Manisha, appreciate you taking us through top of mind in terms of the commodities and soft commodities in focus. Lata is going to be speaking with a very special guest on the other side of this commercial break. Axis Bank MD and CEO Amitabh Chaudhary on their FY27 outlook. That's coming up in just a bit.
Welcome back. Axis Bank shares are trading at all-time highs, of course. Sensex, Nifty and the Nifty Bank are also trading at all-time highs. Axis Bank posted perhaps the fastest loan growth compared to the top three private banks at 11.7% in the second quarter. There was a very good margin management as well. While many brokerages, Jefferies, Nomura, HSBC, have all a buy rating on the stock due to the better valuation, analysts are worried about the repeated one-offs that have hit the P&L and, of course, more lately, some high-level resignations. To get an idea about the bank and how it sees the coming year, that is 2026, I have with me Amitabh Chaudhary, Managing Director and CEO of Axis Bank. Amitabh, good morning. Thank you very much indeed for your time. You're the first big banker we are speaking after the festive season. So how was it? How was the loan demand? And would you want to substantially increase your loan growth guidance?
So, Radha, thanks a lot for calling me on your show. Let me start answering your question. Loan growth during the festive period reflected strong customer sentiment and structural enablers. So just to give you a sense, on the wheels business, we achieved a strong growth in October 25 versus 24 of 21%. And obviously, this was driven partly by the pent-up demand of September flowing into October and some of the GST rate cuts, which you saw, obviously the buoyant festive sentiment and positive customer confidence stemming from all the actions which the government is taking, and so is the regulator. And we saw some similar trends on the mortgage side. Even on the card spends, we got an extra boost with GST benefits coming in right at the start of the season. So we saw strong demand and double-digit growth across key categories such as durables, shopping, and online marketplace sales. For example, in card side, we had partnered with almost 200 brands during the festive season. So overall, the sentiment was positive. November, the trend is looking decently good. I wouldn't say obviously it will not be a repeat of the festive season, but overall, the market sentiment seems to be strong. You're also seeing clear upgrades coming through on the expected GDP growth rates. So I think that is also getting reflected in real projections on how the economy is expected to do. Obviously, I mean, there are always challenges, but overall, the sentiment does remain strong.
So you would want to give us a guidance?
Okay, sorry about that. Well, we are progressing well to be a stronger and sustainable franchise. We've been talking about that theme for quite some time. We do believe our platform will allow us to grow at rates faster this year than the industry. And this thesis, we believe, will continue to play in the medium term. The supportive regulatory conditions and the operative landscape obviously adds to our confidence. We have also said that in the medium term, which is defined as 3 to 5 years, we believe our advances growth will be above the industry growth rate. So yes, obviously, the credit growth rate is picking up. The numbers seem to indicate that. The deposit growth rate seems to be a bit tepid. But our view is that given the pipeline we have, given the momentum which we are seeing, this year we should be able to maintain a growth rate higher than the industry. And then obviously, in the medium term, we also expect to continue to drive our platform accordingly.
Okay, time permitting, I will come back to this. The more recent news that hit the exchanges was the resignation of the chief risk officer. Now, actually, I went back. For the past year, you've had not just Amit Talgeri, which is the most recent risk officer, Arjun Chaudhary, the affluent banking and cards guy, resigned, S. Bhaskar, the chief of audit, Ganesh Shankaran, the wholesale banking, that was 1 year ago in November. So, I mean, is there a pattern we have to read, or were these all personal decisions?
Oh, well, there is no pattern here in the sense that, firstly, recognize Axis Bank as a great platform where we are generating talent which people want to hire. In some cases, the decisions have been personal. People have been doing the same job for a long period of time and they want to take a break. And so in some cases, some of the names that you took, people actually have picked up jobs post leaving us, which are more slightly less intensive in nature than what they were doing earlier. So it's not leaving the organization, it's making a lifestyle choice. In some cases, they've got opportunities which are very, very different from what they were doing in Axis. I mean, you took one name where the person has gone and is running a very small company, but the potential to grow it larger is huge. This is kind of a completely different platform. So I think the reasons are individual. I don't think it reflects anything on Axis, but I'm quite glad that people are now seeing Axis as a place where they can hire extremely good talent.
Oh, yes,
and
yes.
We have replaced Amit with someone internally. So we have enough talent internally also where people are getting opportunities to grow.
Okay. No, if that's the reason, that's very good. I just noticed the pattern. Let me come to the other news which CNBC-TV18 broke. My colleague Yash Jain broke a story on the Insurance Amendment Act that's going to be tabled on Parliament. And there is a major liberalization in the sense insurance companies may be allowed to merge with non-insurance companies. Now, you have, of course, Axis Max and Max Financial. Do you think, therefore, a merger is imminent? If this is allowed.
Has been on the cards for a long period of time, Lata. I mean, we have been hoping that the new insurance bill will allow a merger of these entities. The core business will obviously remain insurance, and that's the only business they will do. Here we have a unique case where there is a holding company which holds shares in an insurance company, and so that's the only thing they hold. And we would like to have a merger so that the shareholders of that holding company can take ownership of the Axis Max Life Insurance directly. Recently, you would have also been aware, when the story was broken, that IRDA has decided not to pursue the case in Supreme Court. So it's an indication from IRDA that maybe the bill is coming or they will allow something like this to happen. Our views are that there is further guidance expected from IRDA on this matter. And based on that guidance, we will act. Our intention and hope is that we will be allowed to merge the two entities so that there's only one entity which is out there. By the way, Axis Max Life is doing exceedingly well. And I think that is also reflected in the stock price and their market share gain. So we're very delighted with the investment we have made and how that entity is progressing.
Okay. You all had also expressed a desire to increase your stake in Max Life, that is Axis Bank's stake. But there was the SEBI investigation on the pricing. Anything latest from SEBI? And therefore, if that is a done deal, can you go ahead and raise your stake?
Well, the investigation from SEBI side is going on. Normally, these investigations and this process takes time. So we are going through the process. We believe that we have a very strong case here. That I think whatever we have done is with the full approval of the regulators involved. But obviously, SEBI as a regulator has a right to go deep into the case and take their view on whether what we did was correct or not. And we are going through that process. Okay. We would obviously like us to take our stake to 20%. We would also like to, understand once the Forms of Business Circular comes as to what some of our options are. Right now, we don't know. Yeah. And at the right stage, we will see whether we want to increase our stake or not. We cannot take that decision unilaterally. There are other shareholders involved. So it will take time. Right now, there is nothing on the card.
Fair enough. Fair enough. Anyway, regulators seem to be in a more liberalizing mode. So let's see. Let me now come back to your P&L. Margins, it was a pleasant posting that you all did, just 7 basis lower NIMs. What is your sense about, will Q3 be the bottom? I think that's what you guided, that Q3 will be the worst. And there is a possibility of another rate cut. So then what happens to the NIMs?
So let me start by saying, assuming there is no further rate cut, let me give that position first. We expect margins to bottom out in Q3, mainly due to a slight, and the reason why margins might go down in Q3 is because of a slight tilt of loan mix towards wholesale over the last few quarters. Okay. And obviously, we'll see the agri seasonality impact in Q3. A bank has maintained that through life cycle, the cycle stance of average NIMs at 3.8%. And cycle is measured in terms of duration of 15 to 18 months, starting from the date of last rate cut in June 2025. So we are maintaining that stance. We do believe that the margin trajectory is like an inverted C. Effectively, margins will moderate when the rate cuts are announced, drop on the inverted C, and then it starts climbing back towards the end of the duration period, because then the kind of deposit rates also catch up. We all know that the expectations in the market on the rate cut are quite high. I think people are almost assuming that the rate cut is pretty much a given because inflation projections are low. And that obviously the impact of GST cuts is flowing through. So my view is that a rate cut might happen. So some of the commentary which we have given in the second quarter might change. But the overall, if you kind of expand the time period, overall our commentary on margins does not change. Quarter to quarter, it might be different because there is a additional rate cut that might come in.
Okay, fair enough. Now let me come to credit cost. Both credit cost and slippages as ratios fell, and that was positive. But you all have not gone back to your Q4 lows. Last year, Q4, your credit cost was 50 bips. Now you are 73. What should be the direction of slippages and credit cost? Can it go further lower?
We do not provide any guidance on the credit cost. But financial 27, we do believe would be normalized with effect in comparison to financial year 26. Okay. So we have had some one-off events. Firstly, they will get normalized. Secondly, Credit cost cycle itself is witnessing a normalization from through cycle trough seen in financial 23 and 24. So despite this normalization process, so for 23, 24 were way lower than where they should be. Then we saw obviously a spike. Now we are kind of coming down to normalized levels, which will be slightly higher than financial year 23-24. Okay. But our view is that they will settle at levels lower than what we are seeing right now. And obviously, Axis Bank has been quite conservative in terms of the approach it has taken to the kind of the risks which you want to take in the business, both on the wholesale and the retail side. And our view is that this will continue. So overall, things are stabilizing, and they should stabilize at levels lower than where they're seeing.
Okay. I have just one more question on that, but let me get out of the way a worry which analysts have. While you are a buy, the stock is a buy for many of the brokerages. There's just this worry. Twice in a row you had a one-off. Yep. So, and then on October 9, there was another caution from RBI. So should we expect another one-off, or is it over and done?
See, some of the one-offs which are there were subject and based on continuous evaluation of our policies, products, services. In some cases, we discovered them ourselves. In some cases, we were guided by RBI. Right now, we are not aware of anything which would result in a one-off. But, I cannot guarantee that this will not happen. Yes, we have taken that one-off, and the last one-off which we took, we have very clearly stated to the market that we expect this amount to be written off or written back completely in the March 28 quarter. It just gives us increased provisions in what we had earlier. We always had the COVID provisions which we have not touched. So we do believe we are a conservative institution, as and when we discover something where our standards or our accounting policies are slightly below what a typical conservative institution would have, we will step up very, very quickly and take whatever hits we have to take. We are not aware of anything right now, but the interpretations do change. Sometimes you do see things where maybe you could have done it in a slightly different way. That keeps happening, but hopefully the size of the balance sheet we have should be able to absorb them without too much of a problem.
Fair point. No, of course, it didn't impact margins, etc. Just now coming back to that slippages part, most of the banks, including yours, were lending a lot of loans to MSMEs. Now, do you see any danger at all? I mean, for other banks, they went even 29, 28% higher on MSME loans. In your case, I think it was 16% higher year on year. You don't see any danger over there, is there, MSMEs?
Well, as you rightly pointed out, there is an increasing commentary coming from NBFCs that MSME side of the business is seeing trends which are negative. And right now, let me just clarify once again, we have not seen any signs in our portfolios, although we continue to keep a close watch. The fact that it is happening somewhere in the industry and we are in the risk-taking business, we should obviously, be reading this commentary very, very seriously. Okay. Just to clarify why we might be different, significant portion of our MSME book is secured by way of immovable property or assets. So it adds comfort not only to the underwriting toolkit, but also recovery in case of stress. Just to give another data point, 85% of our portfolio and 87% of our incremental sourcing is from SMA 3 and above borrowers, which is obviously higher rated borrowers. So these rating scales are back tested and monitored with rigor periodically. And as on today, they demonstrate performance above acceptable levels on various parameters. Another data point, 70% of our loans are short tenured. Hence, reducing exposure to default is easier, or you can monitor them faster and lower than the long tenure loans. We also quite well diversified geographically and industry-wise. So there are things which tell us that, okay, we might be slightly better placed, but I do not want to kind of walk away from the fact that the industry is feeling some stress and we should be watching our portfolio like a hawk, and that's exactly what we are doing. By the way, the recent announcement from the government on the relief package, which is similar to the earlier ECLGS scheme, will also give some breathing room to some of the SMEs who might be suffering. So watchful, right now seeing no signs, but being extremely watchful about this portfolio.
Oh, thank you very much, Amitabh, for a many-sided interview. I could have gone on, but out of time, and the stock continues to trade at all-time highs. Thanks a lot.
Thank you. Thank you so much, Lata. Thank you.
Okay. Well, there you are. All indexes at all-time highs, Sensex, Nifty and Nifty Bank, and the stock we just spoke about, Axis. On that positive note, wrap up on Bazaar Chartbusters coming up.
You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangadam Malu. With me as always, Nigel D'Souza. And today is a green letter day because the Nifty and the Sensex have both hit record highs. But as we celebrate the frontline indices doing extremely well, let's find out whether broader markets will do well or not. And that depends on the earnings environment, the demand environment, and how business pans out. And who better than some of the consumption companies to join us today? AWL is joining in today to discuss the business. Remember, AWL was earlier Adani Wilmar. Now it's AWL Agri. We have the CEO Angshu Malik and the Deputy Executive Chairman join us on the show as well. So Angshu Malik and Shrikant Kanhere, both of them with us. Thanks a lot, gentlemen, for joining in. For the first time, we're speaking as the Adanis, have exited the business entirely. So that really is the first question. How is life after that? Because were there any, management changes that the street can expect going forward with this development taking place? Now they're also declassified as promoters, not having stake in the company. Were there any agreements with business partners, vendors, etc., which was subject to the continuation of this arrangement, which stand to be renegotiated? If you could first, to start things, tell us, how life goes on without the Adanis. Angshu.
The life has not changed much in the sense that the strategy part, the overall outlook of the business and the confidence in the Indian market still remains very, very bullish and up. Now, on the management side, as you see, Shrikant is now the new MD and CEO of the company, and I move into as Executive Deputy Chairman. I have been in this company for over 25 years, so the continuing with the organization and guiding on strategy and other things which Shrikant and we will work together. Now, this is the only change that has happened in the light of change from Adani's exit. But otherwise, from company point of view, the business point of view, the growth strategy, investment strategy, everything remains robust, and we are going ahead with all the plans that we had.
All right, take that point. Shrikant, so in that case, welcome as the MD and CEO, your first interview. Important to know then what your strategy would be. How did it be any different or plus from what has happened earlier? If you could give us a sense.
I think as we go further, I think the top priorities for the company remain same what we were driving earlier. I think the food will remain the top priority for the company. We will want to grow the food to a sizable level. We are already a 1 million ton of food basket today. As we go further, we would certainly like this business to grow in a double digit as next couple of years, number one. Number two, of course, the distribution again remains on the top of our agenda because today with the 2 million outlet coverage, we are still reaching at close to 50% of the universe that we would cover. So distribution has to be there. And there's a lot of potential even now to grow. And as we go forward, I think everything, all the growth which we see will be a distribution-led growth that we will see. And third, and of course, any CEO would like to drive, of course, the expectation from the investing community as well as the promoters is to consolidate the margins as we go forward. So these are the three top priorities that we would be driving as we go forward.
All right. Hi, gentlemen, and welcome, Shrikant. First of many interactions. As you said, food and FMCG, that has tremendous potential. And there are various touch points that you would like to go to. That said, as a percentage of the contribution, where is that headed? What's the timeline that you'll be looking at? And, if you could help us out in terms of the margin outlook. Once investments are complete, what should the broad range be?
Yeah, food, and I think we started our food journey sometime in 2015-16 with rice, and then we added wheat flour, then we got into a besan, nuggets, poha, and so there's quite a long tail now we have in our food basket with a varied margin structure. So as we speak today, our food is contributing close to 20% of the volume in overall scheme of the things, and it's quite a sizable volume rather, I would say, as I said, 1 million ton of food basket today. We would certainly want this to go beyond 25%, and that's the something which we are working on, because the more food gets into the system, it to some extent also de-risk your oil risk or a commodity risk which we run on the oil side. number one. Number two, on a margin front, I think food certainly has got a better potential to have a margin as compared to the edible oil. Today, it's by design and to some extent an EBITDA neutral business because we are today in food in the investment and the growth stage. I think in the next couple of years, we would reach to a level where we will start consolidating margin as far as the food is concerned.
If you could give us a sense, Shrikant, how much a 25% volume contribution from food would turn into revenue contribution, because food and FMCG account for just 10% in your revenues right now. You said that you are looking to decommodify your business. But even in the categories that you're present in the food business, most of them are commodities, right? There is rice, there is soya nuggets, all these products that there are, pulses, etc. They're all commodities. So how do you decommodify that business? Are you looking to get into prepared dishes and things where the underlying price of that commodity does not matter as far as the user price is concerned?
So to answer your first question, what kind of level we are looking at in terms of the revenue? I think of our target, we have been saying this for quite some time. We want to reach to a 10,000 crore of revenue once we reach that 25% kind of volume. And I think that should happen in next 2 to 3 years, number one. Number two, when I say decommodation, I don't mean to that. What I'm trying to say is, since the food is less volatile as compared to the oil, so therefore more food gets added to the basket, you are de-risking the edible oil risk.
All right. And just a couple of questions before we wrap it up with Anshu. Shrikant, just tell me, you said you want to increase your distribution touch points. You're currently at around 9 lakh stores. What is your target over the next 2 to 3 years? And rural, it's about 31% of your revenues. What's your target here? Quickly.
Yeah, so on distribution front, we reached to close to 2 million outlets, direct plus indirect. Direct is close to 900,000 outlets. We would certainly like to cross this 1 million as a target by end of this year, number one. And on the rural side, of course, today we are reaching to close to 50,000 towns, and the rural contribution is close to 31. We want to make it to 35% by next couple of years. That's the target which we are running on the rural side.
All right. And Anshu, finally, on the larger part of your business, edible oils, if you could give us a sense on the remainder of this year, how's demand been? What's the kind of volume growth you're expecting? And given the sort of price changes, what's the inventory that you're sitting on? Should we see margin improvement from here on or margin reduction?
On edible oil front, we have seen at the India level, the domestic consumption has actually flattened and has not grown. Whether we look at Kantar reports or Nielsen, both are saying the same. We also see hardly 1% or 2% growth. Now, why is this happening? Possibly one, there in edible oil, if you see the price last year versus this year, you will find it's almost 25 to 30% higher. That has impacted the purchase at least at the rural or smaller towns. We have also seen the pressure in the metro cities. Going forward, the prices are likely to remain stable, and at these levels, consumers are getting back into normalcy. And we see this quarter, October, November, December, sales are picking up as compared to the first half of the year. Now, from a company point of view, we have started working on creating some premium brands and premium products, because we see there is a consumer which is looking at cold press oil, they are looking at first press oil, they are looking at organic products, and they are looking at expert solutions to their problem, whether it is sugar, high sugar problem, or there is cholesterol issues. So they are looking at it, and we have Fortune Expert oil, and we have 2-3 products on it where we find the sales are now improving, particularly in the e-commerce chains.
Take that point. Thank you, gentlemen, for joining in. Good luck for the growth prospects of the business going ahead. And as we pointed out, this is the first of many conversations that we'll have across your various businesses and discuss how growth is panning out in all of them. With that, we'll take a short break, come back on the other side. Somil Mehta of Mirae joins in for a quick technical check on the market.
fact, markets holding on to good gains. We're at around the 26,300 mark for the first time ever. So scaling new heights, and the Nifty Bank is participating. 60,000 almost on the cards for the Nifty Bank. But the most heartening aspect today is yet again we have number of stocks advancing more than the number of stocks declining. Somal Mehta joins in to help us out with how would he trade the index. Hi Somal, good morning, good to see you win. Trade on the index and 2 fresh calls on stocks as well. Go ahead.
Good morning to everyone. Congratulations to all of us for the new high. Calls for a celebration, right?
Yeah, but not feeling like that, Somal. The portfolio is not feeling so good. The mutual funds that we have anyway is not looking too much. But anyway, go ahead with your trades.
All right. So Nifty and Bank Nifty view definitely positive, as we've already spoken about it a few times. My targets on the upside now revises to 26,800, 26,900. That would be my target. 20 daily moving average still remains a very, very crucial point here, a crucial support here, which is 25,870 now, and 40 daily moving average is 25,700. So these are very crucial levels to watch out for in Nifty. My view is positive, and I'll be expecting 26,800, 900 as target on Nifty. Now on Bank Nifty, the targets revised to 60,400, 60,300, a little higher from these levels. And the support still remains around 58,650. So these are some levels, and view is positive in the short term, in the medium term, both. 2 stocks which I've chosen is both large caps. Bajaj Finance would be my first pick. It has started a new rally on the upside, taking support at the averages, taking support at upward sloping trend line. Great setup for a medium term trade and in the short term as well. Stop loss would be 1,000. Target would be 1,100. The second stock which I have is again large cap. HDFC Bank has started a new rally on the upside now today, has broken a flag pattern. Stop loss would be 980 and target would be 1,100.
All right, we take that point. Thank you so much for that. With that, we take a short break, come back, more news and updates on the other side. All right, you're watching us here on Chartbusters. As we look at it, 26,288 on the Nifty, the Sensex, 86,000. Important levels, red letter day, green letter day, the way you call it, celebrations, Nigel.
Well, that's right. We'll wrap up on Chartbusters, but talking about red, I believe the team of Trading Hour is dressed in more red than green. They are tuned on the other side of the short break.
And which of the three are dressed in red versus green? We'll have to find out. Take a break, come back, watch Trading Hour.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormiz Patakia and Reema Tendulkar. Well, bulls are charging ahead. That's the theme, of course. The Nifty, decent gains from the lows as well. We are almost 100-point up on the Nifty as we speak. The Nifty bank contributing 0.5% higher as well. The mid-cap index briefly saw some red, but it has recovered from those levels, up 20 points right now. The advance decline ratio is in favor of advances. But, yesterday we saw a bigger rally. All the sectoral indices were in the green. The Nifty constituents did really well. For today, the contribution is not coming from across the board. We are seeing gains, but something like a PSU banking index, energy, realty, small caps, all of them are under pressure. So watch out for that one, and specifically the advanced decline ratio, because the market breadth is very important to track. That has been on and off in last couple of trading sessions. Hey guys.
Hi, we've punched through new highs and we're pretty much sustaining at those levels, at least in morning trade. And once again, global markets are fairly supportive. Nikkei, that's the Japanese market, has gained 1.25%. The Korean markets, which have been on a tear, it's been a record-breaking run for Kospi this year with a gain of about 66%. That's added on another 0.5%. So global markets are fairly upbeat. And Hormiz, I always thought that maybe the markets would hit all-time high levels once that India-US trade deal is signed, right? Everyone was looking at that as the tactical trigger for us to cross this hump. But we've done it despite. So once again, underscoring that, or maybe taking note and acknowledging that earnings has picked up and domestic liquidity, of course, all thanks to retail money.
Hope is eternal, isn't it? And that is why we've, ever since the conversations about this impending deal started to happen, positive connotations started to take place on this deal. The Nifty started to move higher from those levels of 24,587, which was the recent swing low. And then we started to move past that 25,000, went up to 26,000, then consolidated. And now we are at new peaks, 26,310. Now the new record high for the Nifty. And it's been that kind of a market where good news is getting factored in before it takes place. As of course, the trade deal yet to happen, but the anticipation of that trade deal has resulted in a lot of market moves, be it in those trade deal related names as well, be it the likes of the Gokaldas Exports and the Avanti Feeds and the kinds.
Oh yes, a lot of them, and export-oriented stocks, they were definitely on our radar. So we'll, of course, discuss them. For now, Gokaldas Exports, it is at the day's low, but couple of other names which are on our radar because of the moves that we are seeing in the broader markets. Pull at something like a Gillette. That stock is up around 5% as we speak. These standalone refiners were under a lot of pressure yesterday, so there is some recovery from those lows. Chennai Petro is up 3% as we speak. A lot of discussions about labor laws, how that could impact a certain sector. SIS Limited, that is the stock on our radar, and that is something that we should be tracking as well. But Nifty at an all-time high, so many constituents to talk about as well. Hormuz has gone across to the big wall with what really led to that rally from the lows. Hormuz.
It's taken us 14 months to get back to where we were in September of 2024, and the Nifty now making new highs. But the bigger talking point is the fact that from the lows that we made in April, the index is up 19%. It's been a very sharp move on the upside over the last 8 odd months. And if you take a look at the contributors as well that have led to this move, you would not find the usual suspects. BEL, of course, has been one such name, but Eicher Motors is the top gainer on the Nifty from the 27th of September last year. Bajaj Finance a slight cool off from the record high levels, and therefore it has moved down to third place. But SBI and Bharti Airtel also making a move among the top gainers on the index over the last 14 months. But take a look at the underperformers. Trent, a high flying name until for a better part of last year, but has halved from those levels. Bajaj Auto incidentally made a record high on the 27th of September 2024 and is down 28% from those levels. Coal India, TCS, NTPC, all of them featuring among the laggards for the Nifty during this period. Now, if you take a look at the gainers from the lows that we made this year, BEL and Eicher Motors, of course, are the common names here. But look at M&M, the rally that it has had for ever since the GST reforms, Eternal, Geo Financial, all of them seeing gains in excess of 40%. But look at the laggards as well from this period. But the sectoral picture as well, the Nifty Bank has been a big contributor to this move. The index at record highs nearing 60,000, up almost 10 to 12% now. The Nifty Auto Index hasn't done much, but the IT Index has been an underperformer. The bigger underperformer, though, has been the FMCG Index. That's down 16% since September of last year. And the same quiet moves for the Pharma and for the Metal Index as well. The Nifty may be at record highs, but the broader markets are the ones that are feeling the pain. The mid-cap index has done precious little during this period. The small-cap index is down 7%. And therefore, if you take a look at the stock-specific movers as well, you look at BSC, Paytm, Muthoot Finance, Indian Bank, all of them seeing gains of 60 to 100%. But take a look at the laggards. They are the ones that are the bigger talking points here in the broader markets. Colgate, IndusInd Bank, no longer in the Nifty. Tata Tech, of course, Rima will talk more about that. But PSUs like RVN and IREDA, the high-flying names of 2023, down anywhere between 38 to 40%. The small-cap names also present a similar story. You have winners like Laurus, Navin Fluorine, MCX and Sagility, but look at the losers. Tejas Networks is down 60% over the last 14 months, as is Ola Electric. Jindal Saw, Brainbees, Whirlpool, all of them down anywhere between 45 to 50%, and these are just 5 names. The list will go longer if you take a look at the list of underperformers within the broader markets. But today's talking point, the Nifty at new highs, the bulls will definitely be hoping the broader markets play catch up pretty soon.
Thank you very much for all those numbers, and it's been a very uneven recovery. But what stood out is the fact that in the large cap space, TCS has underperformed. In the mid cap space, you spoke about Tata Technology. So let me pick up on the performance of IT stocks versus their all-time high levels. Well, a couple of observations. One, there are 2 Tata mid cap companies which are 50% of their all-time high levels. We're talking about Tata Elxsi, where the all-time high level was 10,760, and the other one is Tata Technology. technology. But if you just, broaden it out a bit, the takeaway is that ER&D company, engineering, R&D and development companies, which includes a KPIT, LTTS, they are the rank underperformers. And the key reason is the growth rates for these companies have moderated. So from the COVID low till FY23, these companies had phenomenal growth rates. Just for an illustrative example, if you pull up a KPIT Tech or you pull up a Tata LXC, you would see very strong growth rates of 30, 35% coming through. And then suddenly growth rates came off from FY24, FY25, and FY26 is also going to be a very sluggish year for these companies. The third is that large cap IT companies are about 20 to 30% off from their all-time high levels. So Wipro and TCS about 30%, Infy HCL Tech closer to 20%. The mid-cap companies where growth rates have been high, and the poster boys here are Persistent and Coforge. These are the ones closest to their all-time high levels, about 6% and they're the ones which despite the weakness that we've seen in the broader IT stocks, have delivered some phenomenal returns over the last 3 years. So that's the sum and substance of the IT stocks. But moving on now, there is some news on Tata Power. An over decade-long overhang is set to be lifted on India's largest ultra mega power project, and it's set to resume operations after months of inactivity and over a decade of uncertainty. Vivek joins in with the details.
Well, that's right. So, one of the most important plants, in fact, one of the largest plants in India, and especially for Tata Power, the Mundra UMPP, which is the ultra mega power plant, which is 800 into 5 megawatts, which is close to 4,000 megawatt, and this particular plant has actually been in operation since July 2025, when Section 11 was not extended. So now, it's been inactive since July, and not only that, there was absolutely no visibility as far as long-term PPA is concerned. But now what we are understanding from our sources is that the company as well as the Gujarat state government have reached an in-principle understanding to go ahead and sign a supplementary PPA to resume operations and to start procuring power from the Mundra facility. Not only that, remember the original PPA was signed with 5 states, and we understand that once the Gujarat supplementary PPA is signed, of all of the 4 other states will use that as a precedent and go ahead and start procuring power from Tata Power at what will essentially be very similar terms and conditions. Now we reached out to the management of Tata Power. So far they have not yet responded to our queries, but just to give a sense of how important this particular development is for Tata Power, in FY25, the company reports a cluster, Mundra Coal and Shipping, and this particular cluster reported a PAT of 1,078 crore. It's reasonable to assume that majority of the contribution would have come in from Mundra itself, and it was just operating under Section 11, not a supplementary PPA. In Q2, on back of the fact that Mundra was inoperational, that particular cluster actually reported a loss of close to 362 crore. So, the importance of Mundra cannot be underestimated. It's an important development, and we will keep updating our viewers on the same.
Okay, all right, and we'll keep coming back to you as and when there is an update, Vivek. Thank you so much for joining us with all those exclusive details. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll focus on the crypto market as always with Manisha Gupta on the other side.
Welcome back. As promised, let's talk cryptos. Manisha is now joining in as always. Manisha.
Well, thank you so much for that. What I'm talking about today is metaverse, because we've seen this economy continue to evolve and grow as well in sense of numbers there. Well, there is increasing demand for immersive experiences, and that is where it's taking the markets from. When we talk about evolved metaverse, well, the fact being that earlier it was all-encompassing, single, massive virtual world where you could go party, meet and buy land as well. Well, that's not what's working right now. What is working is smaller, focused virtual experiences, which perhaps companies and education centers and a lot of gaming companies as well seem to be bringing in now. So when you look at the overall market here, in 2023, metaverse overall was $82 to $95 billion of a market, with an expectation and the kind of growth that we've seen in the last many years, expected to be a $1.3 trillion of a market by the time we are in 2032. Now, when you talk about metaverse, it's built on a lot of converging several technologies there. To begin with, it's about virtual reality headsets, which, by the way, seem to be getting lighter and more precise. Augmented reality glasses is another thing. Artificial intelligence, because that helps in generating content and power automated entities within those virtual worlds itself. And most importantly, when you try to own something in these virtual worlds, it has to be on blockchain and Web3, because this is where decentralized finance tools and ownership of digital assets will happen. And then, of course, it is about high-speed connectivity, which is crucial for real-time, seamless interactions within the metaverse as well. I also want to take you through on where major focus into metaverse really seems to be coming in right now. One, well, absolutely, it has to be gaming, because that is where you have to have that AR, VR and immersive experiences there. It also has to do with work and education. A lot of websites, apps, projects now seem to be working towards in this direction, where immersive metaverse is working in sense of education. Social interaction, well, yes, a lot of meetings seems to be happening in that sense there. And then there is commerce, a lot of jewelry companies, sales, commerce seems to be happening, buy and sell within metaverse as well, where you can experience the product in sense of metaverse. And then travel, remember those 3D houses and travel locations, etc. Well, metaverse really seems to be using it to full hilt right now. And then there is, of course, cultural environment. This includes of concerts, meetups, etc., wherein as well metaverse as an economy seems to be going quite fast.
Okay, all right. Metaverse, so much focus, and we spoke about it some time back, and now again, as you're saying, it's back in fashion and we are talking more about it. Thank you, Manisha, for bringing us all those insights. With that, we'll slip into a break. When we come back, we'll discuss market technicals with Jay Thakkar of ICICI Securities. Welcome back. Well, there is some selling pressure from the top. The Nifty is up 73 points, yes, but there's some selling which has come by as well. Bajaj Auto, Tech Mahindra, Infosys, TCS. So some of these IT names, they are leading to the pressure on the Nifty from the highs as well. Bajaj Auto is at the day's low. We do have some selling pressure on Infosys. The stocks like Reliance Industries, a big weight on the index, that one too is putting some pressure on Nifty as we speak. The mid caps too have turned into the red. That's a 75-point downtick on the mid caps, though the advance decline ratio so far are in favor of the advances as we speak. The Nifty mid cap index at the day's low. So watch out for that one because these lines are fast converging and market breadth will be important to track. But let's get in Jay Thakkar from ICICI Securities for a quick technical check on the markets. Jay, what are the charts suggesting? Do you think we'll see some profit booking today after the stellar rally yesterday and record highs today?
Hi, good morning to you, Sonal, and congratulations first of all to you and all the viewers of CNBC-TV18 of again watching Nifty at the all-time high. I mean, it's definitely time to celebrate. But at the same time, we have seen the market breadth overall so far has been negative. But eventually, I think that with this kind of a breakout in the leading indices like Nifty and Bank Nifty, I think overall breadth is likely to improve going forward. So from the Sensex weekly expiry point of view today, that being the case, you can definitely see some volatility, some profit booking from the high levels due to the weekly expiry of Sensex. But overall setup, if we see, then I think now that until 26,100 levels on the Nifty aren't broken, until we don't see a close below those levels, at least for this weekly expiry for Nifty, or maybe until 9th of December, that is the next weekly expiry. For next 2 weeks, I think Nifty is definitely in the clear uptrend, and we have a target of 26,500 now going forward. And eventually the target comes to 26,800 for the December series. Then the logic for that, Sonal, would be that we have seen a good rollover happening overall market-wide. But there has been a good short unwinding by the FIs, and the index shorts have come down almost to 90,000 contracts now by the FIs. And generally, whenever we have seen this kind of short covering happening, generally Nifty has gone up by 1,000 to 1,500 points. Now, if we take that from say 25,800, which was the previous base, then I think 26,800 should be the conservative base for Nifty. So for the December series, those are our targets, and for next 2 weeks, I think 26,500. Those would be our target for the index. So we continue to maintain a stance bullish for the index.
Okay, gunning for 26,500. Jay, out of time, but thank you very much. So, still bullish going into the year end. But Thomas, you're looking at Whirlpool, large block deal?
Oh, indeed. And it has been in conversation for the last couple of years now for Whirlpool. And today we saw almost 1.5 crore shares that were traded today. 11% stake. So the initial plan was to sell 7.5, but then the deal was upsized and we almost 11.5% equity that was traded. The average selling price today was around 1,041. And the street had a whiff of this, that this is in the works, because Whirlpool Corporation, the parent company, during its third quarter earnings presentation, they mentioned that they are going to announce this stake sale sometime towards the end of the year. And the fact that they are going to bring the stake down to 20% in the first half of 2026. Now, the price at which the previous block took place was at around 1280, and the stock has since then been on a bit of a downtrend, and today's selling price was of course around 1041, and yesterday's close was around 1200. So which is why you see that bigger fall that you're seeing on the stock price, because it was a substantial discount at which it took place. Now, in February of 2024, the promoters had sold 24%. They bought their stake down to 51. They had 75 earlier, and they made no bones about the fact that it was because of the valuation arbitrage is why they sold their stake. The Whirlpool Corp CEO, in an interview to CNBC, stated that very clearly. The parent company trading at cheaper valuations, the unit trading at much expensive valuations. At that time, Whirlpool India was trading at around 50 times. The parent was trading at around 7 times. So that was the big deal. And of course, a lot of the funds were buyers in that. SBI, IMF, Society Generale, Nippon, all of them. And since that deal in February of 2024 until October, the stock had almost doubled. It went up to levels of almost 2,500 by the end of October of 2024. And after which there was some concerns with regards to earnings, the overhang with regards to further stake sale, whether or not it might happen or not. And that is why the stock until the 29th of January 2025 was down around 36% from the October highs, which were around at 2450 levels. And on the 30th of January, Whirlpool made this announcement that the parent intends to bring that stake down down from 51 to 20%. Then they planned on doing that by mid to late 2025, but now they've said that it will be in the first half of 2026. The 2 days after this announcement, the stock was down 30% within the next 2 days. And if you take a look at the shareholding as well, MFs were big buyers in that block that was sold in February. So they increased their stake. FPIs have increased their stake since from March 2024, from the very recent September of 2025. You take a look at that. But retail has chose to remain cautious. Their shareholding has remained relatively the same from around 5.5% to 6%. It is still the same at around 5.5% to 6%. The valuation arbitrage still persists. Although Whirlpool has seen a substantial correction, it is still trading at 38.2 times FY26 price to earnings. The parent is still trading at 11 times. So there is still a big gap in terms of the valuations. But there were recent developments that said that Whirlpool the parent company intends to remain in the business, and said that India will remain a key part because they have entered into this 30-year brand and license agreement. There are also exclusive rights for the Whirlpool brand, which can be extended by 10 years. There is a transitional service agreement. There is an intellectual property assignment deed. So there are a lot of developments that have taken place. And even Kotak, in their note, they said that these terms at which the deal has taken place are reasonable. And this will ensure that there is this long-term continuity of the business, even if the parent continues to sell stake. So now, with this 11.5% stake sold, the promoter stake goes down to 40. But there is still this overhang because further supply is going to come over the next 6 months, that they plan on taking it down to 20%. So as of now, big underperformer. It'll be interesting to see who are the buyers in this transaction, but 11.5% lower on Whirlpool.
Oh yes, a big move there. Thank you so much for explaining that to us. But for now, we'll slip into a break. Up next, in an exclusive chat with Jonathan Garner from Morgan Stanley, we'll discuss market fundamentals, top sectoral bets, and a lot more. Stay tuned for that conversation.
Welcome back on to an exclusive conversation then. Jonathan Garner from Morgan Stanley, the Chief Asia and Emerging Market Equity Strategist, is joining in on the show. He has long argued that India stands out among emerging markets thanks to the strong earnings growth, a robust domestic investor base and an improving macroeconomic backdrop. And Jonathan, firstly, thank you so much for joining in, and what a fitting day to have you as well, because the Nifty and the Sensex both are at record highs today. Well, the first question, Jonathan, to you, you may be at record highs, but on a year-to-date basis, the Nifty is still up only 11%. Compare that to a lot of the other Asia-Pacific benchmarks or even the global benchmarks for that matter. The index is still an underperformer. But would you think that with the changing macros, with the policy announcements that have been made, the foreign investors which have long stayed away from a market like India will finally start to make a headway back into Indian markets, especially because of the fact that we have been underperformers?
Yeah, so India outperformed 4 straight years, 21, 22, 23, 24. So you're right, there's been somewhat of a give back in performance relative this year, though obviously the absolute returns have been there to some extent. As that's happened, the valuation relative has fallen substantially from about 1 standard deviation above long run average versus other emerging markets to about 1 standard deviation below. And I think the reason that relative derating happened is that relative earnings growth momentum slowed. So we had a marked pickup, particularly in North Asia, in markets like Korea and Taiwan, which are very rich in terms of semiconductors, tech, hardware plays on AI, and to some extent, some limited extent in China. Nominal GDP growth slowed in India, slowed probably more than we thought at the beginning of this year. But as we look forward, our economists are resolute, and certainly, as you just mentioned, the market's starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. I think on the other part of your question, I think often when I've been on your shows, you've asked about the foreign investor, the FIIs. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year.
Jonathan, hi, morning. What's the overarching view on Asia and emerging markets? You know, as we were discussing, emerging markets have come off an exceptionally strong year, particularly, say, a Kospi. That's up 66%. But the gains are concentrated. It's led by AI, semis, all the technology plays. So first, if you could tell us the big view on emerging markets going into 2026, what do you like, what do you not like, and why? And secondly, if the AI frenzy were to cool, not a bubble, pricking or bursting, but just some moderation in the optimism, then how does it affect the dynamics?
Thank you. That was another 2-part question. So I'll try my best to remember both parts of the questions. So I think the first part of it about emerging markets overall, I mean, this year we had a tailwind from a weak dollar, particularly in the first half, and that eases financial conditions in emerging markets. We had a lot of multipolar world dynamics, as we call it, the whole trade and tariff debate. And that certainly around April, May caused almost all markets to fall. When we actually... Sorry, I can hear some feedback. When we actually go through the second half of the year, it's right, that dispersion in performance was very significant. But going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small. And most of our other market calls are relatively contained. And we're just arguing that to have a robust approach, investors need to focus on stock picking and they need to be quite nimble. We're not done with macro volatility globally. We're living in very uncertain times. So it's not a sort of a bang the table opportunity on any individual larger market here for us. Thank you.
Jonathan, coming to India itself, before I get into macros and the sectors that you like, Maruti, that is one stock that is on your focus list, right? I wanted to understand what do you like about it right now? You called it a potential beneficiary of the GST reform and product pipeline strength. So what differentiates Maruti today versus 2 years back when we were talking about it suffering from the EV threat? What makes you so bullish on this one?
Yes, I mean, in terms of talking about individual stocks, I don't tend to do that on these because we have analysts that cover them. But what I would say is that it's in the right space in terms of GST, it's a consumer discretionary. So when you get these cyclical upswings in activity, it's the kind of thing that tends to work well. And obviously, it's a stock that our analysts cover and that we know well.
What about sectors in general? You have highlighted more upside in, say, financials, industrials, and consumer discretionary. What is the strongest bottom-up signals that you're getting from these three sectors that make you bullish here?
Obviously, we work closely with Rhythm Desa and the team on all of this. And yeah, we're overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan, you mentioned we are living in uncertain times and the fact that the macro instability is not over yet. But India as a economy in general has had relatively stable macros, right? Because the first quarter GDP print was fairly robust, almost close to 8%. Polls for the second quarter GDP are also indicating a similar sort of print at around 7.5%. Do you see this economic stability as an outlier compared to a lot of the other global markets? Or will this uncertainty around this trade tariff deal with the US be a bit of a dampener going into the second half?
Yeah, so actually the drop-off in inflation in India is important. I mentioned in answer to your earlier question, nominal GDP growth, which matters much more for corporate top line than real GDP growth. And I think that's where the negative surprise came in. I think effectively the decline in inflation is telling us that policy was too tight. And likewise, credit growth actually falling to low single digits. This is not what one should be expecting from an economy that is still developing very rapidly. So what we're anticipating, hopefully, is that with the policy easing measures that we've had, the nominal GDP growth environment will accelerate, as I said, from kind of mid-high single digits to mid-low teens in the course of next year, and that will reignite the corporate earnings profile, which softened relative to those markets we talked about earlier that had a very strong year, the AI, tech, semi-capex kind of markets. They, by the way, are likely to continue to post strong earnings growth next year, maybe decelerating somewhat, but they will still be growing earnings next year.
Jonathan, would request you to hold that thought. Would love to continue this conversation on the other side, but just need a mandatory short break.
Welcome back. You're still tuned into Trading Hour. We still have with us Jonathan Garner of Morgan Stanley. Jonathan, we have been talking about how global markets have been faring, a lot of macros as well. You are seeing some upside for Japan as well. But, there's some nervousness around yen carry trade. We are talking about yen strengthening, yields are jumping. Do you think this is something which could impact markets globally and Asia as well?
In a word, not really. In a sense, what we're seeing is a normalization of yields in Japan from very low levels, consequent upon the BOJ intervening less in the government bond markets, which is a very healthy development, and the fact that reflation is ongoing. If you look at Japanese 10-year yields, they're about 1.8%. That's still less than a half 10-year yields in the US, for example. And if you look at the underlying situation vis-a-vis the yen, it's actually strengthened this week after we got the details of the fiscal package. And the fiscal package itself is entirely financeable. Japan is amongst the G7 almost unique in running essentially a balanced fiscal position relative to GDP. It's less than 1% of GDP fiscal deficit. So it's more than able to expand its fiscal impetus here. So the yen is undervalued. We think it will strengthen back towards the mid-140s over the next few months. And I think that process began in the last few days.
Jonathan, at Morgan Stanley, how do you all assess the risk of an AI bubble?
Well, I think that's far too broad a term to use. Certainly in recent trading, we're seeing more performance relative activity at the stock level. When we model out the impact on particularly what we specialize in, which is things like the upstream exposures in markets like Japan, Taiwan, and Korea, as I said earlier, we're anticipating continued strong earnings growth, particularly in the memory names, which are very dominant in the Korean market, for example, at least for the next 12 to 18 months. So, within the Asia coverage that we do have some recommended stock exposures in our focus list to it. And overall, yes, it's a sector that's trading on very high valuations to its own history, but it is also exhibiting by far the highest ROE of any sector in our coverage right now. These major companies in Asia are generating 30% ROEs. So obviously they're the equipment suppliers to the infrastructure build out that's going on in the sector globally, and they're doing very well.
Back to India, overweight position, but you are recommending a tight risk position. Can you elaborate a little bit more on that and what you expect in 2026?
Yes, to be precise, we're 75 basis points overweight. At our maximum bullish, as I say, back during those 4 straight years of outperformance, we were at times 200 basis points overweight. So we moderated our bullishness on India this year. But then we have relatively tight risk positions in all markets currently. Ridham Desai and the team just set a Sensex target of 95,000, but again, with a wide bull-bear range around that. And that would certainly be consistent with India outperforming because it gives more upside than we have for overall MSCI emerging markets, where we have something like a 1,400 target.
And what's the bull-bear on the Sensex?
76,000 up to 107,000. So quite a wide range. And that's a feature of markets globally, and we talked at length in our year ahead report about that. If you think just about this year, from early April to now, the EM index is up around 35%, and the Topics index is up over 40% since early April. So we're not, in a sense, in normal times for the kind of performance that we can get, the performance volatility we can get.
Jonathan, come December, you would expect that activity would cool down and people would go on holidays. But the 2 major policy actions that are lined up, at least for our own markets, one being, of course, the RBI policy, and then, of course, the Fed decision on the 10th. Firstly, considering what you spoke about for the Indian economy, you mentioned that earlier policy rates were a little too tight. Do you expect further easing from the Reserve Bank going into this policy and in 2026? What are you pricing in for that? And the same for the Fed as well. Do you see a rate cut on the 10th? And what policy actions are you pricing in for 2026?
So if you start with the RBI, yes, we do expect a 25 basis point rate cut. After that, we'll see on hold probably for a while. In the case of the Fed, it's very balanced. The probabilities are moving around almost by the day. But in the most recent note from my colleague Michael Gapin, he counts, I think, 5 Fed governors as in the no rate cut camp, 4 as in the cutting camp, and 3 as agnostic or undecided, including the chairman of the Federal Reserve. So it's very delicately balanced for the Federal Reserve.
Hey, Jonathan, a pleasure speaking with you. Thank you so much for joining us today with your insights and the outlook on markets, EMs, and a lot more. That was Jonathan Garner of Morgan Stanley. With that, we'll slip into a break. But as we do that, here's a quick programming note. If you're looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital AMC's Ashish Somaiya and Prashant Khemka as they share their winning market themes and actionable investment strategies. Ask your questions live on 28th of November at 1:30 p.m. Become a member today on the CNBC TV18 app or log on to cnbctv18.com/access/plans.
Welcome back. Some tempering of the gains. The all-time high today was 26,310. The Nifty is at 26,240. So come off a bit. In the green though, but just by a smidge, up close to about 0.1%. Kotak Mahindra Bank continues to go strong, sees buying. But on the flip side, profit booking is visible in Bajaj Auto, so that slipped over 1%. Tech Mahindra has come in for some amount of pressure. L&T in the green, up 1%, but from the day's high, that too is seeing some tempering of the gains. Tata Steel, Geo Financial, Eternal, these are some stocks where you are seeing some tempering of the gains and moderation.
Okay, yes, so that's the market update for now. With that, we'll do one thing. We'll wrap on this edition of Trading Hour, but stay tuned. Halftime report is up next with all the market action.
Nifty scales to a new all-time high of over 26,300, while the Sensex powers past 86,000 as the S&P 500 index in the US resumes its AI rally. Morgan Stanley's emerging market strategist Jonathan Garner says India's valuation has turned attractive and he expects earnings growth to pick up next year.
In a likely resolution of a long-pending issue, Tata Power is likely to ink a supplementary power purchase agreement with the Gujarat government for its Mundra unit and restart its operations in December. This pact is likely to be used to ink power purchase agreements with other states as well.
Whirlpool of India sinks after its promoter sells nearly 11% equity after upsizing the offer from the initially indicated 7.5%. The sale results in the Indian arm ceasing to be a subsidiary as the parent stake slips to nearly 40%.
Axis Bank loan growth should continue to be better than the industry. MD and CEO Amitabh Chaudhary tells CNBC-TV18 that the bank is keen to merge Axis Max Insurance with Max Financial if rules change. He says he's watchful of MSME loans but doesn't see any cause for worry.
India winning the right to host the Commonwealth Games 2030 in Ahmedabad can spell nearly 15,000 crores in terms of development boom in the city area, going by past records. Infra, realty and hospitality players are likely to be the key beneficiaries. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Patra and with me is Manglam Malu. Well, what a day it is. We're sparkling for the markets. We're off the day's high, but nonetheless, we have touched that new all-time high for all of the indices, in fact, and the Nifty Bank yesterday's trade itself. So today we do have the Nifty, which is just about come off those highs. So at around 26,250 odd is currently where the Nifty is at. The mid-cap index is seeing profit booking at the top, so slipped into the red. But nonetheless, we do have the advanced decline ratio, which is on the positive side. So let's see whether that sustains. But we do have a couple of heavyweights which are at fresh 52-week highs in today's trading session. So that includes Reliance Industries, Axis Bank, Hero Moto, to name a few, which are at the top of the list in terms of fresh 52-week highs.
Take that point, Ekta. And in fact, we just ticked that mark of a record high for this year. And, it's good that it's come after 14 months, though the broader market has a lot of catching up to do when it comes to earnings growth, when it comes to revenue growth, when it comes to FII flows, and perhaps some certainty on international trade, and which is why this reflection of a record high is absent in the broader markets today. In the advanced decline ratio as well, like you pointed out, now we have almost an even Steven sort of red and green lines coming in out there. And eventually we will watch out for how the second half of trade also pans out, because we have the Sensex options expiry today that plays out. So we'll watch out for all those cues as we move along today's trading session. Kotak Mahindra Bank doing well, HUL fairly well bid, and a couple of these financials, Bajaj Finance, for instance, is at the top of the table when it comes to the gainers on the Nifty. But another stock which is doing well is Glenmark, surging on the back of receiving an establishment inspection report from the US FDA for its Mundra facility in the US. Ekta.
Well, definitely positive news which is coming for Glenmark. In fact, this particular Mundra facility has had a warning letter since June of 2023. So now they've received, it was inspected by the US FDA in June of 2025, where they were issued around 5 observations. And now they've received an establishment inspection report indicating a VAI, or a voluntary action indicated status, indicating that this particular facility is out of the woods and the company is going to start commercial production from Mundra again. The plant is expected to become more significant in terms of a contributor going forward, post these regulatory issues now being ironed out. So that's definitely a positive for Glenmark. In terms of the other key point about about Mundra, Glenmark has made investments of around $100 million in the facility. So it'll be interesting to see what kind of contribution it has going forward in terms of the drugs which will be filed from this plant. But remember that Glenmark has been facing regulatory issues. For example, the import alert on the Badi facility, warning letter to the Goa facility, as well as the Indore facility. So this definitely does come as a positive, and hope that the others would probably see some light of day.
All right, we will monitor the situation as we move forward. The US FTA and sector having a very fun relationship. Let's move on. Let's talk about Rail Lighting then, the very first management on the show. Joining us now, Randeep Narang, who's the MD and CEO of the company. Obviously, the discussion will be around the new order win that the company has made in Middle East, North Africa rather. They've said that they're on track for 22 to 25% growth in FY26 on the top line. Let's see where that goes. And strong execution order and timeline. Will that momentum continue or not? Thanks a lot, Mr. Narang, for joining in. A good order win that you've got around 550 crore rupees. But in light of your overall book of, nearly 9,500 crores as an order inflow for this year, it's not moving the needle much. It's just about 5.5% of your targeted order inflow. What I'm curious to know about is the first half of this year, you've done a 61% jump in your revenue and a near 50% jump in your EBITDA. You're still maintaining this 22 to 25% sort of growth target for the full year. Why is that? Do you expect some slowdown in the second half? Or do you believe that you will outpace the guidance that you've given already, given where you are at the first half of this year?
So hi, thank you for having me here. So the actual revenue depends on the state and the quality of the project management focus. So some projects are into engineering approval stage, some are into execution stage. However, we had set a guidance of 23 to 25%, but we are confident that we'll cross 25% plus. And that's the change we're seeing now. Post monsoons, our execution is getting better and picking up faster. So we are confident that we will beat this guidance of 25%, definitely by a percentage point or two.
Okay. Well, Mr. Narang, if you could just give us a sense in terms of what kind of cumulative order inflow are you expecting in the second half of the year and where exactly would it be from sector-wise?
Okay. So principally, we have around 15,000 odd crores of unexecuted order book and around 2,600 crores of L1. We have booked orders worth 3,700 crores this year so far, and a L1 of 2,000 odd crores, 2,600. So we are around 6,000 crores of fresh orders. We are looking at another 3,000 to 4,000 crores of new orders in the next 5 months. And we are on track for that. And we are bidding, pipeline is there. We're looking at bidding at least 30,000 crores of new orders in the next 4 to 5 months. So we're pretty much, our guidance stands stable and it is in line with what we promised.
All right. So you are on track for that 9,500 to 10,000 crore worth order inflows this year itself. What about the margins? You said it depends on the quality of the execution that you're doing, the quality of the client, etc. You have been guiding an 11.5 to 12% sort of margin range. First half of this year, you've managed to hold on to that 12% mark. Just the way you're going to outpace your guidance on revenue, will you do that on the margins as well?
I think 11.5 to 12% is the steady state we are looking at. Of course, there are some projects which are lower, some are higher. So we are looking at a balanced portfolio of margin management. We believe that 11.5 to 12 is a very stable margin profile, much better than our competitors. And we are therefore focusing to make sure that this happens. And we are pretty confident that we'll maintain it.
Okay. Well, Mr. Narang, you're confident in terms of your revenue as well as your margins. Just wanted to understand what you are doing when it comes to the international business, because you have 2 projects in Bangladesh, we do understand. Totally, I think it's around 30% of your total sales. Give us a sense in terms of the incremental order inflow, how much of it is coming from the international business, and are margins significantly different from, say, the domestic business?
So our current order book is around 60-40, 60 domestic and 40 international as we go along in terms of including the L1s. What we believe is that we will maintain that the India market is booming, the T&D industry is booming in India. And international also, there is a steady growth in Africa and other countries. So what we believe truly is that the margin profile has improved in India and international both. And therefore, we are in that good zone. You also know that we are well diversified backward. We are into towers, conductors, tower testing, making monopoles. So we have a very strong cost structure, execution skills, and diversified backward integration. So that helps us to maintain our margin profile.
Right. Speaking about the margin profile itself, I just wanted your thoughts on two things in particular. One, in the second quarter, there was a big jump in your subcontracting expenses. If you could tell us what explains that and where is that likely to settle as a percentage of revenue? And the second part is the brownfield expansion, which is coming on track in the third quarter. How much will that support your operational performance, given that it will be more backward integration in nature than revenue recognition?
Yeah, so that's a good question. I'll answer the second question first. So the backward integration on our brownfield projects is on track and will be in stream by December, that is next month. Our new factory, which is for towers, a greenfield project, will be operational. It's already started slowly moving into the production planning, production startup phase, and by January, that will also come into being. A conductor factory will happen by June, July of next year. So we're very much in line with our projections for supporting our revenue growth through our backward integration of factories of towers and conductors. Now, on your assets part, what you mentioned, we are particularly looking at higher execution happening. And as revenue is growing, there is also a certain amount of retention cost. There's a certain amount of inventory buildup, which is temporary, and which will ease off by March. So we already focused on that, and that will be closed and controlled by March.
Okay. All right, Mr. Narang, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Transrail Lighting. They have increased their guidance in terms of the revenue. They're expecting around 26 to 27% growth versus 22 to 25% that they anticipated earlier. And they are also expecting the margins to be stable at around 11.5%. We'll take a short break, but up next, we'll focus on the markets. Pankaj Tibriwala of Ikigai Asset Managers will join in to discuss the markets. Stay tuned.
CNBC.
Welcome back. The Nifty and the Sensex have hit a record high. The Nifty Bank as well, as has the mid-cap index. But are your portfolios feeling that or not? Let's get in our market master today. We do have with us Pankaj Tibrewal of Ikigai, founder and CIO at Ikigai Asset Manager. Pankaj, always a pleasure speaking with you. It's one of those, ticking the box sort of record highs where, yes, the markets hit that, but, portfolios aren't feeling the same. The street is worried about earnings returning. The street is worried about growth returning. The street is worried about FIIs returning, and it's worried a little about the uncertainty around trade as well. Amidst all of this, where do you think one should actually invest to make their portfolios feel like they're at a record high?
Good afternoon. I think your observation is absolutely right. So let's look at the data. So if you look at Nifty, which is almost at record highs, but if you look at the median constituent of Nifty, it's down by about 8%. Similarly, if you look at the small cap index, it's about 8% away from its all-time high. But the median constituent of small cap index is on an average down by 21%. And if you look at the BSE 500, the median constituent is down by about 18%. So very few handful stocks have taken the index higher, but the breadth of the market has been extremely narrow and poor. And we have seen this in the previous cycles also, that sometimes the index is driven by few names and few stocks, but the breadth has been extremely poor. Now, what can change this? I think finally stocks are slave of earnings and flows. And when we look at earnings this quarter, I think it was a little better than expected. After many quarters, we saw an upgrade cycle rather than a downgrade cycle on an aggregate basis. And let's, Mangalam, decode the entire earnings space. So 500 companies reported earnings growth of 15%. And if I bifurcate into BFSI and non-BFSI, BFSI is about 92 companies, earnings growth of 7%. And non-BFSI, which is bulk of 408 companies, is about 21% earnings growth. Now look at the market cap earnings growth. The large caps delivered 9%, mid caps delivered 31%, and small caps after a long time delivered 35%. But a caveat there is that both in mid and small caps, a decent portion is driven by oil and gas companies. For example, in mid cap, it was HPCL. In small caps, it was Cochin Refinery, maybe MRPL and stuff like that, where we need to adjust for that. But even after adjusting, the earnings growth was quite healthy for mid and small cap space. So I think once there is more consistency for a couple of quarters, I think you could see the breadth also reviving back. But obviously, as you rightly said, market all-time highs, but portfolio of individual investors not showing that.
Okay. But Pankaj, if you had to just narrow down on maybe a couple of pockets that you like within the market at this point, within the mid-cap space especially, what would they be?
So one space where we have been positive is the auto ancillary space. I think the auto cycle after a long time seems to be reviving back. The ground feedback continues to be positive. Even after the festive season, the momentum on four-wheeler, two-wheeler, and even commercial vehicles have started to be quite positive. That's the feedback we are getting from the ground. And after a long time, auto ancillary seems to be in a sweet spot in the mid and small cap space, and especially the companies which are also pivoting themselves away from auto to non-auto. And there are many companies where the next 3-year outlook on non-auto, which is defense, aerospace, semiconductors, and maybe industrials, is shaping up to be very good because a lot of global suppliers are looking for manufacturing on precision engineering, and many of them fit the bill. So that's a space which we like. The second is the NBFC and the banking space. I think the NIM compression and the worst asset quality is behind us, and that's clearly being shown in large cap, mid cap banks right now. Earnings growth from here on should be quite strong for the banking space overall. And if you look at the lending, which is non-NBFC as well. But in non-NBFC, we have seen a sharp run-up already happen. So we need to be careful on valuations. But that's a space which can show you strong earnings growth. The third space where it's a contrarian call, I think, is metals and mining. I think you have seen a very strong quarter last quarter. But going forward also, I think that space globally is looking to be quite good. And you have seen a very sharp jump in copper, followed by zinc and other metals. I think that should reflect in the overall stock prices as you move ahead over the next few quarters.
All right,
So
auto ancillaries. Got that. Auto ancillaries, you like NBFCs, banks rather, and also the metal space, which is a contra call. So we'll, take these on board and wish that earnings do actually come back with a vengeance in the second half of this year, and then perhaps get you more on the consumption space and maybe a word on the IPO space as well, as more IPOs. Nearly 30,000 crore worth paper is likely to be supplied in December. With that, we'll take a short break, and as we do that, a quick programming note. Thank you, Pankaj, for joining in. If you're looking for big bets and market themes for 2026 as we move towards the start of the new year, CNBC-TV18 Access gives you direct access, as the name suggests, to White Oak Capital AMC's Ashish Somaya and Prashant Kemkar as they share their winning market themes and actionable investment strategies. You can ask your questions live on 28th of November, that's tomorrow, at 1:30 p.m. Become a member today on the CNBC TV18 app or log on to cnbctv18.com/access/plans. Watching us here on Halftime Report on CNBC-TV18 from the FNO desk, I'm just looking at a couple of trends at midday for the market. Yes, we hit a record high on the Nifty, the Sensex, and even the Nifty Bank in today's trading session. The mid-cap index was yesterday, though we're off those highs right now. From today's high, we've given up around 70-80 points on the frontline index, which is usually par for the course. The only thing that we have to watch out for now is some profit taking, which is taking place in the broader end of the market, which is visible in one, the mid-cap index not doing too well, currently lower by almost 90 points. And the advanced decline also comes up for you with a line which was far outnumbering the red one. The green line has now come closer. In fact, the red line has moved above the green line. So 1450 stocks which are declining for about 1400 stocks which are advancing. So the second half becomes extremely crucial. And the other thing is that the top contributors on the Nifty are just on the Nifty Bank. In fact, 3 of them belong to the Nifty Bank itself. So the market has to really broaden out, and Reliance has actually been the top dragger on the way down. Now, as we look at the market as it progresses, the important levels to watch out for, the 26,300 call writers are fairly active at 83 rupees, telling you that the market may face some sort of congestion or supply at around 26,350 to 26,400 thereabouts. But where equal vociferous writing is seen in the 26,300 put and the 26,200 put. So the 26,300 put comes up for you, premium of close to around 150 rupees, and the premium is actually down, which tells you that there has been a lot of writing which has taken place out there. So around 26,150, 26,200, there is support, and the 26,200 put as well for a premium of 100 rupees, telling you that there is support around 26,100. So 26,100 to 26,150 is the support, whereas on the way up, 26,350 to 26,400 is the supply. That's basically the sum and substance of the options data. Just a couple of factors we need to watch out for. The Nifty put call ratio from levels of 1.41 yesterday, which was at an overheated zone, came down to 1.38 earlier and now to 1.25. Around 1.2 is where the overheated zone ends. So we'll have to watch out for more moderation out there. And the second part is the Sensex weekly options expiry today as well. So could we see some impact of that on the Nifty in the last hour or not is something that we will be tracking. One stock I'm looking at, Samman Capital, was in FNO ban all of the last series. Does it get into ban again on day 1, day 2 of the December series or not is something we'll be tracking.
Okay, all right, Manglam. Thanks very much for that. So that's on the entire FNO space at this point in time. We'll take a short break, but up next, Manisha Gupta will be with us. She has with her a guest, Arun Raste, joining in to discuss the commodity space. Stay tuned.
Welcome back. Joining us on the show now is Arun Raste, he's MD and CEO at NCDEX. Mr. Raste, hi, thank you so much for joining in, and congratulations are in order because 770 crores is what you've raised as a preferential share issue, and you also are going on for the equity and derivative market there. What we do also understand is that it is the cash segment that you would be starting first on. Why do not you update our viewers with all of that?
Thank you, Manisha. Good noon. So, as you mentioned, we did raise about 770 odd crores from both domestic and international investors. We did a fresh round of equity, about 40 odd %. We will primarily use it for the equity and equity derivative segment. We did get SEBI approval a few months ago for starting our equity and equity derivative segment. So, in terms of the process, what we will do is we will start the equities first, and then we'll go for equities. But before that, there is one more addition, which probably you haven't heard about. We also intend to start a mutual fund platform, which we probably the first to go online, because that is not linked to the trading and surveillance system. So we can have a separate platform, and through which we can do the mutual fund distribution. So that will be our first offering. And that should be early in the next financial year, very early, possibly the beginning of the financial year itself, that we'll start it. And then later, as our systems and things is in place, we will go for equity. And then after that, we'll go for equity derivatives. So in terms of, if you're looking at calendar, probably next calendar year and latest by next financial year, all the three should be up and running.
Mr. Raste, the other thing that we also have been hearing about is you acquiring a 20% stake in the Sri Lanka commodity and financial derivative markets. What is that about?
No, so this is all subject to regulations, both in Sri Lanka and India. What we have agreed with the Colombo Stock Exchanges, if they get approval to set up equivalent of a NCDEX in Sri Lanka, we will be picking up stake in that. But that will be subject to regulatory authorities in Sri Lanka, SEBI approvals in India, as also DA or MEA as approvals required. Subject to approvals, we will be taking that. So what we have agreed with Colombo Stock Exchanges, they don't have derivatives at the moment in Sri Lanka, either financial nor commodity. So this new exchange, which might come up, will be dealing with both commodities as well as financial derivatives. And what we have agreed is we will be operating that for some time. We will be providing expertise, we will be providing them manpower in the initial stage, train their people, and also become stakes. So put together for our efforts and whatever we are putting money we are putting in, we will get about 20% in this new exchange. And that will be possibly subject to regulatory approvals. It should start sometime next year or a year after that.
Mr. Raste, just taking a step back, and as you mentioned that the first thing that will go live is your launch of mutual fund distribution platform. We do also understand is that it will function independently when it comes to the exchange's main trading and settlement system. So would you say the time that you're talking about, the timeline that you're talking about, is the timeline that you would require to set up operations and technology, etc.?
Exactly. So if you're setting up an exchange or if you're setting up a platform, there are three requirements. One is the technology part of it, one is the human beings, the people who will run it, and third is the market participants. So we are working on all the three fronts. We intend to hire something like say 100 to 150 people over the next 12 months to take care of all the three functions. As I speak, my team is at the moment speaking to somebody who is a technology provider for the mutual fund platform technology. And as far as the systems for the equity part is concerned, we have already floated the RFP, and hopefully we should close it by end of next month.
Mr. Raste, what are the plans looking like when it comes to equity and derivatives therein? Because you have BSE and NSE standing up as tall competition for you.
See, competition is the game, but I will just put some numbers in front of you. So I'll start with mutual funds. If you're looking at mutual funds, if you're looking at say 15 years ago, what was the number of people who were investing in mutual funds? It was just about 50 odd lakhs. Today it is 5 crore unique accounts. Right? So compounded growth or last 12 or 13 years, we have grown almost 20 times. And this growth will continue. So I was looking at some of the developed markets, maybe US or UK. 50% of the population is invested either through direct equities or mutual funds in those markets. If you look at that, compare that with India, it is just about 15%, 14 odd %. So the scope is humongous, 3 times bigger than where we are right now. If you look at equities, just last 5 years, if you look at data, year on year, every year you're adding about 2 crore people. Now, even with this, if you look at mutual fund growth, see the biggest growth now coming into the mutual fund space is not from the top 30 cities. It is coming from cities. And that is the place where NCDX has big roots. Thanks to our agri-commodity background, we are present in more places than the existing players. So definitely the population in rural areas which has not derived benefit of the growth in capital market, possibly we will give them the opportunity. Look at it from this perspective. I get a woman who is investing about 250 rupees in SIP every month, who is a customer of ours. We have about 12 lakh customers, farmers associated with us. Just 250 rupees a month if they start investing in SIP. My mutual fund portfolio will just fly from day one, right? So we will be looking at new markets, newer channels. Definitely there is space for 2 or 3 exchanges more in a country like India. Because if you look at a country like US, there are some 12 or 13 exchanges. China has 3 or 4 major exchanges. India has just 2. So there is enough space for more exchanges to come in. I don't see the big players will be affected by our entry because our target group is different and the pie is growing. This pie is growing exponentially. So there is space for everybody. We'll find our niche.
Oh, yes. Apart from BSE and NSE, now NCDX as well coming in with equity and derivatives foray. And of course, the mutual fund platform could start in much, much earlier.
Okay. All right, Manisha. Thanks very much for taking us through that conversation. We need to take a short break. But up next, stay tuned for the conversation that we have lined up. SMS Pharma, that stock was up around 15% in yesterday's trading session. We'll be talking to the management on the other side. Stay tuned. Welcome back. Well, giving up a little bit of its gains for the Nifty. So 26,247 is currently where it's at. We're seeing profit booking coming into specific stocks such as Eicher Motors, which is at the low point of the day, down around 2.6%. Remember, it's been an outperformer this year, but seeing some amount of profits being taken off. But nonetheless, let's talk about one particular company, which really was one of the broader market gainers yesterday. SMS Pharma is the next management on the show. The reason the stock is in focus is because the FDA has approved a reformulated version of the acid reflux, very popular acid reflux drug, ranitidine, or popularly branded by some companies as Rantac as well, from its associate company VKT Pharma. So to talk more about this, we have with us Vamsi Krishna Potturi, who is the Executive Director of SMS Pharma, joining in. Vamsi, hi. Thank you very much for taking the time out. So you've received approval to manufacture the API of the reformulated ranitidine. Is that correct?
No, actually, we've received the approval to manufacture the finished dosage of the product, which is the tablets. And along with that, the API, which goes into the formulation. Yeah.
So you'll be manufacturing the API as well as the finished dosage.
That's right.
All right. Just give us a sense in terms of how exactly this drug is reformulated, just to, apprise our viewers. This particular drug was withdrawn from the US markets because of fears of it having a carcinogen NDMA present in it. So that's the reason why it was, it stopped being sold in the US markets, but now it's reintroduced. So just give us a sense in terms of what the difference is, and do you expect as much of a pickup in the US markets as there was earlier?
So coming back to so FDA has banned this product 5 years back, citing the reasons of NDMA for carcinogenic. But now we've liaised with the agency, we've complied with all their strict regulations, and now we've delivered the product that is very good in terms of controlling this NDMA throughout the shelf life of the product. And now the agency has given approval for us to relaunch the product. It's been a 6-year wait, and finally, after undergoing severe at different conditions, we've reformulated the product at different extreme conditions. We've tested the product, and when found okay, when we submitted all this data to the agency, I think finally we've received an approval.
So what does this mean?
Coming back to your point with respect to the market share, see, before the product was taken off, it was approximately around 400 million tablets was per annum was the market share on this product. I mean, it was a 5-year lag because there's no other ranitidine in the market, right from the innovator to no generic players in the market since last 5 years. So definitely this market share has moved on to other products, but yes, it will definitely come back, but we have to wait and watch. It's a slow growth, but we have to try and bring some market share back.
So from an SMS Pharma standpoint, that's the question, right? How much do you expect this to contribute to your revenues once you start supplying it, and what is the likely scale up going to be from here on?
Correct. So with respect, we will be starting slow, obviously, because it takes time to build the brand and time to get the trust of the customers back. Again, we would like to re-emphasize that the product that we've recreated, the reformulated ranitidine, is very safe, and it's much lower than the guidelines requested for the NDMA at various stress conditions as well. So this is a very strong product, and it'll take time for the customers to, get over this fact, but we know they'll come to terms with this.
Okay. What's the competition pipeline like for ranitidine in the US markets in the foreseeable future? I know you currently have the strongest market, you're the only player, but what's the pipeline like? Who are the other filers?
So right now, we are the only vertical integrated player on this product where we do the API and the formulation. So definitely, maybe it'll easily take our competitors at least 2 to 3 years, because they have to go through the same rigorous process that we went through of redeveloping this product. But yeah, if anyone enters, it'll probably be 2 or 3 players is my guess.
Okay, what I'm trying to understand, Vamsi, is basically whether you're expecting that kind of market to come back for ranitidine. Because if you see globally as well, because of the issues that had taken place 5 years ago, though the other countries had not, withdrawn the product, there was a shift to other acid reflux drugs simply because of the fear of NDMA in ranitidine. So do you think that has ranitidine in other markets actually declined over the years, and hence that gives you an assessment in terms of what it would be like in the US?
No, I think it's just about the fear of, having this carcinogenic impurity. So now a strong regulatory agency like the FDA endorsing this product, I think will definitely give a lot of relief to few other countries where this product, we will definitely see ranitidine picking up in the next few months, actually, as we speak. In various other countries. And again, as you rightly said, it's very difficult to get back that entire market that we lost, but it's a slow process. It's a slow process that, we can start, and probably we'll get there someday, but it's definitely a slow process.
Let's talk beyond ranitidine as well. You have given us a growth target of 20% in FY26 with 20% margins as well. Halfway mark, you are pretty much on track to achieve that. Just a word on ibuprofen. You are planning to scale it up from what, 450 tons per month to about 1,000. How much would that mean in terms of incremental revenue for you, and by when?
So when we hit 1,000 tons per month, so that will probably contribute close to 600-650 crores of top line revenue for SMS.
And
just on ibuprofen, isn't it already quite a widely penetrated market?
Yes, it is a widely penetrated market. We are the latest entrants on this product, but we were able to get good market share across the world. In US, we have almost 60% market share. In Europe, we have big customers lined up. So we are getting market share month by month. We are going incrementally month by month.
All right, we take that point. Thank you so much for joining in. And just missed this point on by when will it turn to 1,000 per month?
So it will probably from April. We will complete the project by April. So yes, from April on, it will be 1,000 tons per month.
Vamsi, always a pleasure speaking with you. With that, we'll take a short break, come back, get you more of the markets and a lot of stock-specific action. The markets actually picked pace once again. The mid-cap index back in the green. Stay with us. Welcome back. There's been some recovery from the lows. The mid-cap index just about moved into the green, now flitting beneath the flat line. A couple of these stocks belonging to the auto space in particular doing extremely well. Ashok Leyland was fairly well bid all of yesterday and now continues its up move up around 9% for this week with a 6% gain coming in right now itself, a big surge. And looking at Ashok Leyland, Escorts Kubota as well, which is in a similar segment, doing a catch-up. So that stock is up around 2.5%, closer to 3% as we speak. And Pankaj Tibriwala just spoke about some of these auto ancillaries doing well. So Samvardhana Motherson, for instance, has moved higher too. What we'll do is take your leave on this edition of Halftime Report on that note and take the market action forward with Business Lunch after this short break. Thank you so much for watching.
The Nifty scales a new record high of 26,310, while the Sensex powers past 86,000 as the S&P 500 in the index in the US resumes its AI rally. Morgan Stanley's emerging market strategist Jonathan Garner says India's valuations have turned attractive and he expects earnings growth to pick up next year. In a likely resolution of a long-pending issue, Tata Power is likely to ink a supplementary power purchase agreement with the Gujarat government for its Mundra unit and restart operations in December. This pact is likely to be used to ink power purchase agreements with other states as well. Shares of Whirlpool of India sink after its promoter sells nearly 11% equity after upsizing the offer from the initially indicated 7.5%. The sale results in the Indian arm ceasing to be a subsidiary as the parent stake slips to near 40%. Experts tell CNBC-TV18 that the government's incentive scheme for rare earth magnets is attracting high interest from foreign and domestic industry players. They, however, point out that this will entail importing some rare earths, even as efforts to explore local sources continue. And India winning the right to host the Commonwealth Games 2030 in Ahmedabad can spell a near 15,000 crore rupee development boom in the city area. Going by past records, infra, realty and hospitality players are likely to be the key beneficiary. The long-awaited day for the Bulls finally arrived today. You're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Patakia. And after the Nifty and the Sensex both hitting record highs earlier in the day, there has been a slight cool-off, which is only par for the course after nearly 300-point up move yesterday, after a over 100-point up move in today's session as well. So some bit of profit booking coming in at higher levels, of course, today being the Sensex monthly expiry as well. So that needs to be accounted for as well. So the bulls still ensuring that the Nifty remains in the green despite coming off the highs of the day. 26,310 is the record high. The Nifty Bank at one point had almost touched levels of 60,000, and that index too currently still around about that 59,800 mark. That is holding on to gains of around 300 points in today's session as well. So 59,870 the intraday high for the Nifty Bank, still trading around those record high levels is the banking index. But the pain though lies in the broader markets. The broader market breadth continued to struggle in yesterday's for the last few sessions, and today is no different. The mid cap index has already moved into the red. The small cap index too is also off the highs of the day. So, and Nimesh also mentioned yesterday during his D-Street chatter that the participation in the broader markets was negligible, even though the indices were doing fairly well for themselves, and it was only a relief rally that was seen after oversold levels on those stocks. So the advanced decline currently at even Stevens as of now, but the declines have just about managed to overtake the advances. So that is the picture of the market currently, but it has taken 14 months for getting to those record high levels for the Nifty. Did happen in today's session, and you take a look at the bigger talking point. Of course, from the lows in April, the index is up 19%. That's the bigger talking point. When it comes to the contributors, of course, BEL, Eicher Motors, some of the top movers, Bajaj Finance, SBI, then gains of anywhere between 25 to around about 40-odd%. Now, look at the underperformers. Trent, a street darling at one point of time, is halved. Bajaj Auto made a record high, or the same day that the Nifty made its record high, is down 30%. TCS is down 25%. NTPC is down 25%. So that is the picture among the losers on the index from September of last year. You take a look at the movers from April of this year from the lows, same names of BEL and Eicher Motors, but M&M, the post GST rally has been very substantial. Eternal has done well, Geo Financial has done well, but when it comes to the broader markets, that is the problem, and that has been the problem for the last few months. The mid-cap index from September of last year is up only 1%. The small-cap index is down 7%. You take a look at the losers in the mid-cap index. Of course, there have been gainers, but take a look at the losers. IndusInd Bank no longer in the Nifty, still down 40%. Colgate down 40%. Look at Tata Tech, recent listing, a much hyped IPO, down 40%. RVNL and IREDA, the two high-flying PSUs for all through 2023 and a better part of 2024, down 40%. The small-cap losers are painting an even worse picture. Tejas Networks, another Tata Group name, down 60%. Ola Electric down 60%. Whirlpool add another 11% to this 46% fall today. Brainbees is down 50%. Jindal Saw is down 55%. So this is only the top 5 names. The other list of losers will be even longer if you take a look at the smaller cap names. But today, the Nifty hitting record highs. The pain point, though, has continued to be the broader markets, and it has taken 14 months for the Nifty to hit to get back to levels to where it was in September of last year. And CNBC TV18 got the first global reaction from Jonathan Garner of Morgan Stanley. He told us exclusively that he remains overweight on India and doesn't believe that foreign investors are leaving the Indian markets. Listen.
Market starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year. Going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small, and most of our other market calls are relatively contained. Overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan Garner of Morgan Stanley, the first global exclusive reaction to CNBC TV18 as the Sensex and the Nifty hit record highs in today's session. Now, an over decade-long overhang is set to be lifted for Tata Power as one of India's largest ultra-mega power projects is set to resume operations after months of inactivity and after over a decade of uncertainty as well. Vivek is here with more on this. Vivek.
Well, that's right. So what we are picking up from our sources, Tata Power's UMPP at Mundra, which is the ultra mega power plant, having 5 units of 800 megawatt each, almost 4,000 megawatt of power capacity, which currently is idle given the fact that Section 11 has not been extended since July this year, and also uncertainty over the supplementary as well as the full-time PPAs that the company was looking at. But what we are understanding from our sources is that all decks have been cleared, and plant is all set to resume operations. And this time around, we understand that Tata Power has got an in-principle approval from the Gujarat state government for going ahead and signing a supplementary PPA. This, remember, is a material development as far as Tata Power is concerned. Now, when we are talking about the other states, remember, Tata Power Mundra has 5 other states, or a total of 5 states where they have signed a PPA with. We understand that 4 states will actually go ahead and use Mundra as a precedent to go ahead and sign a PPA with Tata Power. Now, we reached out to Tata Power for this particular development. They are yet to respond to our queries. But what we have to understand is that the importance of Mundra cannot be underestimated. Remember, a total of almost 1,100 crore of PAT from Mundra as well as Indonesia is something that it contributed to a total PAT of around 6,000 crore in FY25. And it actually reported a loss in Q2 on the back of the fact that Mundra operations were stalled. So it's a material development. Under recovery, fixed cost under recovery will go away and will also contribute meaningfully to EBITDA.
Vivek, thank you for that update there. Now, in a big push to rare earth magnet manufacturing, the centre has announced a nearly 7,300 crore rupee outlay for rare earth magnet manufacturing. Now, this scheme aims to make India self-reliant and a key planner in global rare earths. The scheme also aims to strengthen India's automotive, defence and aerospace sectors. Currently, India imports all of its rare earth magnets, but Union Minister Ashwini Vaishnav said that India must become self-reliant in rare earth magnets in the next 4 to 5 years. Listen in to what two big mining giants in India, IREL and IMFA, had to say about this opportunity.
India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having. But we require dysprosium and terbium, which are required for the this coercivity or to have this high remanence, which allows the retain high magnetization and the coercivity in the magnet. Right now, this dysprosium and terbium has to be imported. And on top of that, there are technology available like Protorial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
We, of course, have decades of experience in mining, in processing of ores, etc. Now, I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain, as it is at the moment, going through the details and looking at what is there on offer. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
Take a short break, but just before we do that, here's a quick programming note. If you are looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital AMC's Ashish Somaya and Prashant Khemka as they share their winning market themes and actionable investment strategies. Ask your questions live on the 28th of November at 1:30 p.m. Become a member today on the CNBC-TV18 app or log on to cnbctv18.com/access/plans. Welcome back. Now, the city of Ahmedabad has won the bid to host the Commonwealth Games in 2030. And Sonal is here to tell us this massive infra opportunity that lies ahead.
Well, yes, the announcement that Ahmedabad will host the 2030 Commonwealth Games could open up one of the biggest real estate and infrastructure opportunity cycles the city has ever seen. Large sporting events don't just bring athletes and spectators, right? They trigger a wave of construction, urban development, hotel expansion, and long-term demand for residential, retail, and commercial real estate as well. So let's break down where the biggest opportunities lie and which kinds of companies stand to benefit the most. But first up, let's just look at the costs that have been incurred in previous Commonwealth Games. The numbers are for you on the screen. Manchester, Melbourne, Glasgow, Gold Coast, Birmingham, somewhere between 10,000 to 15,000 crore rupees is the opportunity which is available. Now, sectoral impact. First, real estate developers. The biggest near-term opportunity sits with developers holding land around key games avenues, the athlete village and transport corridors connecting them to the airport and the city centre. Hosting the games means new world-class sports facilities, upgraded highways, metro links and also an expanded airport. All of this sharply improves connectivity and land value and adjoining micro markets. Developers with large integrated townships, mixed-use developments or upcoming residential projects in and around Ahmedabad and Gandhinagar could see accelerated demand as investors and home buyers they look to participate in the growth story. Some of the big real estate players in Ahmedabad include Adani Realty, Urban Smart Spaces, Godrej Properties, to name a few. There could be some opportunity in the airport link development as well because of improved international connectivity plus terminal expansions increase inbound travel, hotel demand, premium office or retail near airport as well. Of course, Adani airports will be in focus because of that. Construction and engineering contractors, they'll also be in focus due to venue construction, road, metro, airport works and hospitality projects. So the likes of L&T, HCC, GMR and any other regional large contractors and players will be in focus. These firms historically won major game contracts in Delhi and elsewhere as well. Hospitality industry, of course, will be in focus. There'll be surge in visitor nights for the games and longer-term business travel. It will lift revenue per room for these companies, per available room, that is. There is a new ITC hotel there as well. So stocks like ITC hotels, Indian hotels, etc. will be in focus on the back of this. But of course, the key to track now will be formal project announcements and tender awards from Gujarat or state government and the organizing committee as well. But this definitely could be a big boost to a lot of industries.
The big infrastructure boost lies ahead in Ahmedabad. Sonal, thank you for that update there. Moving on, a big launch from Mahindra's Born EV SUV platform. The company introduced the XEV 9S, a 7-seater SUV aimed at the mass market, which is priced at 19.95 lakh rupees. The car was unveiled at Mahindra's Scream Electric event, where it is celebrating 1 year of its Born EV platform. Let's now listen in to Rajesh Jejurikar, the ED and CEO of the auto and farm equipment sector, who spoke to Shireen Bhan at the M&M Town Hall about the company's EV plans.
We have believed, Shireen, that the EV portfolio has a lot of learning, and we have to calibrate the organization learning as you're building a category. And the last 6 months has been, and which is the reason why, even though we were ready with some other products, we decided to phase it out so that we build learning in the channel, the back end of the organization, quality, software, all of that. And I think we are at a stage where we're ready to ramp up, and hopefully Jan onwards we should see the numbers go up. And that's how we had planned it, which is why when we announced the first two, we had said the initial capacity we are operationalizing is about 4,000 to 5,000 a month.
Take a short break here on Business Lunch. More news and updates follow on the other side. Boy, the markets have taken a bit of a nosedive in the last few minutes now. 150 points off the highs of the day. The index, the Nifty is now down 50 points. Now well below the 26,200 mark and heading towards 26,100 now on the downside. The Sensex has also corrected 500 points. Both of them hit record highs earlier in the day. But the pain, as we mentioned earlier as well, is in the broader markets. The mid-cap index now is down 350 points from the highs of the day. The small-cap index is now down 0.7%, already down 180 points from the day's high, and leading the move downwards are the banking names. The Nifty Bank has seen this sharp one-way move down from the intraday highs, and we had earlier started off the show when the index was near levels of 59,800, and now the index is down almost 300 points from those levels within a matter of minutes. And of course, we need to account for the fact that this is the Sensex monthly expiry that we are talking about. But the Nifty now below the mark of 26,150, almost 160 points off the highs of the day. And leading the index down are names like Reliance Industries, that's down 0.7%. Bharti Airtel is down 1%. That's the top contributor to the Nifty downside. TCS has taken a dive as well on the downside, now 1% lower on TCS. That stock too seeing a significant correction from the highs of the day. SBI, among the PSU banks, the PSU bank index is the worst performing index so far in the trading session. Was down earlier in the day, continues to remain lower as well. The recovery in SBI has been sold into, as is the case in the PSU bank index as well, and is reflecting there. And Maruti is the other one that is leading the index down as well. 1.5% lower now on Maruti, move down in the last few minutes as well. But Whirlpool continues to remain at the lowest point of the day, 11% lower, as you can see at the bottom of your screens. But the picture right now, the Nifty down 60 points. It's a 160 point correction from the highs of the day after hitting record highs. Some profit booking setting in on the monthly expiry of the Sensex contracts. Take your leave on this edition of Business Lunch from me and the team. Thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Well, after touching record highs, there's a massive profit booking that's taking place. We are off around 160 points from the highs of the day on the Nifty. Midcaps in the red. Banks too have fallen. The PSU banking index putting some pressure. So a lot to talk about. But yes, we have seen all the rally being sold into, and that is key to track.
That's right. Good afternoon, and extreme volatility, especially as far as the markets are concerned. What we're actually seeing is the advance decline ratio breadth is something that has deteriorated quite rapidly as far as the second half is concerned. But we have a lot lined up on the show, so let's start off with the top headlines. Benchmark indices off morning highs after hitting fresh record levels. Energy, realty, and PSU banks trade lower, while financials surge. Mid-caps relatively underperform.
Whirlpool is under pressure after a large block deal as over 11% equity worth over 1,600 crore rupees changes hands. Sources tell us that the promoter entity is the likely seller in the block today.
CarTrade Tech shares slip after around 5% in trade after the company announces that the proposed acquisition of its rival CarDeco will not materialize as both sides agree to mutually call off talks.
GMDC shares surge in trade. Another 8% rally today after 8% yesterday as the centre approves a 7,280 crore rupee incentive program for rare earth magnets, intensifying the country's push to build domestic capacity and reduce dependence on China. Okay, those are the top headlines. The mid-caps, the advance decline ratio when we started the trading day was in favor of advances. Now it has turned for the worse. And this is something that we were highlighting as well, that the market breadth, that has been under pressure for quite some time now. And those lines have converged. In fact, now there are more declines versus advances in trade. The small cap index too is lower in trade today. And across the board, there is some profit booking which is on the cards. But you know, a lot of other stocks which are on our radar. This is our special segment, Mid-Cap Movers. We have Ria to take us to the mid-caps that are moving around in trade. Ria.
Well, yes, starting off with the gainers first, we have GMDC up 8% today after the Union Cabinet approved a rupees 7,280 crore incentive program for rare earth magnets. The stock is also up roughly 22% in the last 3 sessions as well. Tejas Networks also up around 6% today. Even Ashok Leyland up around 6% today to hit a 52-week high today. This is also on the proposed merger of the finance arm of the company with NDL Ventures. Gillette also seeing gains of roughly 4%. And Dr. Agarwal's Health also up roughly 3 to 4% today and also up 8% in the last 5 sessions. On the losing side today, we have Whirlpool down more than 10% today after its promoter has sold nearly 11% stake in the company and they have upsized their initial offer from the initially indicated 7.5%. We also have Natco Pharma down nearly 5% today. Keynes also down roughly around 4% today and down 17% in the last 1 month as well. Even Motilal Financial Services seeing a cut of roughly 4% today and down 12% in the last 1 month. And at the end, we also have GE Vernova down roughly 3% today.
Well, thank you so much, Ria, for joining in and giving us all of the stocks in the broader end of the markets that are making all the moves. But it's a good time to welcome independent research analyst Brijesh Bhatia for a quick technical check on the market. Good afternoon, Brijesh. Very tough, and we know it's a tricky question to ask you. But do you feel Nifty maybe has made a top-out pattern? Do you see further selling pressure, or do you feel we can make a recovery?
I don't think there is a topping pattern as of now because yes, the large caps have been few pocket has been roaring onto the market. We saw with IT, SBI, Reliance, L&T. I still believe 26,000 has been convincingly held. On expiry day, we saw 25,800 being strongly held. So till 25,800 is not taken out on the Nifty, I still believe there is a huge room towards 26,500, 26,600 levels onto the upside. Any dip towards 26,049 to 26,083 on the spot is a good level to look for a long opportunity.
Any individual names that you have on your radar, Brijesh?
On the mid-cap side, I think those stocks which are continuously outperforming in the current November series have seen a strong holding as of now also. Cummins India is the one which I think is a strong one we should look at. Two things are happening. First, though it was a long consolidation after a strong rally, bullish head and shoulder onto the hourly chart, indicating there is a strong momentum on the stock. Buy at around 44.20, 44.30. Target could be around 46.50 onto the upside and keeping a stop loss of 4350 onto the downside. And my second pick will be M&M Financial Services. So if you look at the whole structure, we saw a strong rally between 2020 to 2023. Stock went into a strong rectangle structure. And importantly, if you look at the Fibonacci time cycle, it gave breakout right at around 127 week, which is a strong sign of a bullish trend. And now the trend resumption is that we have seen at 328 to 350, 360 level has been strongly held in current market as well. When markets see a profit booking, M&M is holding strong. So buy at around 358.59, keep a stop loss of 345, and look at around 390, 395 onto the upside.
Well, thank you so much, Brijesh, for joining us, giving us a view on the markets as well as your individual trading calls. Well, we now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Mid-Cap Radar. Well, the market breadth continues to deteriorate. After hitting lifetime highs, we've cooled off significantly. The Nifty now near the day's lowest point. What's actually dragging the market lower, especially in the last hour of the session? It's some of the large banking names, heavyweights as far as the bank Nifty are concerned. Have a look at SBI, that particular stock near the day's lowest point. Even a name like Axis Bank is dragging the bank Nifty and along with it the Nifty lower as well. And a sector that did very well in the session yesterday was the Nifty metal. But today, if you look at most of the constituents over there, a name like Welspun Corp, a name like JSPL, SAIL, all of these stocks under a bit of pressure as well. Another stock from the cement pack, that is Ultratech Cement, that particular stock too has now gone ahead, hit the day's lowest point. But like we promised, it's now time to speak to an important corporate guest. Rajesh Sharma, the MD of Capri Global, joins us now. Mr. Sharma, thank you so much for joining us. Q2 was quite strong for you. In fact, it was so good that you managed to go ahead and increase your AUM guidance for FY26, implying an 18% growth in the second quarter. Which segment are you currently seeing the growth coming from?
Yes, thank you. So growth is coming from all the segment, but more of the gold loan because you added more branches. If you see, last quarter we added about 86 branches, and gold has become almost about 40% of the overall AUM. Now, gold specific branches about 850. So with those branches, I think gold is growing, and further there is a cultural shift. Borrowing against from the gold is now getting more popularized and more acceptable, where in the semi-urban rural area, people don't hesitate to meet their short-term requirement from the gold. If you talk about MSME segment, that has also reasonably growing. Affordable housing, because of the push of the Pradhan Mantri Awas Yojana again, the demand we are seeing clearly, that segment is also growing. We grow almost 35% year on year in that segment also. So overall, it has been a very good quarter, and the joy has come from increasing our margins, and we have declared all-time profit after tax, which is about 236 crore.
Mr. Sharma, when you speak about how gold loans have now become 40% of your total AUM, do you expect it to remain at those levels? What kind of growth levels are you looking at here? And RBI has now eased the norms, right? So how much of the gold portfolio falls under that 2.5 lakh rupee ticket size? If you can give us some numbers there.
So the portfolio about 2.5 lakh rupees will be about less than 30%. Majority of the portfolio sits between 1,25,000 and 2.5 lakh rupees. And that also because in recently last 2 years, gold loan prices almost have doubled. So the ticket size have gone up only also because of that. The gold loan prices have seen a run in last 2 years, almost 100% jump have come. So we see that if gold loan prices keep pushing like this, I think more portfolios start shifting from beyond 2.5 lakh rupees, where we have to assess the income and underwriting of the borrowers.
Understood that. The other part of the PNL that we were looking at is the other income portion. It's growing at a strong pace, doubled on a year-on-year basis. Co-lending is something that has clearly aided you. Going forward, what will be the ideal mix for you? Do you feel as a proportion of the total income, co-lending will continue to grow higher?
So in the total income, there are various fee segments. There is income from sale of the insurance policy to our borrowers. There is a car loan which we sell for our third party product, being about 12 partner banks where we sell. Last year we sold about 1 lakh car loan and generated a gross fee income about 240 crore rupees, a significant amount of income. So there's a huge focus that how do we deliver a ROE between 2 to 2.5% purely from the fee income. And that also differentiate others from our competition. So their fee income include car loan distribution income, insurance distribution income, and co-lending income. As regards co-lending, about 20% AUM sits in the lending is a very wonderful product where the low cost fund of the bank and collection efficiency and underwriting capability and the reach in the rural segment of the NBFC do collaborate with the lender, and ultimately customer also benefit. As far as the company is concerned, we need not to provide any capital for that.
Got it. Mr. Sharma, you briefly spoke about MSMEs as well. Just want to understand, is there any pressure point? Are there any pressure points that you are seeing in that particular space? Because that has been a concern, right, for lenders generally. Your credit cost, you said you'll remain at 90 basis points this year. Do you stick to that? If you can give us some more idea on what are the constituents that you're looking at to keep that credit cost at those levels?
So while generally speaking, this MSME segment in the unsecured have shown a lot of stress. And if you talk about the collateralized segment, in some pocket, in some profile where the tariff have caused those exports slowing down in the textile hub or the gems and jewelry and other aspects, in those clusters, we have seen some stress going up. But barring that, in the collateralized segment, especially in the segment ticket size of 20 lakh rupees, we are not seeing much in, barring those clusters I mentioned are affected due to the exports is slowing down.
Understood that. So in terms of NIMs as well as ROAs, what is it that we should aspire for by the end of FY26 and FY27? How is it looking?
So 27 definitely ROE we are targeting not less than 4%, and which is visible. If you look at the quarter specific, our ROE had touched in that zone. And despite the large amount of capital have come by way of QIP, we are able to reach a ROE in the range of about 15%. And I think next year will be much better. We should be able to target a ROE in the range of about 16.5 to 17% and overall ROE in the range of 4% plus.
Okay, Mr. Sharma, a lot more questions, but completely out of time today. But it was a pleasure speaking with you today on the quarter gone by, but most importantly, the outlook going forward for the company. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the market, stock-specific action, and get our mid-cap spotlight stock as well. Welcome back. You're still tuned into Midcap Radar. This is our special segment, Midcap Spotlight. Rachna is joining us now with all the updates coming in from CarTrade Tech. That stock is lower in trade today. Rachna, tell us more.
Now, this is a significant development in the consolidation story we've been tracking in the digital auto space. CarTrade Tech has issued a formal exchange filing providing clarity on its discussions with Girnar Software. Now, the deal won't be moving forward. Now, Girnar Software is the parent company of Car Dekho and Bike Dekho. Now, if you remember, on November 11th, the company had confirmed that it was in preliminary talks for a potential consolidation of their automotive class fields business in India. And this was first reported by us a day before that, and the company later confirmed it. But now, if you look back at it, had this deal gone through, it would have brought together two of the largest online auto marketplace players in the country, and it could have created India's biggest auto tech platform. And there was good reason for that. Car Dekho's new auto business, which includes Car Dekho, Zig Wheels, Bike Dekho and Power Drift, are estimated to have generated around 3,000 crore rupees in FY25, revenue at 33% EBITDA margin. That's growing to nearly 3,700 crore in FY26. The group also fully owns its auto lending arm Rupee and holds majority stakes in Insurance Dekho and OTO, giving it a much wider financial services footprint in the mobility ecosystem. For CarTrade, analysts said that the rationale was scale, synergies and pricing power. The two platforms together command nearly 20% of India's digital auto advertising pool. That's according to JM Financial estimates. And based on the valuation math that was laid out in the same JM Financial report, Car Dekho's new auto vertical alone could have been valued at around 61,000 crore rupees, making this one of the largest consolidation moves in India's consumer internet space. But all of that now is on pause. CarTrade Tech has said that both the parties have mutually agreed not to proceed with the proposed transaction, and at this stage, the company has stated clearly that the discussions have ended without an agreement. This brings down the curtain, at least for now, on what could have been one of the most consequential combinations in the sector.
Well, that's right, Rachna, in a story that we're on top of. But now the management has decided not to go ahead. It'll be interesting to see, in the next conference call what exactly they say in terms of what made them drop this particular acquisition, given the kind of synergy benefits it would have brought about. Well, a smidge of a recovery in some select stocks across the broader end of the markets. Names like Delivery trading near the day's highest point. LTI Mindtree, that particular stock is doing quite well. IDFC First Bank, that particular stock has now surged and is now near the day's highest point. A quick up move on that particular name. Cummins India, another name our technical analyst on the show had said was looking quite strong on the chart. That particular stock too has now moved and up over 1% in the session. But the broader end of the markets continue to witness significant selling pressure. And if you look at the advanced decline ratio from the time we started the day off, it's deteriorated quite significantly, and well in favor of the declines is what the advanced decline ratio currently is at. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra and with me is Vinny Motiwala. This is a show where you get your daily dose of mutual fund, investment strategies and a lot more. Hey Vinny, interesting discussion today and we have a lot lined up on the show for our viewers as well.
Absolutely a lot lined up on the show, but in the first segment, what we're going to be putting the spotlight on is going to be the flexi cap funds, right? Look at the growth that they've seen over the last few years. The amount of interest that actually comes in here is very great. Now, to talk to us about all of that, we have Swaminathan, MD and CEO at Geo BlackRock Asset Management, to talk to us about all of that. So that's what we'll be discussing. Sid, good afternoon. Thank you so much for joining us in the studios today. It's a pleasure having you here.
Yeah, thank you for having me.
And Sid, let's start by talking about flexi caps as a whole, right? As an asset class that comes in the mutual fund category, that's seen an amazing growth. October 2025, when you look at it, flexi cap funds overall, they accounted the flows were 8,900 crore approximately. Jan was just 5,600. So that growth has obviously been there. Now, given these sharp inflows in 2025, how should one interpret these flows and how does the allocation in terms of portfolio come in for investors here? How should one be looking at it?
Sure. Look, I think the way I think about this is there's always going to be times where a certain category or a certain sector is the flavor of the month or the flavor of the week. We all know this, right? But what's really encouraging for the flexi cap category specifically is that the consistency with which that has grown and the popularity of it with investors. And to me, it really signals that it's being kind of accepted and seen as the core equity allocation for everyone's portfolios, right? So, and that once you kind of have that mindset to say, okay, and I'm a big believer in asset allocation, so I'll talk about that a lot. But once you have an asset allocation in mind and you say, I need a certain percent in equities, and then within that, you have flexi cap as your core, and then you can choose the, let's call it the satellite allocations around that. That's a really powerful way to kind of build your portfolio, increase your wealth. So I think FlexiCap being at the heart of that is a really positive sign for all of us.
So when you say it should be a part of the core portfolio, of course, asset allocation can mean different things for different people. It's personal finance at the end of the day, so it's very personal. When you talk about it, say somebody's starting out fresh, they're first-time investors, and we're seeing that continue month by month in the mutual fund industry. How much do you think they should allocate to say, FlexiCap funds? Of course, it wouldn't be one answer fits all approach, but what is the general answer on how much FlexiCap should be as a part of your portfolio?
Yeah, it's a really good question, and we are very excited about the first-time investors, if I can take a minute. So we have, so far in our 4.5 months since launch, gotten about just over 8.5 lakh investors. Of those, nearly 10% of those are first-time investors, so we're very, very close to them. And the beauty of, to answer your first question around how to get started, is that you can get started with as low as 500 rupees in an SIP. So I think that's a great kind of mechanism for someone who's, let's say, not sure, to start just getting into it, see how the funds are doing, to learn more if they want to be kind of learning themselves, or they can seek kind of the guidance of an advisor to get more sort of notification around how to rebalance things. But I think that is a huge kind of enabler to be able to get in at such a small amount. Allocation, to your point, which I've talked a bit about, is a very personal thing, right? So depending on who the individual is, how old they are, what their goals are in life, that can differ a lot. So again, it comes back to the education. Either learn by yourselves, figure out how you want to do it, and then think about something like a FlexiCap as a core part of the equity, or go and get some advice from someone who can help you build your asset allocation.
It should be core, is the point, not a satellite part of the portfolio, FlexiCap for that matter.
Exactly right.
Normally when I started, it used to be like, oh, invest in large cap, that is where the safety net comes in. Obviously, FlexiCap does give the mix of all caps, and someone professional is managing it, so I don't have to keep worrying about it. In terms of returns also, over the past 5 years, FlexiCap around 18-20%, while mid and small cap, where that excitement comes in, that's seen a bit of a higher return. So how does one actually adjust their portfolio? Do you need to do that? Or how do you move about with the mid and small cap and the flexi cap coming into your portfolio? And core means then avoiding or lesser large caps, or how does that work?
Yeah, sure. I'll try and answer that. So you're right. back in our, let's say, early days of investing, you would just think about large cap as kind of the core allocation. I think the one of the beauties of the kind of market and how it has evolved here in India is that the breadth of the market has grown tremendously over the last year. So in terms of the number of new companies that are coming to the market, getting listed has grown. And along with the breadth, the depth is also increasing. So more and more investors are looking at these companies and actually thinking about investing in them. And that's why you're seeing some pockets in terms of, small cap doing better, mid cap doing better. But overall breadth and depth is increasing. So that means that when you think about the core, your core can now be beyond just a large cap. And that's why I'm now saying flexi cap is what you should be thinking about as the core of equity investing. To your second point around how do you pick between the two, again, there are many ways to skin that cat, right? So within a flexi cap fund, you can let the fund manager make that decision for you, right? So again, there's the flexibility to go between the market caps, which is why it's called flexi cap, or you can choose to do it yourself, right? And again, at Geo BlackRock, we've got funds, again, that are offering that kind of satellite exposure. So if you want to have one core and have a bit more exposure to small cap, a bit more exposure to mid cap, we have funds for that as well. So individuals can choose whether to kind of do it themselves. It isn't easy. Getting that call right, getting the timing right isn't always easy, but some people would want to do it themselves. Or they can leave it to either a fund manager through a flexi cap fund or through an advisor in terms of getting the right asset allocation and then rebalancing it in an appropriate way.
It isn't easy. That's why we have you on the show today to make it easy for our viewers, right? But when we talk about outlook on, say, sectoral rotation and how reallocation can be a part of your overall strategy as well across sector, that impacts long-term alpha as well, right? How does that work in the strategy when it comes to flexi caps? How often do managers actively think about making that churn?
Yeah, very interesting question. So. In our actual flexi cap fund, we have a very differentiated strategy. So this specific fund that we have in the market right now, we are looking to generate the alpha really through stock selection views. So we're actually taking a lot of views because it's a data-driven strategy. We're using a lot of the technology to do that. So we're looking to generate alpha just by making calls on one stock versus another. So we generally tend to be pretty sector neutral in this particular fund. Now, we are planning in the future to launch more funds where we will be applying the same kind of data-driven approach, but to do sector rotation, because we believe there is alpha to be had in both. So you can generate alpha by selecting between, say, one stock versus another. You can also generate alpha by betting on one sector versus another. But the way we have chosen to kind of approach that is actually separate that in terms of having separate funds that do that. So this one is just focusing on securities. And then we'll be launching funds in the future that will focus more on sector rotation.
Okay, so sorry. So in that case, if we are focusing more on stocks, would that mean higher churn? Because the earlier conversation that we had as well, that indicated maybe because it's AI human managed flexi cap scheme for you, right? How does churn change things for investors in that case? Because they would like to understand more on that aspect as well.
Yeah, 100%. So yes, so the fact that it is data-driven means that we are able to capture, and when we say data, we're using data that is, let's say, more traditional, fundamental that you might expect, but also alternative data, which moves faster. So you can get insights faster on some of the stocks. So the turnover or churn is higher. But the way we're able to balance that is two ways, right? So one is the fact that I talked about earlier, that the overall breadth and depth of the market has increased a lot, right? So that already means that the ability to rebalance faster is enhanced in a strategy like this. And secondly, breadth, which means that we also have more stocks, which means that even though we're churning, the actual size of the trade in each individual stock isn't going to be huge. So it's not going to have a huge market impact on a single stock. So we are able to kind of, let's say, control our market impact, even though we have a higher turnover than most funds. And that's because it's enabled by this data-driven strategy and supported by the higher breadth and the depth of stocks that we have here in India right now.
Got it. Absolutely. Let's talk about the fund itself, right? The Flexi Cap Fund, around 2,200 crore AUM. So much of it, I think 40% of your AUM is coming from B30 cities. So in terms of the type of investors you're seeing growing now here, and what if someone wants to look to invest here, what is the strategy maybe you would highlight from Geo BlackRock's point of view?
Yeah, sure. So starting with your initial point on the investors themselves, right? So you're right. So it's at about 2,200 crores right now. We did close to 1,500 at the NFO. So nearly 50% has come in after the NFO, which is a really encouraging sign for us. And the geographic split is very, very encouraging. So the fact that, as you said, 40% of the AUM came from beyond the top 30 cities is super encouraging, because that's really what we are here to do. We're here to bring more people into the market, convert more savers to investors, access the areas where there isn't that much access right now of mutual funds. So that's a really encouraging stat. It's early days. We're still under 5 months old, so it's early days, but it's a really encouraging stat for us to look at. In terms of the how, again, we have seen the full spectrum of investors taking part in the FlexiCap fund. So we have nearly 680,000 investors in the fund. And that is all the way from your deep mass retail doing 500 rupee SIPs to also some institutional tickets. So it's really, as I said at the start, an all-weather fund that caters to kind of the entire investing population of India. And the fact that you can get started as low as 500 and do it consistently through the SIPs is a great enabler for investors here in India.
You have launched a FlexiCap funds. July was a season of liquid funds coming in from Geo BlackRock, right? What is in the line or the pipeline right now? You have received some approvals. It is in the pipeline as well. If you can just, I wouldn't of course ask you greater details on that. That is not something I can talk about. But what are some products you think are needed in the market and will be given by Geo BlackRock?
Yeah, absolutely. I won't get into any of the product details here right now, but yes, we have gotten approvals for 4 more funds, which we'll be looking to launch over the next few months. But taking a step back, the kinds of products that we want to bring to the market here, and we have, a couple of lenses that we apply to it. First, that the product has to, deliver a value proposition for a certain segment of the investing population. So whether it's a institutional focused products, for example, our liquid funds that we first launched, or more of the retail product, for example, the FlexiCap that we launched more recently. So it has to have a value prop as a fund for a particular segment. So that's really important. And then when we come to the fund, we look at what's already available and make sure that we are delivering something that's unique and differentiated. Now, we recognize that the market as it is in a growth phase. We've come a long way in the last 5 years, but I still think we're only scratching the surface. I think in the next 5 years we could double from here. So the growth potential is there, but there are almost 50 other AMCs here with funds in each of these categories. So we look at the category, we say, what is it can we bring that is differentiated from an investment style perspective, from an access perspective, from a cost perspective, that really can stand out and deliver something different to the client. So that's the lens that we're applying. And that's the theme that you will see kind of coming out over the next sort of 3 to 6 months as well.
That's going to be interesting, right, to watch for all of them in terms of the themes as well, including different kinds of funds that you all are launching from what you all already have. So thank you so much, Sid, firstly for joining us on the show, giving us an explanation in terms of FlexiCap fund, the industry-wise, what's the growth there, and infos there as well. Thank you so much for joining.
Thank you for having me. Cheers.
And viewers, we're going to step into a very short break. Don't go anywhere. We'll be back with more on the other side.
Welcome back. You're still tuned into MF Corner on CNBC TV 18, and it's just not about investments and other aspects of asset class, right? There is a lot that's happening in the mutual fund industry, and that's exactly what we want to address. So let's talk about the top news that we've seen or we've heard recently. First up is veteran fund manager Roshi Jain has exited HDFC AMC. When you tell us more on that, the track record, and what kind of journey has she seen?
Absolutely, you know, like you said, and a veteran actually coming in here with the name that she has as well. So obviously 4 years after being at HDFC AMC, a very strong performance that she's delivered across the key funds that she'd been managing as well. She's finally said that she is moving on from there. Now, she took charge of HDFC FlexiCap Fund that was around in July 2022. That was succeeding the former CIO, that is Prashant Jain. During her tenure there, Roshi actually managed 3 flagship funds: HDFC Focus Fund, HDFC FlexiCap Fund and HDFC Saver Fund. And all of them have seen impressive returns. You can see it on your screens as well, right? All in the range of 21 to 23% versus the category average. Now, when you're looking at it in the last 3 years is what we're looking at, the CAGR returns for all of this are at 21.9%, 22.3%, 21.6% respectively. Significant outperformance, like you saw it, versus the category average, which is around 15 to 60% for all these funds. Look at the AUM, right, that she's managed. 1.33 lakh crore as of November 2025 was the AUM of all these 3 combined. You know, when you look at the Focus Fund, 25,000 crores, FlexiCap, 91,000 crores itself was just that FlexiCap fund, and Tax Saver was 17,000 crores. So that's the total AUM she was managing. And before HDFC AMC also, she had spent nearly 17 years at Franklin Templeton, and that's 2005 to 2021. And her journey has been fantastic. She started as an analyst where she's moved up and then managing funds. So that is a great journey that she's had over there. Before that was at Goldman Sachs, where she was a financial analyst as well from 2002 to 2005. And she's handled on the Asian side of retail stocks in Singapore as well as Hong Kong, and a European building material side in Goldman Sachs is what she worked on. So this is a key departure that's come in, and HDFC AMC, where investors were keenly watching out for now what's going to be happening here in these funds.
Oh,
Who
yes.
comes, takes over, that's going to be the key as well.
But of course, because it's an active fund, right? So the fund manager matters the most here as well. So we'll watch out for that. But that's about HDFC AMC and the big change there. But let's talk about PPFAS Mutual Fund as well, because this is one of the AMCs that actually holds unit holder meets, which we don't see otherwise in other AMCs. They held their 12th unit holder meet over the weekend, and they laid out the roadmap for coming years as well. The first one, of course, is they're planning to launch a large cap fund in 2026. That's as close as Jan 2026. That's new because it is a category which is largely out there in the industry as well, right? It's not a new product, so to say. But yes, they are going to do that. The second is they'll be setting up a subsidiary to apply for license under PFRDA to operate under the National Pension Scheme framework. So that's a new retirement product that they're looking at overall. And they're going to expand global access through operations in the GIFT City. So some more ways of exposing yourself to the US markets as well. In terms of the investment criteria, when it comes to the global markets, they talk about how they only have selective global giants in their portfolio. They're focusing only on the ones which are cash generating, they are not high risk and high burn AI disruptors as well. They also spoke about an IPO, and they said they could look at it by 2030. More details on it, of course, is something that we'll be watching out for. But you know, PPFAS MF is the one which has the highest cash levels in the industry, 22.2%. That's the highest by a margin, because the next one is Quant MF, 11.8%. We also have Capital Mine MF, but you know, it just came by. So of course, cash levels are expected to be high. But we have White Oak MF with the cash levels of 11%, Motilal Oswal AMC at 7.2%, followed by HDFC AMC at 6.3%, Trust AMC at 6.1%, Bandhan AMC at 5.7%. So it is a huge margin by which they have cash in their portfolio. They had indicated earlier that they are still looking for opportunities to invest that cash into, not finding those opportunities yet. So yes, this is the analysis as far as PPFAS schemes are concerned. Very interesting, considering that there is something new which comes out of every unit holder meeting there, and this time it's the large cap NFO launch.
We'll be keeping an eye on that, and we'll keep you all updated with that as well. But More news flows or NFO openings that we've seen come by this week is one, Navi AMC, that's their Nifty mid small cap 400 index fund is what they've opened up. You can see it on the screen still, 5th of December. DSP Mutual Fund has come out with a Nifty mid cap 150 and small cap 250 fund as well. So that is something. Tata AMC, Tata Asset Management, that is, they've unveiled the Titanium SIF side of the fund as well. So SIF, that is also coming into play now. And obviously Geo BlackRock in recent news has, mutual fund has received the SEBI's nod to launch 4 new active funds. That's going to be Geo BlackRock Sector Fund, Low Duration Fund, Arbitrage Fund, as well as a Short Duration Fund as well. So a lot of updates, Sonal, that have come in terms from other news flows as well. And all these new funds, NFOs coming in, everyone has to keep an eye out on that as well.
Okay, all right. With that, we'll do one thing. We'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
Lines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng being the only outlier here. It's down 0.3%, but the Taiwanese index is up 0.6%.
Markets are reassessing the prospect of a potential Russia-Ukraine peace deal. 26,261 on the Nifty. The Nifty Bank is up about 0.13. The Sensex is up 0.16.
We've got some earnings acceleration as well in this quarter compared to what we've been witnessing over the last few quarters.
This has been in the making for a long, long time. You know, painful wait going back to September of last year.
The company as well as the Gujarat state government have reached an in-principle agreement.
India is the third largest resource for this rare earth ore.
Given the momentum which we are seeing, this year we should be able to maintain a growth rate higher than the industry.
Well, bulls are charging ahead. That's the theme, of course.
Nifty Bank has been a big contributor to this move. The index at record highs nearing 60,000, up almost 10 to 12%.
You're right, there's been somewhat of a give back in performance relative this year.
Well, after touching record highs, there's massive profit booking that's taking place. Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Rima, with me Surbhi, Prashant and Nigel joining in. Well, it's a milestone day. The Nifty, after 14 months, conquered, surpassed its previous peak, went on to hit levels of 26,100. The Sensex inched past 86,000 mark for the first time ever, but you just don't get the feeling that the bulls are charging ahead. It's been a bit of a choppy session in the second half of the trading session. We dropped into the red and now trying to, climb and fight our way back. So the Nifty's managed to climb above 26,200. So we've got flat moves across the indices. Hi guys. I guess it's the Sensex monthly expiry plus US markets are shut today. And then, of course, profit booking, right? Every time you get to those high levels, you can always say there is that fear of heights.
We were discussing this in the morning that it doesn't really feel like an all-time high. It is an all-time high day. Didn't quite feel like that. One in the morning, and the second half, dare I say, has turned out to be a little disappointing because you'd want momentum, you want participation. That's been missing.
Close at the highs,
yeah,
right?
Yeah.
Rima, those in Santa colors.
Between the green and the red.
December and Santa now.
Actually, we're all red, white and green.
At the beginning of the month. On Monday, you were talking about year-end rally, year-end, and, volumes spiking down.
Disappeared.
Red, white, green.
One more stat, Surbhi, that out of 500, NSE 500 companies, I was just looking at last time at the Nifty made a high, which was September 27, 2024. Only 170 stocks are even higher. And actually, it's about... if you look at stocks which are up over 2% in the same period, high to high, there's only about 130 odd names out of 500. So, and that is, you can look at this data point, but to make the same point, this point essentially being that indices are at new highs. It's been like that, right? Hanging near highs for a while, whereas the broader market has been struggling a bit. Nigel is with us as well. Nigel, afternoon.
I thought you forgot about me, guys. Those Christmas colors and all that. But, not a bad session, guys. Come on. I think it's okay. Par for the course. Normally, when you see a fresh all-time high, you see some kind of profit taking. But otherwise, it's pretty okay, I think. So the Nifty Bank is leading the way. The VIX has cooled off and the PCR as well has cooled off. So let's see whether or not we can build on to the gains from here. And the point that we've been making all through the day, it's not feeling like all-time highs. Time for the broader markets to start performing. And Pankaj Chibriwal, he joined earlier, and he said, in fact, in the past quarter, yes, the Nifty earnings were okay, but from the broader markets, actually, there were some green shoots with a higher amount of revenue growth from the broader markets in particular, and better earnings growth as well. So if the pieces have to come together, then hopefully the broader markets do participate as well.
Okay, well, yeah, indeed. That's the shape of the day. Let's actually move on, tell you what we've got lined up, and then we'll get to the trading calls as well. It has been a record high for the Sensex and for the Nifty after a 14-month struggle. But the stocks have given up gains from the highs, so it's a bit of a quiet session as of now. Flatline for the key indices. The other big story, the cabinet has approved a scheme to promote the manufacturing of rare earth magnets in India and reduce the import dependence. We spoke with, of course, the companies involved, and Parikshit will also join in to tell us about the likely contours of the scheme and when it's likely to be notified. Mahindra & Mahindra is celebrating a year of its Born EV platform with the launch of the mass market 7-seater SUV. This is an EV again. It's the XEV 9S. Can it, spark the fortunes for M&M once again? We'll find out. The management also talks about their EV segment plans overall. Whirlpool is another stock in focus. Promoters have sold over 11% stake, which is valued at about 1,600 crore rupees. More on this very important deal coming up. And of course, we'll start off first with the trading strategies. As always, Mitesh is joining in. Mitesh, and we've been discussing this since the morning as well. And I remember your morning call very, very clearly. And you'd said this, that expect some profit taking once we hit these high levels. And you had said that only if the Nifty decisively crosses 26,300 will you initiate fresh longs. Are you sticking to that call?
I think that's a good way to approach Surabhi because, we did get past 26,300 by about 10 points, but no sustenance over there and immediately kind of started tapering off. So I think till you get a, closing about 26,300 would be definitely welcome, but at least some kind of a burst about 26,300, I think that will convince me that the market is ready to get into higher levels and possibly build upon the up move which we have seen for last couple of weeks. Having said that, therefore, since we have not had that event, I think on the trading side also what we'll advise is to possibly reduce some kind of long exposure, even on the stock side, and identify some shorting ideas. So I have one buy and one sell. On the buying side is Motherson with a stop at about 112. Look for targets of 121. And Oil India is a sell with a stop at 422 for targets of 405.
By the way, some metal stocks are now fighting back. JSW Steel is back in the green. Hindalco is pushing towards a 1% gain. So some recovery and up move seen in these metal names. But let's talk about the other big story. One day after the government announced a rare earth permanent magnet manufacturing scheme with an outlay of 7,300 crore, CNBC-TV18 has learned that the government may move fast to operationalize the scheme and invite bids. The aim is to build long-term capacity for rare earth magnets, which is currently almost fully imported into the country. So what could be the contours of the scheme? What's the government thinking? Parikshit joins in with the exclusive details. Parikshit.
Well, the government wants to get down to business when it comes to setting up a domestic supply chain of rare earth permanent magnets as soon as possible. We believe that now that the scheme has been announced, the notification of the scheme could come out in just about 15 days. And post that, the government would like to invite bids by 31st of January 2026. This is what we're picking up from our sources. Interested bidders, we are told, will have to submit a detailed project report along with their bid applications to show that they have some sort of expertise in making rare earth magnets. And even if they do not have expertise, they have the global tie-ups or some sort of past manufacturing experience which will help them in making magnets in the country. At the same time, they will have to show the financial capability as well. In fact, having an ability to invest at least 1,500 crores in setting up a plant for 1,200 tons of magnet annually may be one of the criteria. The government may also invite smaller companies which can set up plants for 600 tons of magnets per annum. They too may be invited. Very soon, an inter-ministerial group consisting of 10 ministries is going to set up. They will be supported by India Rare Earth Limited, Bhabha Atomic Research Center, to come up with a criteria which all the companies who are bidding for this scheme will have to follow. Companies are free to have global tie-ups. They can have a technology partner from abroad, but they must manufacture in India. That is going to be the base criteria. We also believe that during the consultation phase, when the scheme was being worked out and discussed with the industry over the last 3 to 4 months, at least 25 companies showed interest. How many finally go ahead and apply for this scheme? That remains to be seen. We're told by sources that at least 3 companies in India, Intellis, Ashwini Magnets and Midwest, have an ability to make rare earth materials in the country. But we definitely have to boost the refining capacity in a great manner as well. The government is also asking the Department of Atomic Energy to tell India Rare Earth Limited to expand its capacity of making NdPr oxide, which is a crucial raw material of rare earth permanent magnets, so that they can be a big input and raw material supplier to the domestic industry.
Okay, all right, got that, Parikshit. Thanks very much. Important story that is playing out over there. In fact, we had caught up with the Indian rare earth company itself, as well as IMFA, India Rare Earth Limited and IMFA, and they're the big public sector miners for these rare earths. IMFA is a private sector player, and they told us that they will look at the contours of the scheme very, very carefully, and then they decide whether they want to get into the manufacture of the magnets themselves. Listen in to both the companies.
India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having, but we require dysprosium and terbium, which are required for the this coercivity or to have this high resonance, which allows the retain high magnetization and the coercivity in the magnet. Right now, this dysprosium and terbium has to be imported, and on top of that, there are technology available like Protorial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
We, of course, have decades of experience in mining, in processing of ores, etc. Now, I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain, as it is at the moment, going through the details and looking at what is there on offer. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
Okay, so that's a word from IMFA. But, like India Rare Earths Limited, like Mr. Mohanty explained, there are still lots of tech issues that need to be sort of cleared up. The availability of raw materials, the actual materials with which these magnets are made, the actual rare earths, that also needs to be sort of seen. In any case, we have Deven Choksi of DR Choksi FinServ joining in to take a couple of questions, talk about some interesting stocks. Before I get to anything else, Deven, hi. Good to have you in. And, I think congratulations to all of us, to all the investors. We've finally seen the all-time high for what it's worth. But let's talk rare earths. It's obviously a very interesting subject. The question is that in the market, there are few stocks. I mean, you can go back to a GMDC. GMDC has already rallied some 70% this year. And like India Rare Earths was explaining that the actual elements which go into the making of these magnets, for that, the feasibility studies are still going on. They need to see if, there are enough deposits in Rajasthan and, elsewhere. Now, is it worthwhile to play a stock like GMDC, or should one just stay away? Do you think it's a very volatile area right now, this whole rare earths piece?
Yeah, hi, Selvi. Good afternoon, and congratulations to all of us. I think we'll have to develop the habit of, congratulating each other every time, because I think this market is showing the signs of going up to 30 to 33,000 Nifty in a span of around 12-15 months. So hopefully, I think we'll have more occasions to wish each other on this subject. Well, I think the like semiconductor, the newer segment of business is getting opened up with rare earth now. Probably, I think the entire ecosystem under which I think these particular magnets will be manufactured, I think it will be very interesting play. Not only mining. Mining is one part of the activity, important part of the activity. But the kind of technology stack it evolves into, I think is something which very interestingly one will have to look at. Maybe China is a leader in this particular space from a point of view of mass scale production. And I think that's where probably Indian companies would like to go back to. Because I think this policy might end up allowing the collaborations because of the nature of business that we are getting into. In my viewpoint, it's very early to, pinpoint one or two companies at this point of time just because they have the ability to mine. How exactly this mined material will be taken into the factories and then ultimately to the customer is required to be seen very systematically. And who emerges in the ecosystem is again going to be very interesting. Maybe the user industries like auto ants, I think would be the right choice to look into from that perspective. But still early, I think we wouldn't have much ideas to talk about, frankly, as far as who could be the real, game player in this game, where they can take maximum amount of share in the business.
Okay. All right. Deven, stay on. Lots of other questions coming your way. In fact, be ready for questions on Tata Motors, PV and M&M. And I'm sure you know why, because that's the other big story that we're tracking in the market. It's a big launch coming in from M&M, from their Born EV SUV platform, as they call it. The company introduced the XEV9S. This is a 7-seater SUV. It's aimed at the mass market, and the pricing seems to be very, very aggressive at just under 20 lakh rupees. The car was unveiled at Mahindra's Scream Electric event. So this was a big, big launch coming in from M&M. Hear out from the management on what this product could mean for the M&M portfolio. They talk about the new launch, production targets, and their overall plans for the EV space.
You know, we have launched BE6 and 9E. They was based on the Inglo platform. Inglo platform has multiple top hats. The 9S is one of the top hats. So this is the third vehicle that we are launching out of the Inglo platform. And 2 more vehicles are in progress. We have 3 products right now. So that means BE6 and 9E and then 9S. That's the 3 products that's going in the market. We have operational capacity right now about around 4,000 to 5,000. And that will extend operational capacity will go to 8,000 per month by end of F26. That's March 26. As far as this product is concerned, the 9S, it's one product, 3 variants that Nal has shown us. So therefore, all the 3 variants will be made in the Chakan plant, and as we start the production in January, and we keep increasing the ramp up. So according to the ramp up, the operational capacity will increase. But the stabilization of the ramp up will happen by end of March 2026. That's when Rajesh was saying that it will go to 7,000 operational capacity, 8,000 operational capacity, and 7,000 deliveries. We have set out in 2027 between 20% to 30% in that range. Our electric penetration will happen. We are committed to electric, we are committed to sustainability, and we strongly believe electric is the way forward.
Electric is the way forward, and they've of course taken big strides with the BE6 and the BE9 itself over the last 12 months. And now this is a new one coming through. Stock's quiet. But then it's been such a huge outperformer, not just this year, last many years we're talking. Devin, let's talk M&M, and then I want to, actually get your take on Tata Motors PV as well because of their Sierra launch. But with M&M, it's anyway been a winner, right? So I don't know how much this new EV launch, how much it really moves the needle. How would you rank their performance on the EV side? And a lot of brokers still have targets northwards of $4,000 on Mahindra and Mahindra. The question is, can it still be bought?
Yeah, I think so. I think this company has proved that their successfully born electric vehicle launch portfolios are actually, I think, driving the customers into these products, I think, very significantly. In fact, today they have become a formidable force within the Indian manufacturer space in the automobile, wherein their born electric vehicles are becoming the preferred choice of customers, I think, because of course, the pricing point, which is quite compelling. Second most important aspect, the product and the product design. The differentiator is, I think, very significantly seen in this case for Mahindra and Mahindra. Now, this 7-seater vehicle coming up on SUV platform, again at a pricing point at which it is being sold, I think they are probably going to be having a good company with likes of Toyota Innova, which is basically, I think, a hybrid one, though I think slightly higher than their top-end model as at this point of time. But still, I believe that I think this company would probably have relatively better things to talk about. Wouldn't be completely surprised if I think their opening bookings, I think, could possibly collect more than 10,000 crores kind of an amount in the advance booking, which they have demonstrated in the previous booking as well. So I think even their 3-wheeler segment, I think, is firing on good guns, I think, with the export also. I believe that this company is possibly showing the big character difference as far as I think launch of electric vehicle and taking the market share is concerned.
So you still seem convinced despite the rise of M&M. Devin says probably better times ahead still. Very quickly, just 10 more seconds. Tata Motors PV. Did the Sierra launch make you sit up and take notice? I mean, they've had a really difficult last many quarters. Any reason to buy the stock?
The pricing point, again, I think they are basically targeting the mass market, and the pricing point at which Sierra is launched, I think certainly it demands an attention. I would think that I think this company too deserves to be seen, I think, very differently, given the kind of launch that they are bringing into the portfolios.
Okay. All right. So that's on the auto side. I think we'll go to Nigel in just a bit. Get cues from the F&O market. Right now, things are very flat on the Nifty. It's just nothing seems to be moving. Even the mid-cap index is completely flattened out. The saving grace is actually the bank Nifty, which is still retaining some gains. ICICI Bank, HDFC Bank. These are stocks that are still on the upside. So banks and financials really the only very clear patch of green in the market right now. Nigel, what about F&O? What's happening in the space over there?
Well, not too bad. You would want us to build on to the gains, but we at least hit the fresh all-time highs. And actually, things are going through a bit of a consolidation. I don't think it's too bad. And today's a day of writers, because if you've written calls, you've written puts as well, you're making money today. First point, with regard to the India VIX, that's still cooled off. I recall last week when we had gone closer to around the 25,800 mark, I'd mentioned that the Nifty was down more than 150 points, but the VIX had cooled off. The VIX cooling off is always an indicator. And that's cool even today. So that's good. That's telling us that maybe, in fact, the markets want to test higher levels, at least on the headline index. And the one that will have to lead the way is the Nifty Bank. The 20 DMA is very deep now. It's close to around 1,000 points away from current level. So that's clearly the one that's helping us trend higher. One point is with regard to the PCR. Now, normally when the PCR goes to around 1.5, you see the markets cool off a little bit or go through a period of consolidation. We're getting away light actually, because from around 1.5 at the start of today, we have come down to around 1.05 the last time I checked. And we're going through a day of consolidation, not a pullback. So that's heartening to see that the PCR has come back down to the middle of the range and we haven't seen any big correction out there. And the reason that the PCR has cooled off is because, you're seeing action on both the sides. So call writers, they're making money today. If you look at the 26,300, 26,200 call, the premium on both those two are down sharply. On the 26,300 call, the premium is down from around 100 rupees to around 70 rupees. While on the 26,250 call, premium was around 120 rupees. That's down to around 100 rupees or thereabouts. Even on the put side, 26,200 put, the premium has corrected out there. So there is some cooling off. Short point being that today is the day for writers. If you're writing strikes, then in fact you're making some money. Individual stocks are in focus. Gains, that's come down to the low point of the day. It's down close to around 4%. Earlier this week, there was some excitement. But the big surge in terms of open interest, fresh shorts being added in the system out there. Ashok Leyland has come back strong. Both cash market action as well as the F&O action is quite encouraging. Fresh buying being seen out there. And Bajaj Finance, a stock that had seen a big correction post its numbers. The shorts are getting squeezed out a little bit. That one's up close to 2%, open interest lower. Net, we hit fresh all-time highs. We have not built onto those gains, but not a bad day. The bulls are still in control. Santa should be in town in December.
Okay, all right. Santa did show up today.
Yeah.
Stay too long. Maybe he'll stay longer in December. Yeah. Okay. All right, let's take a quick break on that note. Come back on the other side. We'll have Rajesh Kothari of Alf Accurate Advisors join in. And we'll take a couple of questions in the market with him. Okay, welcome back. Flat afternoon, that's what we have. And by the way, that's a really important message that Mr. Milind Deora has put out on social media now. And frankly, as a Mumbaiker, I'm so glad at least someone's speaking about it. He's urging all the parties to literally come together. I think he's tagged, the Chief Minister as well, saying that can we put an immediate halt on all construction activities, all the digging, basically saying that Mumbai is crying out for help and this is a national health emergency, public emergency, and something needs to be done about it. So that's what I read last, that the GART4 standards, which, on and off come on in Delhi, they have not yet been imposed in Mumbai, because apparently the last sort of word on this was that if AQI remains above 300 for 3 consecutive days, then they'll enforce, GART4. But hopefully some action will be taken before we get to that level, because it's really, really, difficult out here as well. But anyway, back to the market now. Let's bring in Hormaz to see through the haze and the smog on the street, because he's seen through that smog and he's found some buzzing stocks. So, Hormaz.
Oh yes, there are. And even if the broader markets are in a bit of pain, even as the Nifty made a record high today, there are stocks that have singled out for news-specific moves and even volume-driven moves today. You look at Patel Engineering, that's a news-driven move today. It's the biggest single-day gain that the stock has seen since April of 2023, the 16% up move that you're seeing today is the second straight day of gains. The volumes today are the highest on record. More than 18 crore shares have been traded today on Patel Engineering. The 20-day average is around 17 lakh shares. The stock has moved above both its 50 and its 100-day moving average. And although the stock has turned positive for the month, it is still down 25% in 2025 so far. The Commonwealth Games coming to Ahmedabad has taken the stock of Ganesh Housing higher today. At one point, the stock was up almost 12-13%, still holding on to gains of 8.5%. The volumes today are the highest since January of last year. We've had close to 40 lakh shares that have been traded today on Ganesh Housing, and take a look at the 20-day average here. It's only 30,000 shares. The stock now is nearing a very important level at 871, which is the 100-day moving average. It did cross that intraday, but hasn't managed to sustain above that. And after 6 months of consecutive losses, the stock has finally turned positive for the month of November. Although on a year-to-date basis, it's still down 33%. Not to forget that the stock had tripled in value in 2024. Ashok Leyland, as Nigel was also highlighting in his F&O segment, the third straight day of gains for the stock now. It's a fresh 52-week high for the stock. Volumes are the highest in nearly 4 months for Ashok Leyland. 7 crore shares have been traded today. The 20-day average is just over 1.25 crore, so that's 1.25 crore. The stock has taken support at its 50 DMA consistently and has moved higher. It has not closed below that 50 DMA, which is around 140, 141 levels since August of this year. And it's had a fairly good year as well. It's up 44% year to date, and it is set for its best calendar year performance since 2017. And lastly, it's a new listing, Prostam Infosystems. The third straight day of gains for the stock. The biggest single day gain in volume since July is 17% up now on the stock. Is the third best day that the stock has had since its listing in the month of June. And we've had close to 1.7 crore shares that have been traded. The 20-day average here is only 3 lakh shares. And the stock has had a fairly decent run as well. It's up around 76% from its IPO price of 105.
Okay, all right. Interesting stuff there. With Ashok Leyland, I think there are a couple of brokerage calls as well. I think BNK has put out something there, and I think there is some buzz that as we are wrapping up the month in November, sales numbers are strong, especially for Ashok Leyland. We will know in about 3 or 4 days. And of course, I mean the F&O activity, etc., as Nigel and Hormuz point out as well. Rajesh Kothari of Alpha Accurate Advisors is with us now on the program. Rajesh, great to have you with us here on the show. Thanks very much. I think we should at least end higher, right? On a day that we hit a new high, at least some green by 3:30 will be the minimum bare requirement. But Rajesh, just the big story we've been focusing on since actually yesterday afternoon is this government push to build out a sector which does not exist, rare earths. It's ironic. I was just thinking that China built actually a lot of, not rare earth, of course, I mean, it happened much earlier, but a lot of what China did over the last 5-7 years was forced on them because the US would not, sometime in 2016-17, the US stopped supply of some critical technologies. And then China had to build out a lot of these industries in a big way. And of course, now we know where they're at. And something similar is happening now. The only difference is instead of US, it's China now. How do you think about something like this? I mean, a sector which the government wants to build out. It may not be easy, but as an investor, what's your perspective?
I think, what's important is I always believe that, adversity brings the new opportunities. Am I right? Short term always becomes painful. You remember 1991-92 India moment, am I right? It was, I think, the toughest period India faced during that time. And during that time, you know what the reforms then started. Till the time India was like a locked economy. And then you see how in next 25, 30 years India has moved. And I think the current situation, not only from last 3 months, but if you look at from last 2020 onwards, the supply chain globally is breaking. Earlier, it was a constraint due to COVID. Then it became a constraint due to geopolitical conditions. And now it has become constraint out of choice because of the defense related thing, along with economy, along with politics, all are getting combined. But one thing is for sure, I think 40 years back, India was different. And today, India can afford to build this kind of capabilities. But let me tell you, there are many areas where we are far, far lagging compared to any other country, particularly China and US, because we have to keep these two countries as our benchmark and not the many other small economies. Look at the patents. Look at China, look at US, and where is India? India is called the pharmacy of the world. But if you look at the patents now coming from China, increasingly they are taking away more and more market share. So I think there are many more areas where India need to focus upon. Of course, we cannot chew everything together, building one by one, but focus needs to be there. Good thing is that a lot of equity capital is available, provided you have the right structures. And I think today, actually, there is an article in Economic Times by, the Biocon MD, Kiran Ma'am. And if you read that article, it's very clear, like how Hong Kong built that entire pharma R&D related funding. And I think India can also do something very similar. We have a brilliant minds, many of such companies, promoters, they have the brilliant minds. And together, I think we don't require 5,000, 10,000 crores. We require probably 1 lakh crores to build each of these verticals. And money is available. Capital is not a constraint. So,
okay,
we need to build this.
All right. Hi, Rajesh. Good afternoon. And good to see you in. Just one word on JMDC. The current market cap is 17,000 crores. The EBITDA that they'll do at best is 600 crores from the core business. That's been the highest in many, many years. We here at CNBC TV in itself had explained the company at 4,000 crores market cap. Currently 17,000 crores. So 17,000 crores for an EBITDA of around 600 crores. Clearly, the street is giving a big value to this rare earth opportunity, and it will fructify in the next 3 to around 4 years. As promised, maybe in the next 5-6 days, we'll try to get the GMDC management on CNBC TV18. Well, Rajesh, before we continue talking about the markets, I want to congratulate you actually, because I believe Alpha Accurate Advisors, PMS, they've completed close to around 16 years. So congratulations. I'm sure your investors have been very, very happy over the last 2 years, and wishing you to go from strength to strength, because your investors will be counting on you to create a lot of value for them.
Thank you so much, Nigel, for your best wishes. And I think, you guys have also played a very important role in covering the industry very closely. So thanks for all your support for the entire industry, and looking forward to have many more milestones.
More power for the next 16 years. So let's start off today itself, Rajesh. Give us a couple of ideas then. With the due disclosures, as you always ask our team to put it up on the screen, what's the top region you'll have done in terms of additions? If you could help us out in your portfolio. And I assure you, there are disclosures coming up on the screen.
So I think the very important thing in the month of September, we have seen the bold decision by government to cut the GST. And I think the Indian consumer, I would say kind of a muted consumer in last 2, 3, 4 years. And I think this one very important bold step by government, along with income tax cut, along with interest rate cut, it means nearly 4 trillion INR infusion for Indian consumers. So what we are doing, particularly in last 30, 40 days, is realigning a little bit further adding to consumer basket, which includes primarily discretionary, and that includes automobiles, auto ancillaries, the luggage companies, the fashion companies, NBFC and banks, which are more consumer-oriented, the unsecured loans towards consumer-oriented NBFCs. These are the basically 4 or 5 segments where we are adding our weightages. And of course, some of it's coming from defensive sector like pharma and something a little bit from capital goods. But these are the basically segments which we are adding. We believe that automobile is at a very, I think the growth will continue in auto sector, particularly not only for two-wheelers and passenger vehicles, but I think you will also see the positive impact even on the commercial vehicle side. So we have been, we have added in the commercial vehicle in our portfolio. In the consumer segment, one of the largest luggage company, which we have been very bullish earlier, and then in between we exited after making huge wealth. We re-entered it. I think India, if you look at total airports, have doubled in last 10 years from I think 75 airports to 160 airports, and we are adding another 50 airports in next 5 years. There are different ways to play this. One way to play through airline, which we generally don't do it. Second is to play through hotels. Again, it is a high asset. Generally, we avoid. And third best way is to play through consumer discretionary, like luggage company, because you have to carry your bag wherever you go, and whichever hotel you buy, you need to have only, there are only 2 brands available in this country. So by default, it becomes a natural choice for us. So that's the one company which we added in our portfolio. And these are the sectors, where we have increased our exposure.
Thank you very much for that, Rajesh. Great speaking with you as always. Get into break. On the other side, we'll discuss what dealing rooms are saying in our segment D Street Chatter. Stay tuned.
Welcome back. A day when we hit fresh all-time highs, and guess what? We haven't moved a point. 25 minutes left for the end of the trading session, and the Nifty is absolutely flat. Good time to get a sense on D Street chatter. Nimesh, what are you picking up with regard, to the feeling, the left-out feeling?
Honestly, Nigel, not surprised with today's move. We were expecting it to hit an all-time high, and a bit of profit booking. So that's played out. Again, that's not the point. Nifty hitting an all-time high, but if you ask dealers, if you ask investors, the mood is very somber. The portfolios have not made money this year, right? And that's been a big pain point. The broader markets have underperformed so much, especially some stocks which are down 50-60%. So there is this, while on the Nifty, Bank Nifty, yes, it's an all-time high, but not the mood, at least from a market perspective. Flows, again, a mixed day of trade. The good part is we've seen a bit of buying interest back from larger FIs. Even if you look at yesterday's data, X of Bharti block deal, the FI and the DI both seems to be having a positive number. So that's a bit of a positive at the margin. Again, in today's market, I guess the flows are slightly tilted towards the PSU. So again, some select PSUs where there is a bit of buying interest back. I guess technically, 26,200, 26,120 is a level to watch. We are above that. So looks like it's still in favor of the bulls, but need to see whether it's backed by FI buying. But I think for today's market, it's basically a bit of profit booking once we hit the all-time high.
Let's focus on individual stocks then. What are you picking up?
Well, so the first stock on my list is Stylum. This is one stock that we have reported a couple of times in the past as well. There is a big M&A which is on the cards. Looks like the deal is around the corner now, and maybe you might see that fructifying. So that's something to track as far as Stylum is concerned. There is a big announcement likely there. The second stock is Saregama. There was a large block in the afternoon trade. And after that, there is a bit of a sharp recovery as well in Saregama today. I understand a leading FI investor was a seller, and maybe that's a potential clean-out trade from that particular entity. So if there is a disclosure, that could be interesting there. Third, a couple of stocks where there is delivery is buying today, REC and NHPC. As I said, some bit of buying is back in PSU names. These two stands out in terms of delivery buying today. And the last is Glenmark Pharma. There was an announcement that they've got a approval for one of the US plant. But in general, I guess there is momentum back and bit of buying as well from larger HNIs into Glenmark Pharma.
Thank you very much for that. Some other stocks where you are seeing movement. EMS companies are seeing a fair bit of profit booking. So Keynes, PG, Electroplast, these were the big movers yesterday. And today stocks are under pressure. So Keynes Tech down nearly 4%, PG Electroplast lower by 3%. Sirma SGS Tech also in the red. Ashok Leyland on the flip side has hit a fresh 52-week high. This is after the board approved the merger of NDL Ventures and Hinduja Leyland Finance Limited. And yesterday, we got the merger ratio between the two, and that stock has been on a tear today. Nimesh, thank you very much for that. For the markets today, we hit a milestone, record highs after 14 months. And CNBC-TV18 got its first global reaction from Jonathan Garner of Morgan Stanley. Now, he's been bullish on India. He's overweight on India. And, when asked on when FIs will come back into the markets, he says FIs never really left the Indian markets. They were participating in the primary market, etc. But listen in to his views and where we're headed.
Market starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year. Going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small, and most of our other market calls are relatively contained. Overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example. To be precise, we're 75 basis points overweight. At our maximum bullish, as I say, back during those 4 straight years of outperformance, we were at times 200 basis points overweight. So we moderated our bullishness on India this year. But then we have relatively tight risk positions in all markets currently. Ridham Desai and the team just set a Sensex target of 95,000, but again, with a wide bull-bear range around that. And that would certainly be consistent with India outperforming because it gives more upside than we have for overall MSCI emerging markets, where we have something like a 1,400 target.
And what's the bull bear on the Sensex?
76,000 up to 107,000. So quite a wide range.
Okay, well, that's Jonathan Garner, one of the top equity strategists as far as, markets go. A long time strategist at Morgan Stanley. 11-point change, so it's absolutely flat, not very much going on at all. Mitesh is with us with some trading ideas. Short-term, Mitesh, what would you recommend?
One SCVT and one BTST. BTST on ICICI Bank, that's one which has bounced back nicely today. It's near the day's high. So BTST here with a stop at about 1383 for targets of 1410. And ONGC on the negative side sell on STVT with a stop at 246.5 for targets of around 240.
Thank you. Let's get to one more story. The centre is expected to table a list of amendments to...
Okay, I think... Reem, I think your mic's playing truant. Well, let's just, so let me toss it across to Yash, who's joining us, right? So we report, the cabinet basically, the insurance amendment bill was put in front of the cabinet yesterday. The bill is now going to go to the parliament when the winter session of parliament starts. And of course, most likely it's going to be cleared. We've, of course, been reporting on what is there in the insurance amendment bill, 100% FDI, composite license, etc., etc. Yash has been speaking with both industry CEOs and analysts to understand broad strokes, broad contours of, who benefits and perhaps who's at a bit of a disadvantage. Of course, remember, this is all just feedback and companies will maneuver. They've been preparing for this. They will maneuver so that, they are on the right side in that sense. But Yash, take it away.
Well, Prashant, as you rightly pointed out, it is once in a lifetime moment for the insurance sector, as the complete dynamics of the sector are expected to change with the insurance amendment bill getting tabled and approved in the parliament. As far as the bill is concerned, I've been speaking to a lot of analysts and industry players, and the general feedback is that the insurance amendment bill largely is going to be a negative when it comes to standalone health insurance companies. That is on one side of the bill. At the same time, the insurance amendment bill is going to be a big positive for distributors of insurance in the listed space. Of course, we have Policy Bazaar or PB Fintech, to whom the bill could benefit in a big way. Why? I would tell you that. The insurance amendment bill, at least 3 out of 5 major amendments, seem to be negative for standalone health insurance companies. The first one is 100% FDI when it comes to the insurance industry. This is expected to bring a lot of large global players into the sector, and so far for all the new players, the first choice of entry has been health insurance market. Here, there are about 6 players at this point of time, but with more players coming in, the competitive the intensity could go up. The next one is composite insurance license. Large life insurance companies could come in the health insurance space, having the capability to disrupt the market, but health insurance companies may not have the capability to enter the life insurance market, and hence there's a higher possibility of the health insurance market getting disrupted with the agency force which they may bring. The third one is reduction in initial capital and net worth. Now, this is also expected to bring a lot of smaller players which may tap the untapped areas of health insurance market, again disrupting one of the most important growth areas for standalone health insurance companies. And all these 3 points expected to bring more business for distributors like the ones of Policy Bazaar.
Okay. All right. Thanks very much, Yash, for those details. So that's an important development to track as perhaps that bill makes its way, the amendment bill that is, makes its way through Parliament. Thank you for that. Well, we've got Amrish with us. Amrish, good to have you in. Let's first get your stock. I think your pick today is from the automotive space, is it?
Absolutely, Surabhi. The pick is Castrol India, which is a 51% subsidiary of British Petroleum, largest private sector lubricant company in India, both in automotive as well as industrial segments. And they have about 20% market share, 3 manufacturing plants and around 160,000 retail outlets throughout India. And now the focus is on tier 3, tier 4 and rural areas. So they have around 40,000 outlets in rural areas and 25% of the volumes comes from there. They have now diversified their products and services into auto care and chemical management services, strong free cash flow, minimal capital requirements going ahead, and high ROEs. And along with that, the payouts are also decently high with the dividend yield of about 7%. So my expected EPS for calendar year 26 is about 11. And with this, my target price is 265.
Amrish, hi, afternoon. I remember about 2 years back, you were looking at Tata Tech and Tata LXA.
Right.
But
underperformer.
They've been quite the underperformer. We were just looking at the performance of these companies vis-a-vis all-time high levels, and both Tata Tech and Tata LXA about 50% off their all-time high levels. That's quite a stark underperformance. Do you see it reversing, and what did you do with your own holding in these stocks?
No, in fact, I think the bigger issue was execution, which hopefully now should get resolved over the next 2 quarters. And we have seen, like you rightly said, about 18 months of underperformance. So I expect that at least there should be some pickup over the next 2 quarters. I think that's the time I've given for my investments in the sense to decide whether to continue holding on or whether to book out. So I'll wait for the 2 quarters. Hopefully things should improve.
Okay, all right. Stay on, Amrish. We'll come back to you for some more questions, and also we'll be in the last leg, countdown to the market close. Back in a bit.
Welcome back. Looks like it's going to be a flat close off from the intraday peaks of 26,310, but the Nifty might be able to defend that 26,200 mark. Banks have done pretty well. In fact, the banks and NBFCs are in top form. The Nifty Bank is up 230 points, and the top three gainers are from that space. So Bajaj Finance, ICICI Bank, Shriram Finance, all are doing well. And even HDFC Bank is supporting along with that Kotak Mahindra Bank with about a 0.5% up move today. In conversation with Ambarish, Ashok Leyland, 7% up, fresh highs. We were just saying that it seems to be related to that merger between Hinduja Finance Limited and NDL Ventures. Have you done any analysis on what the impact could be on the listed company?
No, I've not done too much of analysis on this merger. But then if you're talking of CVs overall, I think going ahead, clearly the next couple of months looks good from a CV sales point of view. And because of which, again, we have also seen Tata Motors CV also moving up decently well. So expect both Ashok Leyland as well as Tata Motors CV to at least see about 8 to 10% higher over the next 2 to 3 months, based clearly on the figures.
Jonathan Garner, when we spoke to him from Morgan Stanley, he has added Maruti to his focus list in the Asia emerging market portfolio, the focus list there. And again, the same reasons, beneficiary of the GST reform, mass player, etc. Do you like Maruti Suzuki at these levels, or would you go with ACA and M&M, for instance?
No, I think the biggest beneficiary in the passenger vehicle segment, where the vehicles at the lower end, and Maruti has the highest share in that space. So Maruti is clearly the biggest beneficiary. Mahindra also I like a lot, especially because of their new launches, which they have done in the last 12 months. I mean, all of them are doing extremely well. And especially on the EV side. So Mahindra also has a couple of legs up. I'll not be surprised if we see the 10 to 12% higher.
Okay. All right. Amrish, just stay on. We'll start wrapping up. Well, it's been an interesting day for the market. A day where you got the all-time high and then it just fizzled out. I mean, you'd never imagine, Rima, right? If you hadn't seen the first half an hour of trade, that today was an all-time high day for the Nifty and for the Sensex.
It just doesn't give you the feeling, you know, when we have all-time high levels, you always put this bull's charge ahead. It just doesn't leave you with that feeling. But again, it's a milestone, it's a momentous day because it took a long time coming, 14 months for our markets to get back to all-time high levels, and it's still 26,200 on the board.
Absolutely. It's been a test of patience and resilience for domestic investors, and they have prevailed. And the index is back to where it is. So let's quickly recap the large cap participants. We're talking about a 20-point up move on the Nifty as we're closing out. And a lot of that is actually coming in from IT and BFSI. And that will reflect in the Nifty gainers. Bajaj Finance, 2.5% higher. ICICI Bank, 1.3% up. Look at something like a Kotak Mahindra Bank, about 0.5% higher. Shriram Finance, 1% up. So these are your main gainers. But then you also had stocks like SBI that did not participate. They chose to sort of sit out of the up move today. SBI was down about 1%. HDFC Bank about 0.5% higher. So let's move beyond BFSI and see what else worked for the market. Lever is up about 1.2%. Hindalco managed to put on about 0.7%. And a lot of the IT stocks found some traction once more. So HCL Tech, Infosys, these were some of the names on the upside. Some of the metal names like Hindalco and JSW Steel, they continued to shine on as well. So that's the upside of the screen. The downside now, lots of cool off in the auto space. Eicher Motors 3% lower, Maruti 1.5% lower, Bajaj Auto down 1.5%. So these were the names that really stood out. Adani Enterprises has lost about 3% as well. ONGC is down about 1.5%. Let's now talk about the mid-cap market. Here as well, at the index level, things completely flattened out. The advance decline ratio is also neck to neck. 1:1 is what we're looking at. Some interesting movers and shakers. Patel Engineering, they won an order. Stock really had a superb day, 12% up. Sami Hotels, we spoke with the management in the morning, sounding very, very confident about the second half, talking about a higher margin trajectory going ahead as well. So that stock did fairly well. The other gainers of the day, definitely the CV players. Tata Motors CV, 6% higher. Ashok Leyland, 6.5% higher. Actually, even Escorts Kubota had a good session, 4.5%. So these stocks did well. And then you have, of course, some of the key losers. So worth highlighting some of these names as well. On the downside, look out for Whirlpool. After that large deal, stock was down about 11-12% throughout the trading session. And a couple of the real estate names have seen some profit taking today. Sobha, Brigade, BP, DLF, a lot of these stocks on the downside as the day winds up. So the bell has gone. 14 points up on the Nifty. All-time highs hit, but we didn't quite close above those levels. So perhaps the bulls will have to fight a little longer. With that, it's curtains on this edition of Closing Bell. But thank you for watching and keep it with us because Markets Forward is taking the action ahead.
Sensex and Nifty hit a record high after 14 months. Both markets give up most of the gains to end barely in the green. Bank stocks lead the rally.
Whirlpool of India stock declines in trade after its promoter sells nearly 11% equity after upsizing the offer from the initially indicated 7.5%. The sale results in the Indian arm ceasing to be a subsidiary as the parent stake slips to near 40%.
In a likely resolution of a long-pending issue, Tata Power is likely to ink a supplementary power purchase agreement with the Gujarat government for its Mundra unit and restart operations in December. This pact is likely to be used to ink PPAs with other states as well. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vivek Iyer and with me is my colleague Sonal Bhutra. Well, good afternoon, Sonal. What a volatile trading session we saw today. We hit the intraday fresh all-time highs, post which we gave up a lot of those gains before making a smidge of recovery towards the day's highest point.
Yes, so Sensex crossed that 86,000 mark. Nifty was above the 26,300 mark for the first time, but we have come off from those highs and absolutely flat on the Nifty. Mid-cap index too gained 51 points today, but the advanced decline ratio, that is something that we will keep an eye out on, because today it was largely in favor of declines after for a bigger part of the day being in favor of advances as well. Most of the sectoral indices, they were in the red today, but we did have some gains coming in from Nifty Media, financials, banking index did well, and the IT pack as well. But a lot to talk about the market moves and individual names on the show today. So here's everything we have lined up for you on the show today. As always, we take you through the top movers and shakers of the day. Today it will be with Sudarshan Kumar. We decode the Nifty's all-time high, tell you why CarTrade slipped in trade. Also, we will put the spotlight on Glenmark Pharma and take stock of the big promoter stake sale in Whirlpool of India. And last but not the least, we delve into the key market events to watch out for in tomorrow's trading session. But of course, the big talking point, it has to be the 14 months time that Nifty has taken to hit new highs. We have Hormuz Patakia with us to decode the rally, the constituents and the contributors as well. Hormuz.
It finally happened, didn't it? And 14 months is what it took. 27th of September of 24 was last time when the Nifty was at these levels, and we finally managed to cross that. But the bigger talking point is that from the lows that we made in 2025, which was in April this year, the index is up 19%, yet we remain underperformers compared to the rest of the globe. You talk about contributors, the usual suspects of Bharat Electronics, Bajaj Finance, SBI, but Eicher Motors is the top gainer here, gains of anywhere between 25 to 45%. But the losers are the bigger here. Trent, street darling at one point of time, has almost halved. Bajaj Auto, Coal India, TCS, NTPC, all of them down anywhere between 25 to 30% in the last 14 months. But if you take a look at the gainers from the April lows, you see BEL is up almost 50%, but the post-GST rally seen in M&M is the talking point here. Eternal has done well, as has Geo Financial Services. But if the Nifty made record highs, the broader markets is where the pain lies. The mid-cap index has done precious little over the last 14 months. The small-cap index is down 7%. And more than the gainers, you look at the losers here. You look at the mid-cap losers, Colgate is down 42%, as is IndusInd Bank, no longer a part of the Nifty. Tata Tech, another hyped IPO, down 40%. RVLN and Ireda, the high-flying PSU stocks of 2023 and a better part of 24 as well, down 40% each. The picture in the small-cap space is even more grim. Ola Electric is down 60, as is Tejas Networks. You look at Jindal Saw, add another 11% to Whirlpool's 46% drop. So overall, the Nifty may have made a record high, but it is the broader markets where the actual underperformance and the actual pain lies.
Well, thank you so much, Hormuz, for joining us and giving us all of the details. Although, like you mentioned, that the Nifty has hit all-time high after 14 months, the rally has been extremely narrow. But moving on, remain overweight on India. That's the word coming in from Jonathan Garner of Morgan Stanley. He adds that he's bullish on financials and the consumer discretionary space.
Market starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year. Going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small, and most of our other market calls are relatively contained. Overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
All right, that's the word coming in from Jonathan Garner, but we also spoke to a whole host of other market experts. Here's how they view the Indian markets from here on.
Especially when we are coming out of a reasonably decent underperformance relative to many global markets around the world as well as emerging markets. And I think we've got, of course, some of the macro starting to look a little better, especially given that environment for a further rate cut both globally as well as in India is starting to look relatively more brighter. And I think alongside which, last but not the least and most important is that we've got some earnings acceleration as well in this quarter compared to what we've been witnessing over the last few quarters.
If you look at Nifty, which is almost at record highs, but if you look at the median constituent of Nifty, it's down by about 8%. Similarly, if you look at the small cap index, it's about 8% away from its all-time high. But the median constituent of small cap index is on an average down by 21%. And if you look at the BSE 500, the median constituent is down by about 18%. So very few handful stocks have taken the index higher, but the breadth of the market has been extremely narrow and poor. And we have seen this in the previous cycles also, that sometimes the index is driven by few names and few stocks, but the breadth has been extremely poor. Now, what can change this? I think finally stocks are slave of earnings and flows. And when we look at earnings this quarter, I think it was a little better than expected. After many quarters, we saw an upgrade cycle rather than a downgrade cycle on an aggregate basis.
Well, that was the word coming from Pankaj Sibirwal, hoping for better earnings growth going forward. But moving on, Sudarshan Kumar now joins in with the top movers and shakers of the day. Sudarshan, over to you.
So amid big volatility in the market, we have seen some of the top movers. We'll start with the auto pack, and these companies will be reporting auto sales for the month of November on December 1, that is Monday. But we've seen a big move. Look at the Eicher Motors. The stock was higher for the last few days, but today it was top Nifty loser, down 3%. But on the other hand, in the two-wheeler pack, Hero MotoCorp was largely flat, up almost 0.2%. Amongst PV makers, Maruti Suzuki has seen a sharp fall, down almost 2%. But come to CV space, both Ashok Leyland and Tata Motors commercial vehicles were up somewhere in the range of 6 to 7%. The reason of two-wheeler stocks largely falling because Vahan registration data is indicating a mixed trend. While it's negative for companies like Bajaj Auto and Eicher Motors, but it's looking positive for Hero MotoCorp. In the CV space, trend has improved over the last few months, even for the month of November. For example, Ashok Leyland sales Vahan registration from November 1 to November 27, 2025 is already higher than the sales that company had reported for November 2024. On the back of that, these companies were in focus. EMS companies were under pressure after a big move that these companies saw yesterday. All the three names, Keynes Technology, PG Electroplast, Amma Enterprises, were down somewhere in the range of 3 to 4%. Might be mainly because of demand concerns. Normally, demand is low in the winter. Now, today was Sensex monthly expiry. On the back of that, BSE stock was in focus. At the end, it was up almost 1.5%. Normally on expiry day, turnover is higher. That's the reason you have seen a move in BSE. PV Fintech, if you remember, Jefferies had come out with a note. PV Fintech had attended that conference. In that, company has said that GST changes do not have major impact on the company, and the volumes have seen a sharp increase over the last few months, or say mainly after GST changes. CarTrade. Today, the stock was down. At one point, it was down as much as 8%, but it closed with a cut of almost 4%. If you remember, on 10th of November, we had reported that CarTrade is looking to acquire Car Deco and Bike Deco. And 11th of November, company had confirmed that news. But today, early morning, company had disclosed to exchanges that those stocks haven't called off. And that's the reason we have seen a downtick of almost 4%. Lastly, Ganesh Housing was in focus. The stock was up almost 5 to 6%. I think this is the wrong stock that we have tagged. So at one point, the stock was higher 8 to 9%. So the news is that 2030 Commonwealth Games. Ahmedabad is going to host that, and company has a huge land parcel there. That's the reason it was up almost 5 to 6% at the close.
Okay, all right. Thank you so much. Some interesting stocks on our radar today that moved across market caps. Let's move on. The US drug regulator has given Glenmark Pharma's Mundra facility an Establishment Inspection Report, or the EIR. The stock gained in trade. Ekta Batra is here with more details. Ekta, how crucial is this facility for the company?
Well, yes, Glenmark is in focus because they have received an EIR, or an Establishment Inspection Report, with a voluntary action indicated status, which is a positive status for their Mundra facility, which is located in the US. Now, why is this important is that basically it clears the facility, which has been under a warning letter since June of 2023. It was recently inspected in June 2025, was issued 5 observations. The US FDA seemed to be satisfied with the reply on the observations and the remediation, and hence have issued an EIR with a VAI status, which means that they have got the green signal for that facility to start commercial operations. And that is exactly what the company plans to do. They have said that they will be looking at commercial manufacturing from the plant. Now, the plant is expected to become more significant in terms of a contributor now that the regulatory issues have cleaned up. In fact, we had Glenmark invest over around $50 million in the facility as well. Now, remember that Glenmark also has had many other regulatory issues that it has been dealing with. For example, their Badhi facility was under an import alert since October 2022. Their Goa facility was issued a warning letter, and their Indore facility as well.
Well, thank you so much, Ekta, for joining in and giving us all of those details as far as the stock as well as the news regarding Glenmark Pharma is concerned. But it's a good time to welcome our guest, Amrish Malika, who's an independent market expert, and Ruchit Jain of Motilal Oswal Financial Services. Good afternoon, gentlemen, and thank you so much for joining us. Well, Amrish, let me come across to you first. You heard Ekta speak about Glenmark Pharma after the very significant deal that the company had with AbbVie. Q2 was a bit of a washout given the kind of multiple one-offs that the company reported. Do you feel the worst is now behind that, and especially with the regulator radar also now getting cleared up?
Yes, I mean, it seems the worst is behind, because if you remember, this warning letter was received in June 2023. And after that, that major overhang was there. Now, with this clearance coming in, I think it's a big positive for Glenmark. So, I mean, the stock can, in fact, move up decently well from here. So, I really don't see much of a downside. And still, I think it could be a good time to still buy.
Okay, still a good time to buy. From a chart perspective, Ruchit, how is the stock looking?
Yeah, hi, very good afternoon. Well, we have already seen a price-wise correction over the last few months. The stock made a high of around 2280 in the month of July, and post that, the stock went through some price-wise as well as time-wise correction. And the good thing is that recently, over the last 15 days, the stock has consolidated above its 200-day EMA only. Means in this entire price-wise corrective phase, the stock has not broken its 200 EMA, which is the long-term support. So that is placed somewhere in the range of 1750 to 1800. So the risk-reward ratio seems favorable post the recent correction to take some counter trades over here. So keeping a stop loss below 1750, which is its 200 EMA, one can definitely create fresh longs on Glenmark at current levels.
Well, thank you so much, Ruchit, for your view as far as Glenmark Pharma is concerned. But another stock that was in focus today, and that was a CNBC-TV18 exclusive, was Tata Power. Remember, earlier today we reported that Tata Power's Mundra Ultra Mega Power project, having a capacity of almost 4 gigawatt, is all set to resume operations in December 2025. In fact, we understand from our sources that the company has now reached an in-principle agreement with the Gujarat state government for a supplementary PPA. So this will now supersede both Section 11 as well as the earlier PPA, which both Tata Power as well as the Gujarat state government had actually given up on. This is a material development as far as Tata Power is concerned, given the fact that since July of this particular year, the plant has not been operational as Section 11 was not extended on account of low power demand due to the extended monsoon season. Now, we reached out to the management of Tata Power. They are yet to respond to our queries. And just to give a sense of how important this particular facility is, in FY25, the company reports this particular plant as part of a cluster of Mundra, coal as well as shipping. They actually reported a PAT of a little over 1,070 crore. In Q2 FY26, when the plant was not operational, the same cluster actually reported a loss of 362 crore, and the company squarely put that weak performance to the fact that the Mundra facility was not operating. When you're talking about this particular development, how important do you think this is, Ambrish? We are hoping, that this particular development does fructify at the start of December. Would you relook at Tata Power from current levels as well?
Absolutely, because this has been an issue for Tata Power for a very long time. And with this fresh PPA, I suppose those issues will be behind them. And again, Tata Power, because of this, hasn't really performed too well in the past couple of quarters. So you should see levels of about 440, 450 for Tata Power soon.
Okay. What about you, Ruchit? How does it look from a technical perspective?
Last 11 months, the stock has been in a consolidation phase, and irrespective of the market up move, we have not seen any kind of trended phase coming in. So 370 to 415 is the range where this entire consolidation has happened since last year's December month. So until we see a breakout above that 415, we believe that in the short term, at least the stock would continue its sideways move. So the follow-up move would be very important. Yesterday, we did see an up move. Today morning, the stock opened on a positive note, but we can see that there is no follow-up buying happening. So from a fresh investment perspective, I think if we get a breakout above 415, 420 going ahead, then we should expect a trended move.
Thanks for that, Richard. Another stock that was in focus was Whirlpool India. The stock was one of the stark underperformers in the session today. This was after the promoter entity, the parent, sold nearly 11% equity. Hormal joins in with more details as to what exactly this means as far as Whirlpool India arm is concerned.
The overhang is not yet over, and 11.5% equity sold today by the promoters in that block deal. The stock also ended 11.5% lower. The initial plan was to sell 7.5%. Then the deal was upsized. The shares changed hands at around 1,041. 1,600 crore rupee was the size. Now with this, the promoter shareholding, which stands at 51%, has now come down to around 39.5%, 40%. Now the street had a bit of a whiff of this because the stock was down around 14% in the last 1 month, but Whirlpool Corp, the parent company, in their Q3 presentation late last month had mentioned that they would be doing this stake sale sometime towards the end of the year, and that $700 million debt repayment has been delayed. Now that should happen in 2026, and that the fact that the plan to bring the stake down to 20%, which they announced earlier this year, will now be done by the first half of 2026. Now, if you take a look at the stock, when the deal first happened in 2024, from there until October of 2024, the stock was up 90%. But from those highs, the stock has corrected nearly 60%. Now, the overhang here is that there is still a chance that promoters would sell further because they still have 40% stake. They plan to bring it down to 20%. So there is more supply that is anticipated in the next 6 to 7 months. On the valuation standpoint, of course, Whirlpool, after the correction, trades at around 26.5 times FY27 PE, which is around about the same level as some of its peers, but cheaper than stocks like Voltas, which trades at around 44 times, and Blue Star, which trades at around 47 times. Now, when you take a look at the shareholding as well, before the stake sale, the promoters had around 21%, 51%. Mutual funds and FPIs had loaded up on the stock. The retail shareholding has remained largely constant at around 7.5%. You take a look at the street view as well. ICICI Securities believes that the recent agreements would lead to brand extension, but will impact margins going forward. Kotak Institutional Equities also sees an EBITDA hit from around 65 crore to 70 crore for Whirlpool going forward. Yet the street remains optimistic of around about 8 analysts out of the 13 having a buy recommendation on the stock. But today the big accident indeed was Whirlpool. The overhang is yet to get over because more supply is anticipated in the upcoming months.
Okay, all right. Thank you so much for explaining that. That was a big mover in trade today. Amrish, as Hormus pointed out, there could be a further supply that could come to the market, another 20% stake. You think that will continue to be an overhang for the stock?
Absolutely. Because when they had first announced about this sale, I think way back in March 2025, the stock had cracked to levels of closer to 900. And post that, we saw a decent rally with an expectation that it would be sold to a strategic buyer or an investor. But then the way they are selling right now at a discount, and I suppose they have another 20% more to go because they will finally hold 20%, and currently they have about 39-40%. So the balance 20% will come to the market sometime sooner than later. And that again is expected to happen at a discount. So I'll not be surprised if we see levels of closer to a 900, 950 or maybe even lower. Keeping aside the fundamentals, keeping aside the PE, which is decent, but then this overhang is surely going to keep pressure on the stock. So I think we'll see, like I said, prices of closer to about 900 sooner than later.
That's right, Amrish. And like the management of the parent entity themselves said, they're actually looking at the valuation arbitrage and looking to exit or divest their Indian subsidiary. Well, thank you so much, Amrish, as well as Richard, for joining in and giving us your views both on individual stocks as well as on the market. With that, it's time for a short break. We'll get you the top corporate voices along with the key market events to watch out for on the other side.
Welcome back. You're still tuned into Markets Forward, and it's time to talk about the big corporate voices of the day. The MD of Prestige Estates told CNBC-TV18 that the base for listed real estate developers has grown significantly, and hence he expects Prestige to deliver 10 to 12% CAGR in terms of pre-sales over the next few years, and it will be driven more by volumes than pricing. On the new labour codes, he said labour costs could rise by 10 to 15% once implemented.
In a CNBC-TV18 exclusive, Axis Bank's MD and CEO Amitabh Chaudhary said that the bank's loan growth continues to outpace the industry, with November trends remaining healthy. He noted that the Insurance Amendment Act has been long expected, and the bank is keen to merge Axis Max Insurance with Max Financial, while also raising its stake in Max Life. Chaudhary added that while the bank remains watchful on the MSME loans, there is no cause for concern at this stage.
And before we wrap, we bring you some key market events to watch out for. Vinny Motiwala is standing by the big wall with the key events to focus for tomorrow. Vinny.
Hi, so first let's start with the global events that we have. In Eurozone, we'll watch out for the CPI data, expectation data that will come in, so keep an eye on that. We have the Tokyo CPI. So Japan is something that we'll be keeping an eye out on in terms of market, unemployment data there, industrial production, as well as retail sales. So we'll see some action on the Japanese front. Domestic market, let's shift to that. India, we'll watch out for the industrial production data as well as the GDP data. That will be key to watch out for. Earnings, we have Advent Hotels International that is reporting their numbers tomorrow. So that is something that should be on your radar in terms of a stock. And corporate action coming from Thyrocare, they'll be trading X of bonus, which is in the ratio of 2:1. We have Autumn Investment, which the board will be mulling for a bonus issue. Patel Engineering, the board also will be meeting tomorrow and mulling the idea about right issue. So that is something that you should keep on your radar. IPO watch list, let's watch out for the listing of Sudeep Pharma. That is there. And in other news flow and other events that we're keeping an eye out on, important update, IEX as well as CERC, the case that had been going on. Now, the Electricity Appellate Tribunal will be hearing that case, which IEX had fined because there was a plea that was challenging CERC's decision. So that case hearing is tomorrow.
Well, thank you so much, Vinny. That's an extremely important case to keep an eye out for, and the share price and the shares of IEX will remain in focus on the back of that. With that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty hit a record high after 14 months. Both markets give up most of their gains, end barely in the green though. Bank stocks lead the rally today. The government is all set to fast-track the incentive scheme to bolster rare earth manufacturing. Sources say the notification is likely in 15 days. Bids will be invited over the next 2 months. That's an exclusive. A Niti Aayog panel proposes scrapping licenses, permits and no objection certificates in a regulatory overhaul. Sources say a high-level committee is proposing prior approvals only for high-risk cases involving national security, public safety and environmental harm. That's another exclusive. Tata Power is likely to resume production at its Mundra plant 6 months after suspending operations due to poor demand. The Gujarat government reaches an in-principle understanding on a supplementary power purchase agreement. Sources say Tata Power could use this as a precedent for pacts with other states. The Income Tax Department launches a new initiative asking taxpayers to disclose foreign assets acquired in FY25 by the end of December. The Tax Department identifies high-risk cases where foreign assets appear to exist but have not been reported so far. Tech giant Apple takes India's competition regulator to court, challenges the law allowing penalties of up to 10% of global turnover for market dominance. The law exposes the company to a potential penalty of $38 billion. Apple's global smartphone shipment could outpace Samsung for the first time in 14 years. Counterpoint Research says the positive response to the iPhone 17 series is a major catalyst. At least 55 people dead and hundreds missing after an apartment complex in Hong Kong goes up in flames. The blaze tears through 7 of the 8 tower blocks. 3 construction company executives arrested so far. 2 U.S. soldiers shot and critically wounded near the White House after an attack by a lone gunman rattles Washington. Officials identify the suspect as an Afghan national who's currently in custody. The U.S. stops processing immigration requests from Afghanistan after the attack. Ahmedabad gets ready for a massive infrastructure makeover ahead of the 2030 Commonwealth Games. Big opportunity for developers with land near game venues, athlete village and Cree transport corridors. The airport link development could boost inbound travel and demand for hotels as well. Well, let's start with the day's market action. The Sensex and the Nifty did hit a record high, but then finally closed the day largely flat. The Sensex crossing 86,000 and the Nifty surpassing the 26,300 mark for the first time, closing absolutely flat. 110 points higher on the Sensex, though, coming off its intraday high. The Nifty Bank up by about 200 points and flat close for the Nifty mid-cap as well. Bank stocks, as you saw there, leading the rally. Hormuz is standing by to decode what triggered the rally today. Hormuz hitting new highs, but finally closing off the intraday lows.
It finally happened, didn't it? And 14 months is what it took. 27th of September of 24 was last time when the Nifty was at these levels, and we finally managed to cross that. But the bigger talking point is that from the lows that we made in 2025, which was in April this year, the index is up 19%, yet we remain underperformers compared to the rest of the globe. You talk about contributors, the usual suspects of Bharat Electronics, Bajaj Finance, SBI, but Eicher Motors is the top gainer here, gains of anywhere between 25 to 45%. But the losers are the bigger here. Trent, Street Darling at one point of time has almost halved. Bajaj Auto, Coal India, TCS, NTPC, all of them down anywhere between 25 to 30% in the last 14 months. But if you take a look at the gainers from the April lows, you see BEL is up almost 50%, but the post-GST rally seen in M&M is the talking point here. Eternal has done well, as has Geo Financial Services. But if the Nifty made record highs, the broader markets is where the pain lies. The mid-cap index has done precious little over the last 14 months. The small-cap index is down 7%. And more than the gainers, you look at the losers here. You look at the mid-cap losers, Colgate is down 42%, as is IndusInd Bank, no longer a part of the Nifty. Tata Tech, another hyped IPO, down 40%. RVLN and Ireda, the high-flying PSU stocks of 2023 and a better part of 24 as well, down 40% each. The picture in the small-cap space is even more grim. Ola Electric is down 60, as is Tejas Networks. You look at Jindal Saw, add another 11% to Whirlpool's 46% drop. So overall, the Nifty may have made a record high, but it is the broader markets where the actual underperformance and the actual pain lies.
All right, many thanks, Hormuz, for joining us. Moving from the equity market action to the rupee, largely steady against the dollar in trade today. The currency remains closer to its record low and above the 89 mark against the greenback. Now, last night, the International Monetary Fund reclassified the rupee to what it calls a crawl-like arrangement after the currency moved more freely. Sources in the money market say a crawling peg is closer to a market-determined rate. The fund went on to say that India is well positioned to allow greater flexibility in its currency, which would help absorb external shocks. The Finance Ministry said that India's economy is on a stable footing on the back of encouraging inflation expectations, sustained public capex and strong rural and urban demand. The ministry's monthly economic report highlighted that the economy is positioned to navigate emerging risks and preserve its growth momentum through the remaining months of this fiscal year. The report further highlights that global uncertainties, including shifting trade policies, geopolitical frictions and financial market volatility, are potential headwinds. The Ministry of Statistics has given us a glimpse of the main changes in store when the GDP, inflation and IIP will be calculated on the revised base year of FY23 from the current base year of FY12. Lata joins us now with the major changes in the formula. Lata, what will this mean? What can we expect?
Oh, well, the conference gave us a lot of fodder saying how they are going to, the MOSPI, the Ministry of Statistics, is going to increase its sources and improve the methodology of calculation of GDP, CPI and IIP. Just remember, the base year is going to be changed from the earlier 2011-12, or rather the current 2011-12. The new base year will be 22-23. But the first CPI will be announced only on Feb 12. Which means two monetary policies don't have to bother about a new CPI. The budget also will not have to bother about a newly calculated GDP. You know, it can throw things out of gear. So both the next two policies and the budget are out of danger of any, numbers being rewritten. The big changes that MOSPI announced is that for non-financial, that is manufacturing and such other companies, they are going to use corporate data activity-wise and not enterprise-wise as it is currently used. Very quickly, to give you an example, for instance, Maruti would be originally and in the counted as manufacturing, but now they will take out manufacturing. If they are doing any trading, they will treat it separately and put it in the appropriate categories in the GDP. Now, this could mean that manufacturing may look a little smaller when the new series comes, but there are this kind of fine-tuning that they're doing. The other thing that the MOSPI said is that they're going to use GST data to corroborate the corporate sector data in terms of revenue, etc. And the GST data will also be used for regional allocation of the GVA. Now, last couple of years, the Ministry of Statistics has also started unincorporated companies survey that is called as-used survey. That will be used to give for the annual GDP calculation the amount coming from the informal sector. You know, the formal sector GDP is counted quite easily. Informal sector will be counted through this. But this data will not be available quarterly. Only the annual GDP can be done on this fashion. The quarterly GDP will only extrapolate the informal from the formal as it does these days. The MOSPI has also told us that for manufacturing, they will use double deflation. There was a lot of criticism about the single deflation. That is, they will deflate output prices, input prices, and then give you the exact value add in the manufacturing space. But for the non-manufacturing space, they will have to continue with either the single deflation method or what they call the single extrapolation method, which is still a very sophisticated and internationally accepted method of calculating value add. Very quickly, coming to CPI, the Ministry of Statistics said that they're enhancing the number of markets, towns and items that they are covering. They're going to include fresh administrative data as well as online data. That's very important. That's a new set of data that they're going to include, since so many of us buy so many things online. Also, they're going to give more granular details. So the number of items for which you will get CPI will be more. The new CPI release, which will come on February 12, 2026, will therefore even look very different because there will be more items. Coming to IIP, the focus is again going to be more healthy sources. For every item, they want at least 4 factories, establishments producing it. And also, they're going to continue to replace, if one factory is not giving them data or it has become non-operational, they will quickly replace it in real time with another factory so that the data is always robust. There is a new way of calculating, more robust real-time way of calculating called chain-based indices. that is work in progress. Eventually, that and seasonally adjusted IIP will also come, become available to us.
All right, Lata, many thanks for joining us. GDP, CPI and IIP all set for a change. Now, the Income Tax Department has launched a fresh drive to track down high-risk undisclosed foreign assets. Timsy standing by with the latest. Timsy, take us through what the Tax Department now intends doing.
Well, the Income Tax Department has introduced, again, a second drive towards undisclosed foreign assets. They said that this is, again, a non-intrusive measure that the government is taking, and this second drive is now called Nudge. It will be on the entire December. The drive ends on 31st December, and they say that they already have a list of about 25,000 high-risk cases that will be targeted through non-intrusive measures, asking them to come up clean on their undisclosed foreign assets. And to be fair, they say, according to sources, what we pick up from the tax department is that the big corporates whose employees have foreign assets and have not disclosed are also onboarded towards sensitizing. They've also onboarded ICAI and many other tax professionals organizations, asking them to speak to their clients, to come on board, take the benefit of this particular drive. And just to remind you, last year again in December, the government had come up with similar drive where they identified about 1,080 cases, which raised a demand of about 40,000 crore rupees till June 2025. So Income Tax Department saying that there is a non-intrusive drive that has been started again against undisclosed foreign assets which have been identified by them through the automatic exchange of information through various countries in financial year 2025, and sources say that they already have a data of about 25,000 such high-risk cases. And if these 25,000 people do not take up this opportunity, then what comes to their demand? Well, Black Money Act prescribes penalty of 10 lakh rupees on non-disclosure of foreign asset, apart from tax of 30% and penalty of 300%, and other consequential other measures such as searches, etc., which government has already taken in cases who did not come clean in the last drive. So this is another measure to try and unearth foreign assets under Black Money Act, which are still yet to be recovered and yet to be identified under the income tax returns. Let's see what happens in this particular drive, which will be on for a month.
All right, Timsy, many thanks for joining us. Now, Tata Power is likely to resume production at its Mundra plant 6 months after suspending operations due to poor demand. Sources tell us that the Gujarat government has reached an in-principle understanding with the company on a supplementary power purchase agreement. Tata Power could use this as a precedent for pacts with other states. Shares of Whirlpool India declined after 11.8% of the equity changed hands via block deal. Sources tell us that the company's promoter, Whirlpool Mauritius, is likely to have sold 7.5% equity worth around 980 crore rupees. The floor price of the deal was set at about 1,000 rupees per share. Now, the Reserve Bank has granted a certification of authorization to Paytm Payment Services, the entity owned by Paytm's parent 197 Communications. It can now operate as a payment aggregator. The company had applied for the permit in March 2020. However, the approval was stuck due to certain compliance-related issues on account of foreign investments in the company. The Enforcement Directorate has arrested online money gaming platform Winzo's founders on allegations of money laundering. Soumya Singh Rathore and Pawan Nanda were arrested after being questioned at the zonal office of the Federal Probe Agency. They were initially sent to a one-day custody after being produced before a local court. The arrest comes after the ED's recent searches at Winzo's premises. The government will notify the 7,300 crore rupee rare earth permanent magnet manufacturing scheme in the next 15 days. Sources tell CNBC-TV18 the government could invite bids for the scheme by the 31st of January. Parikshit is standing by with the details. Parikshit.
Well, the government is likely to notify the scheme for manufacturing rare earth magnets in 15 days. Thereafter, the government could invite bids for the scheme by 31st of January next year. Interested bidders will have to submit a detailed project report to show that they are technically capable. They have either indigenous expertise or they have global technology tie-ups to deliver on the promises they are making. An interministerial group supported by India Rare Earth Limited, Bhabha Atomic Research Center and CSIR will soon be set up to frame the bid criteria, and this interministerial group will choose and select the applications also. Startups, established companies, first-time players are all likely to be invited to bid for the scheme. All applicants would be free to have global tie-ups for technology, but must manufacture in India. The government may consider companies who can invest rupees 1,500 crores in setting up a plant for 12,000 ton of rare earth permanent magnets. Smaller players who can set up capacity for 600 tons of permanent magnets may also be considered. During the consultation phase, 25 companies, including magnet makers, automotive component manufacturers, participated in the meetings. As of now, companies like Entellus, Ashwini Magnets and Midwest make rare earth materials in India, but no one does it at the scale that is really needed, or where you can say there is import substitution. The government seeks to establish rare earth permanent magnet manufacturing facilities in India and build a domestic supply chain to reduce reliance on Chinese imports. In order to strengthen domestic supply chains, Department of Atomic Energy has also asked state-owned India Rare Earth Limited to expand capacity for manufacturing NdPr oxide, which is a crucial raw material for manufacturing rare earth magnets.
All right, Parikshit, many thanks for joining us. Apple has moved the Delhi High Court challenging India's amended antitrust penalty regime. The iPhone maker told the court that the law may be subject to as much as $38 billion in fines. This, as the new regime allows the Competition Commission of India to impose penalties of up to 10% based on a company's global turnover rather than its revenue from India. So Apple taking CCI to court. And staying with news from Apple, it is set to ship more iPhones this year, more than its rival Samsung for the first time in 14 years. Counterpoint Research tells CNBC-TV18 that the iPhone maker will ship around 243 million units this year. In comparison, Samsung's estimate of 235 million units. Apple is also likely to end up with a 19.5% share of the global smartphone market, while Samsung's share will be at 18.7%. CarTrade has said that its proposed deal to acquire CarDeco will not move forward. In a statement, the company said that the two companies had mutually decided not to proceed with the proposed transaction at this stage. The transaction was estimated at over $1.2 billion. Remember, CNBC-TV18 had confirmed that CarTrade was in talks to acquire CarDeco and BikeDeco, that deal falling through. Let's take a short break, but up next, at least 55 people dead and hundreds missing after an apartment complex in Hong Kong goes up in flames. That and more when we return. A panel constituted by Niti Aayog has proposed scrapping licenses, permits and no objection certificates. Sources tell us that the panel has recommended third-party and risk-based inspections. Shivani joins us now with more details of the proposed changes. Shivani.
Well, yes, sources have told CNBC-TV18 that a high-level Niti Aayog panel led by former Cabinet Secretary Rajiv Gauba has called for a complete end to what is described in the country as the inspection raj. The committee has recommended scrapping most licenses, permits and NOCs except in high-risk areas like national security, public safety, health and the environment as well. Under the proposed framework, routine inspections will now move to accredited third parties selected through risk-based computer-generated systems. That's what sources are telling us. Now, the panel is also pushing a new trust-based approach, the Jan Vishwas Siddhant, where any activity not explicitly prohibited by law will not need prior approval. It has also called for stable policies and tax regimes and for every regulation to clearly state the compliance cost for businesses and enforcement burden on the government. And in a major shift, the committee also has proposed that criminal penalties reserved only for serious offences, including threats to national security, fraud or major environmental harm, with a full review of all such provisions across laws. If these proposals are accepted, of course, these are right now just on the proposal stage, they could mark a significant reset in how businesses operate in India and how India regulates its businesses. Back to you.
Shivani, many thanks for joining us. The big international story, at least 55 people have died and hundreds are missing after an entire apartment complex caught fire last night. Officials allege that bamboo scaffolding and foam material used during maintenance work might have caused the rapid spread of the fire. The fire tore through 7 of the 8 tower blocks of the building. Firefighters were continuously trying to douse the fire, attempting to rescue the trapped residents inside the burning building. This incident has been touted as the deadliest fire in Hong Kong in decades. Authorities have said that the firefighters managed to put out the fire in 4 buildings and operations were continuing in the remaining 3. A task force has been set up to investigate the cause of the blaze. 3 men from the construction company, including 2 directors and 1 engineering consultant, have been arrested. Ukraine claims Russia has carried out 41 airstrikes, dropping more than 100 guided bombs across the country. Kiev has also said it hit a Russian plant involved in missile and drone production, along with several other military positions. This comes as the Kremlin called on the US brokered peace talks serious, but warned that Moscow would offer no major concessions to Kiev. 2 US soldiers were shot and have been critically wounded near the White House after an attack by a lone gunman rattled Washington. Officials have identified the suspect as an Afghan national who is currently in custody. The Trump administration has stopped processing immigration requests from Afghanistan after the attack. President Trump has asked Japanese Prime Minister Sanae Takaichi to dial down her stance on Taiwan. As per reports, both leaders spoke over a phone call where Trump told the Japanese leader to not escalate tensions with Beijing. This comes after Prime Minister Takaichi sparked a diplomatic row by suggesting that a Chinese attack on Taiwan threatening Japan could justify a military response. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Welcome to a very special Genomics. The 4 new labor codes notified by the government last week are a huge exercise in simplification. They reduce 1,228 sections to just 480, 1436 rules to just 351, 31 returns, and that's very important, 31 returns that companies have to file to just 1, and 4 licenses to just 1. It has, of course, other employer-friendly rules. For instance, it decriminalizes 65 sections, and it has employee-friendly rules like the eligibility of gratuity after just 1 year of service. There's much more, which is probably well known. But to discuss the implications, I have with me an elite panel, but we are going to discuss 2 very different and specific issues. One, can it help more job creation, which is an economy question, and 2, a very legal question, how does it impact listed companies because of the new gratuity rules, which has to be calculated on 50% of the C2C and not just basic? Joining me are Manish Sabarwal, the founder of TeamLease, Amit Basole, professor at Azim Premji Institute, Somraj Roy, the CHRO, Chief Human Relations Officer at CIAT, and Atul Gupta, partner Labour and Employment Practice at Trilegal. Gentlemen, good morning, and thank you very much indeed for your time. Deeply grateful to Manish, who has had to, who's just landed from a flight, and to Atul Gupta, who has put off a flight. Thank you, gentlemen. Manish, first to you. Give us the macro implications. Do you think small-scale enterprises are the ones that are benefited most?
I mean, the 5 victims of India's labor laws have been MSMEs, they have been backward states, they have been women or labor market outsiders, and they've been farmers, right? The most embarrassing number about India 35 years after reforms began in 1991 is that 45% of our labor force is still on farms. The only way to help farmers is to have less farmers. You can't make farming viable with almost half your labor force. But the high-wage non-farm job creation in India has been limited, muted, and disappointing. And I think infrastructure, skills, and finance have shifted from being a dagger in the heart to a thorn in the flesh, right? They need to get better, but they have improved substantially in the last 35 years. But I think regulatory cholesterol, and a big emblem of that was labor laws, there's a lot other things, is possibly the only explanation why 35 years after reform, in the same period, China has moved 300 million people from farm to non-farm employment. I know I don't want to live in China, but I do admire them moving, 400 million people from farm to non-farm employment. So I think labor laws have held back India in various ways, but they have held back employers. There is no other explanation for 63 million enterprises translating only to 30,000 companies with a paid-up capital of more than 10 crores.
Oh, yes, that's extremely well put in terms of numbers. Coming back to you, Manish, we'll handle the macro question and do the micro question as well of gratuity. Amit, first thoughts from you. Are you convinced, as an economist who concentrates on employment a great deal, that this is clearly liberalizing or liberating India's MSMEs?
So thanks, Tata. It's definitely a very big step, right? It's one of the biggest things we've seen in a while, especially in this field. Now, when we talk about labor laws, you're always balancing 2 things: the rights or protections for workers and making employers competitive. And economics, going back to Adam Smith, we know that employers are in a more dominant position. That's the way the economy works. So the state has to step in to protect worker rights. I think everybody agrees on that. The question for a country like India always is, when you have so much surplus labor and so many workers competing for the same few jobs, how do you enable more job creation? And that job creation will then make the laws more easy to implement. Yes. I think this is the really key point here, and the vision behind the laws is that implementing labor laws when there's a lot of surplus labor in the economy is very difficult. It's very easy for employers to work around those laws because there are workers willing to take up jobs. So tightening the labor market is really critical. Job creation is really critical to enable laws to function. And this, I think, is a vision here. So when we talk about things like fixed term employment, the new things they've introduced, hopefully we can talk more about that a little bit later, or allowing women to work in night shifts, or raising the ceiling from 100 to 300 nationally for the industrial disputes and so on. These are all ways to hopefully enable employers to become more competitive, expand, and create jobs. I say hopefully because many other factors matter. Okay? This is a supply side reform.
Yeah.
Demand matters. Whether the investments will come or not, that depends on many other factors, infrastructure, logistics.
Absolutely.
Labor is not the only issue.
Yeah, no, I take your point. Technology, staring us in the face could be a, job destroyer. In fact, Amit, Manish, I spoke to, it is easy to get big corporates to speak. I had to, struggle hard to get a lot of SMEs, and their single point was life is much easier. ये जो नंबर 2 का काम करता है कैश का, वो लोग तो करते ही रहेंगे, लेकिन हमारे लिए the ability to compete with these informal guys is much better because, as Manish says, the regulatory cholesterol is much less. We have to spend much less time. The small industries are genuinely happy. I can tell you that. Will you create more jobs? I asked them. They said, "Arey, that will depend on our orders." No. All we are saying is life is easier. But they did not commit that they will be able to create jobs immediately. Now, with that, let me come to the formal sector big question, and then I come back to both of you for the economy questions. Somraj Roy, the big question that almost all the big corporates threw at me was, our gratuity bill will go up. Is that your worry as well?
Thanks, Lata, to have me on board. Look, we are still awaiting certain clarifications on various inclusions and exclusions of the wages. Whatever it seems from whatever I have read, yeah, the base for calculation of gratuity is to be upwardly revised. And that would mean there would be certain employee costs going up when gratuity base increases.
Okay. Now, let me put that to Atul Gupta as well. Atul, what is the legal position? There are many companies which say that 20 lakh is the maximum gratuity. I'm not going to pay more than that, and I'm not affected by the new law, which says that 15 days of last pay, basic pay, but not now going to be calculated as 50% of C2C, not just basic. So they are saying it doesn't bother us because our cap of 20 lakh helps. But there are yet other companies, and one of them has written in detail to me, saying that it is important to note that the new labor codes include a specific non-reduction clause. Any existing benefit cannot be reduced. And they also go on to say that companies like ours operate through an approved gratuity fund whose trust deed and rules clearly specify how gratuity is to be calculated and disbursed. Once established, these rules cannot be changed. So they are very clear that gratuity bill goes up as they understand the law now. Manish, since you also run a company, what's your fear? Is this fear of corporate India legitimate?
I mean, in a cost to company world, all benefits come out of salary. They're not over and above salary, right?
Okay.
This is a myth which, Haath wali salary versus chitti wali salary is a myth perpetuated by people in government where benefits are not counted as part of employee cost. So I think that, yes, there may be some transition cost, but over time, we will just include the higher gratuity or whatever benefits the government may prescribe as deductions. I think, we are already the world's highest gap between Haath wali and chitti wali salary. It can go up to 42% for low-wage employees. I don't think people can live on 68% of their salary. So I think that this notion that the government can sort of treat obesity by mandating small sizes. We need higher wages through higher productivity employers. Issuing regulatory creating regulatory cholesterol that somehow people believe raises wages. It doesn't. We raise wages by raising the productivity of our firms, our sectors, our cities, and our individuals.
No, your point is absolutely correct for the bottom of the pyramid, where, it becomes formal. The problem that big companies have, especially old companies which are in existence for 40, 50 years, they have quite a few employees whose gratuity goes well above 20 lakh. And now it will be double almost because the basic pay becomes 50% of C2C. So, Atul, can you rewrite the policy midway?
Yeah, thanks firstly, Lata, for having me over. I hope you can hear me now.
Yes.
Yeah, so there's a lot to unpack here, right? Organizations have to contend with not just the new codes, but also a new definition of wages. Now, there is a common misconception in the market that basic pay has to be at least 50% of the gross. That's actually not an accurate reading. what has happened is that the definition of wages has changed. And under the old law, gratuity was paid only on two components, which is the basic pay and dearness allowance. Under the new law, the definition has expanded, and other guaranteed allowances could also be counted towards the calculation of gratuity. It could be even more than 50%, number one, right? Now, to your question of whether or not I have the ability to limit gratuity, yes, the old provision from the law, which has been repealed, has found its way into the new codes as well. There is an ability to now cap gratuity payments as before. The current limit of 20 lakhs still continue to apply, subject to any future notifications from the government.
Okay. Okay.
Right. The other issue that you
No, the
raised
point is, even if that 20 lakh cap is there, many companies are not respecting that cap. They are paying ex gratia, which is taxed. Now, that ex gratia is suddenly doubled for a section of employees. So can they change?
Yes. So I don't think there is anything in the law which expects organization to continue to pay uncapped gratuity infinitely. Organizations will have to do an impact assessment to see how much their gratuity bill is increasing by and whether or not that's something that they can continue to budget for. If not, I do anticipate, and I don't see a legal bar in organizations capping their gratuity payments and grandfathering the accrued benefits for people who've already accrued a larger sum, but going forward limiting gratuity amounts to the legal limit.
Okay.
Right, which is currently 20.
Got it. Which means a one-time hit as and when the rules are notified is possible. I want to check that with Somraj. Have to take a break. Back in a minute with more questions. Welcome back to the Special Indianomics, which is discussing the 4 new labour codes which are ushering a veritable revolution in the way in which the law is treating employers and employees. A great deal of simplicity, but we are discussing only 2 specific issues. One, the macro question of whether it can generate more jobs, embolden people to employ more, and the other specific issue of how listed companies or large companies may be impacted because of their gratuity bill. I've been speaking with Amit Basoli, the professor at Azim Premji, Manish Sabarwal, the founder of Team Lease, Somraj Roy, the HR guy from CIAT, and Atul Gupta, the legal expert from Trilegal. Somraj Roy, to you, assuming that you cannot cap or you do not wish to cap the extra, gratuity that you'll have been giving your employees earning over 20 lakh, how much will the hit be to earnings or profit? How much is employee cost itself as a percentage of your total cost?
So employee cost as a percentage of our revenues is around maybe 6-7%. Okay. I think the cost will go up by another 2-3%. This is just a ballpark figure that I'm saying, because we'll have to see how basically the gratuity is factored in. Different organizations will have different impact. People with younger workforce will have lesser impact, whereas those, as you rightly said, having long tenured employees will have a higher impact. So that's my take. So we'll have to wait and watch. And I once again repeat, what comes as an exclusion and inclusion and what forms the base for 50% is going to be the factor which will determine how it will pan out, Lata.
Okay, so assuming it is made mandatory now, okay, notified this year, is there a likelihood that there will be a hit to P&L? If it is, how much is it? Is it like, the total cost goes up by a few basis points as a percentage?
Yeah, it will obviously. I mean, it is implemented from the 21st of November.
Yeah.
So I'm sure there is going to be a retrospective impact to it.
Okay.
And the cost will go up by 2-3% at least. The minimum, that's what I'm saying.
Okay.
It could be hovering anywhere between 3 to 6%.
Okay. Fair enough. Atul, you will agree with that number that even if it is, life continues the way it is, it's going to be a small percentage of total revenues.
Yeah, I mean, it's going to be very organization specific, Lata. But like you correctly said, long tenured employees will potentially be in the category with the highest exposure as compared to the employees with lower tenure. And it's all going to depend on what organization's overall size is, right?
Okay, yeah, absolutely. So, if total cost, as Somraj Roy says, is 6% total employee cost, what will gratuity be as a percentage of that 6%? It might be minuscule. So any incremental rise in that could be just in basis points is what people are guessing at this juncture. Okay, now, gentlemen, thank you very much, Roy and Gupta. Let me get the macro question in. Amit, a lot of MSMEs were not expanding simply because that will mean more things to register, more submissions to be made. With that, binding constraint gone, do you see MSMEs expanding faster?
Well, this is a difficult question. I mean, I would put it, easing the regulatory environment is a necessary condition for having a vibrant MSME sector. I wouldn't say not MSME because the problems for M are very different from S and M. So we tend to club these together, but they're actually very different things.
So the SMEs have a better deal now.
So if you talk about firms that, let's say, are already formal 20, 30, 40 worker firms who want to expand further, I think those are the ones that have the capacity to create a lot of jobs, are vibrant and so on. This is a necessary condition, I think, no doubt about it. It is not a sufficient condition for the simple reason we've discussed that many other factors matter for whether we will grow or not. But I think this was a good, it was a long time coming and it's a good thing to do. I'll just point to one particular interesting aspect of it, which is this category of fixed term employment. And what is not clear to me is this sort of stands somewhere in the between of permanent employees on the one hand and third party contract workers on the other hand. So the expectation is that firms will now have the ability to hire a lot of fixed term employees without worrying about long term implications for them. And they can in-house them. They don't have to do third party. But they will have the same benefits as permanent. the idea.
Okay.
But it's not clear to me whether employers will be incentivized to do this because the third-party contract system still exists.
Yes.
Right? So you can always go around and do that. Not clear why they would choose to in-house. Maybe other panelists can enlighten us
Yeah,
on this.
Manish, yeah, that question straight away to you. Do you see, less of contracting out and more people taking employees on their roles as fixed-term employees?
I think different companies will do different things. I don't think you can model it, depending on which sector you're in, depending on how your costs are fixed and how they're variable, how much seasonality you have in your demand side. So I think that modeling is really not important. I think the implication of the labor code to your first question is yes, I do think that MSMEs will create more jobs. I know labor inspectors used to paraphrase Talon and say, show me the company, I'll show you the crime. It is quite obvious that that level of criminalization, I mean, those 75 provisions which you talked about, which have been removed, actually led to almost 8,000 criminal compliances. One provision can be used 8,000 times across state and central laws. So the implications are quite substantial. So I would, obviously many of the other things have to happen. But I think, the biggest outcome of this is allowing chief ministers to create fertile habitats. Now, India can't be run from Delhi. There's no such thing as India's labor market. In fact, there may be no such thing as Karnataka's labor market because Bangalore and Mysore have completely different sort of situations. So my sense is, I think the delegation to chief ministers, the decriminalization, the deregulation and digitization all will lead to higher job creation.
Okay. And do you also believe that, there were some employers, large employers telling us that, the unions would come and scare us that this guy is working here, he's not on your rolls. That kind of strong arming by the unions may not happen. Is that something you heard as well? Because you deal with a lot of companies.
Well, the criminalization of politics and the politicization of trade unions has been a toxic combination. Why is the biggest factory in India only 55,000 employees in a single location? The biggest factory in China is 600,000 people.
Okay.
I mean, there's nothing cultural about scale in India. So I think that the regulatory cholesterol was weaponized by people to basically keep most of our companies dwarfs rather than babies. Dwarfs are small that will stay small. So I think that the toxic combination of trade unions being overly politicized and politics being overly criminalized in backward states is now something that will be blunted. So if backward state chief ministers want to raise the Industrial Disputes Act from 300 to 1,000, they don't have to talk to Delhi anymore. I know a state which is considering making it 10,000.
Okay.
Because they have nothing to lose and there are no trade unions. There's their economic wasteland. So I think the competition between states and provinces that was the sort of China's genius may sort of be enabled by these labor codes also.
Okay, we definitely live in hope. Just a final question to SIAT. Do you think because things have become simpler, you don't have so many submissions, eight submissions reduced to one and so many sections removed, people will employ more, you think, Somaraj Roy?
Yeah, very much. I mean, it's a very welcome change. Things have been simplified. Obviously, bringing in a lot of gig workers and other workers also into the fold of social security and appointment, etc. This is going to give a strong boost. And obviously, the employment will go up in some way or the other because flexibility has gone up.
Okay, yeah, go ahead.
Sorry, I just had one view to make, Lata, on one of the comments that was made here.
Yeah.
So there is also an important change that organizations need to take into account with respect to the engagement of contract labor. The codes now do say that engagement of contract labor in core activities is prohibited.
Okay.
So that can have a bearing on the comments that were made earlier by Mr. Roy about the fact that why would people want to take more people in-house? Because now even engaging contract workers in core activities can be a big problem for organizations and they would potentially violate the code.
Okay.
Right. So that is going to have a significant impact on how organizations are designed.
Okay.
And what people do permanent roles, what people do fixed time roles, and what people do contract roles.
Okay, this opens a new line of debate for which I don't have the time, but I can give a few seconds to Roy and Manish who are involved in this. Manish, you want to add?
But there's no change to the status quo for the last 50 years in the court.
Okay. All right. You're not convinced. But Mr. Roy, core jobs cannot be contracted out. Is that a big deal?
Core jobs, yes, cannot be contracted out, and we'll wait and watch. And of course, in the contractual employees, it would bring somewhat rethinking. However, as Mr. Gupta also pointed out, I think the fixed term employees being brought in also adds to a lot of flexibility.
Okay.
To your question whether employment could go up, yes, there is a lot of flexibility in the system today.
Okay. On that positive note, we have to call it a day because we're out of time. My deepest gratitude to Manish and Atul Gupta for, one for taking the call immediately after the flight and another for delaying the flight. My thanks also to Amit Basole and Somraj Roy. The positive is that both small, medium, all of them, small, medium and large companies are saying that they feel the regulatory burden less, simplification, flexibility, and therefore they could employ more. Clearly positive comments coming from Indian industry. Thank you very much for joining me, all of you. That's it on this edition of Economics. Thanks for watching.
Hello and welcome to News Centre. I'm Parikshit Luthra. After 20 years, the Commonwealth Games is set to return to India in 2030. The year is of great significance for the Games as it will be their centenary year. The Games were first held in 1930 in Hamilton, Canada. In addition to confirming the host for 2030, Commonwealth Sport has announced that 15 to 17 sports will feature in the 2030 edition. The process to finalize the remainder of the program will start next month, and the full centenary games lineup will be announced next year. CWG is not new for India. The country last hosted the games in 2010. However, that edition was marred by cost escalation and serious allegations against the then government. According to the CAG report, between an initial estimate of 1,200 crore rupees and the final expenditure of nearly 18,500 crore rupees, the cost escalated roughly 15-fold. The primary reason for the increase was that the initial budget accounted only for renovation of existing sports facilities. In reality, all sports facilities had to be built new. Other factors included beautification, infrastructure upgrades, expansion of public utilities, and massive security-related expenses. The cost of preparing teams for the games was unaccounted for, but was later allocated nearly 670 crore rupees in 2008. In addition, delays in planning, tenders, awards, execution, a failure to utilize a 7-year window between India winning the bid and hosting the games appropriately also pushed up the cost. Delays led to short-circuiting of procedures. High cost has been a problem and has led to some hosts pulling out of the games as well. Durban previously abandoned plans to host the 2022 edition, forcing Birmingham to step in. Meanwhile, for the upcoming 2026 games, the Victoria government, which is Australia, was appointed to host, but it dropped out a year later, stating that project costs had tripled and were too much to bear. Countries such as Malaysia and Singapore also declined to show interest. Eventually, Glasgow agreed to host the Games only after reaching an agreement with Australia over funding. At present, the 2026 Games in Glasgow are projected to be a scaled-down event using fewer venues and featuring only 10 sports. And the estimated cost for this game is around $170 million. To discuss this, we're now joined by former Sports Secretary Rahul Bhatnagar. Now that Ahmedabad is set to host Commonwealth Games, Mr. Bhatnagar, can you tell me what goes into hosting such games and what really would be the cost involved?
Well, thank you for having me. And first of all, I'd like to congratulate the Government of India, the Indian Olympic Association, the city of Ahmedabad for having won this bid, because I know that the proposals of every country go through a great deal of scrutiny at the level of the Commonwealth Games Federation, as well as the participating nations. So we are all very proud that India has been allotted these games after a lot of competition from others. Now, coming to your question, that what would be involved in the organization of these games? Well, as you know, the multidisciplinary mega sports event is really a very big affair, because simultaneously we are going to have the competitions in so many games. I don't think the number of the games have been finally decided which are the games to be held, but there will be, I think, at least 15 to 18 games which will be held at Ahmedabad and the near about areas. Well, I think the first thing is that from my experience of the earlier Commonwealth Games is that we must constitute the organizing committee at the earliest. And that is very important, because the things start rolling once the organizing committee has been constituted. I think the next step would be the signing of the host city agreement, which would be signed between the Commonwealth Games Federation, the Government of India, the Indian Olympic Association, and the city of Ahmedabad. So the organizing committee may become a signatory later once it is formed, but I think the first step is this host city contract, which has to be signed. And the preparations basically involved so many different facets that it really is an organizational challenge for any government, for the IOA and the other stakeholders.
Right.
Well, from what I have seen, that basically the organization of the games can be put into 3 or 4 major categories. First of all is the development of the sports infrastructure. That involves, developing the competition venues as well as the training and practice venues. We'll we have to identify where we are going to have these various games, and it is possible that for a number of sports, we do not have that infrastructure of the competition venues. So competition venues will have to be maybe, newly created or upgraded. So that is one very important part of the whole exercise. And then there are a lot of non-competition venues which will have to be developed, like, as you know, the Games Village, then the International Broadcasting Center, the main press center, Central Logistics Center, Central Accreditation Center. Then upgradation, this is also very important, upgradation of city infrastructure in Ahmedabad, that will also will have to be undertaken, because there'll be so many spectators, so many people, so many tourists coming. Then we have to provide easy access to the sports persons, to the sports venues.
Mr. Bhatnagar, that brings me to my next question. When it was 2010 Commonwealth Games, and before that, when we had given our bid, the initial cost that we had planned for was around 1,200 crores, but eventually we saw the cost escalating to over 18,500 crores. How do we prevent such a situation and make sure that we project the costs, we do it efficiently, and we do it in the fastest possible manner?
This is a very important question, and this is not only true for events held in India. This is internationally true, that in all such major multi-sports mega events, the costs over the period of preparation, the costs keep going up. And this has happened, it happened in London when the Olympic Games were held. It happened when we organized the Commonwealth Games. So we have to be careful. The better planning we do, the more realistic planning we do, instead of immediately trying to cut costs. That's a general tendency that happens, that whenever proposals are put up, there is a tendency to reduce the cost. So we have to be very careful, even to whoever is scrutinizing them and who is evaluating them, to see that the unnecessary cuts in the budgets are not done. And it is a fact that nowadays, with the excellence that is required in all the sporting facilities, especially, these are all under the scrutiny and the watch of the Commonwealth Games Federation and International Federation, because they have to make sure that each and every venue where a competition is held is of the international standard, so that if any world record or Commonwealth Games record is created, so that then that is something which will be acceptable all over the world. So from that point of view, as far as the costs are concerned, we have to realistically estimate the costs, and one should not shy away from the fact that over a period of time, if the costs do go up, and if they go up realistically and justified, then there's nothing, I don't think there's anything wrong in that.
Okay, and what do you think should be the legacy of such games, so that the infrastructure that is built is used, and perhaps we have some amount of return on investment that we have done in organizing these games?
Legacy planning is a very important part of any games. We have seen it internationally, that stadiums and big sporting venues which have been created, they just go to the dogs after the games are over. And they are expensive, they are burdensome, and of little use afterwards. So that is a thing that is happening in after most of these big events. So that planning we have to do very carefully. And the important thing is, we have to link those sports venues which we have created to sports development, maybe involve the private sector. That is important, because we have to think about the maintenance costs, which are very heavy. So where will they come from? So it's important that we involve the private sector in that. We should convert some of these mega sporting complexes which we make to be able to host different sports. For example, if there is a big stadium which is only meant for athletics, so we have to find a way that we can carve out some areas for other sports also, so that, and partial use for revenue generation to fund the maintenance, etc. So that is important, that planning has to be done very carefully right from the beginning. And one more thing which is very important, these big stadia, etc., which we build, we had worked out last time also the cost of the seating arrangements. And if you compare that to the cost of the playing arena, the cost of the seating arrangements and other associated infrastructure is so many times higher than actually the cost of the playing field. So we have to look at that also very carefully, that if to the extent we can minimize the cost on all these external things like the seating, etc., and be able to create more after the games, maybe create more playing areas so that they can be fully utilized and used for development of the sports in the country.
Mr. Bhatnagar, I would also like to ask you, what's the lesson that we can learn from what's happened in the past? Durban had previously abandoned plans to host the 2022 edition, forcing Birmingham to step in. Australian state of Victoria in 2022 was appointed to host the 2026 Games. They dropped out a year later, saying that the project cost has increased and it's too much to bear. Malaysia, Singapore did not show any interest. Glasgow was chosen, but only after Scotland struck a deal with the Australian authorities for funding and also got funding from the Commonwealth Games Federation. So currently, the projected cost of the Glasgow Games is $170 million and $130 million is coming from the Games Federation. What is the lesson that India should take?
You see, all these mega multidisciplinary sports events, the cost is really very high. I know at the international level also there is a debate on this, and there is a lot of discussion how the cost should be reduced so that countries who are not able to put in so much money are still able to host the games. But I think it is a fact, and we must accept it, since we have gone and bid for the games, that it is going to cost us quite a bit of money. And that money is not going to be generated out of the revenue, out of the receipts from the games, whether it is sponsorship, whether it's ticket sale. And in fact, from what I remember, that the concerned government has to underwrite that if there is any shortfall in the organization of the games, then the country's government underwrites the balance amount. So we have to be prepared for that. But once again, now that we must look for sources, like you said, that if the Commonwealth Games Federation can also assist somewhat in the cost. But ultimately, we should be prepared to bear the cost of the games, albeit we should try to reduce the cost as much as possible. But there are certain things, which cannot be reduced. There's so many aspects of these games, like security arrangement, infrastructure for tourists, because a large number of tourists will be coming. They'll require hotel rooms, then communications, all those things. So we should be prepared to bear the cost, but at the same time, we should try to minimize it to the extent possible and seek assistance from the international sports bodies to assist in organizing the games.
Mr. Bhatnagar, my final question to you would be, if, according to the CAG report, we ended up spending over 18,000 crores in the 2010 Commonwealth Games, what would be the lesson from these games? A lot of questions were raised about the cost escalations, delays, how efficient the entire system was. What would be the big lesson from there which we must avoid? And are we going to end up spending more than 18,000 crores? What would be your estimate?
No, I cannot make any estimate at this point of time. Before I close, just one thing I'd like to say, one lesson that we learned after the games is that, it appears that we have a lot of time to organize the games. But that isn't true, because the number of things that have to be done is really phenomenal. So the earlier we get started, and the first thing I think should be the earliest we constitute the organizing committee so that it gets to work, and then form at the apex level a group of ministers in the government of India and a group of ministers in Gujarat to oversee the activities, so that we have quick, the approvals are quick and things start moving on the ground as quickly as possible. I think that's very important.
All right, Mr. Bhatnagar, thank you very much for joining us, giving us that comprehensive perspective on what will really go into organizing these games in Ahmedabad in 2030. It's an organizational challenge, and as you said, we must begin as soon as possible. It's time for a short break, but coming up on the other side, a day after the Cabinet cleared the 7,280 crore incentive scheme for rare earth magnet manufacturing, the centre is moving to fast-track its rollout. We discuss that on the other side. Welcome back to News Center. A day after the cabinet cleared the 7,280 crore incentive scheme for rare earth magnet manufacturing, the centre is moving to fast-track the rollout. Sources tell CNBC-TV18 that a notification is expected within 15 days and bids could be invited by 31st of January next year. Interested players will need to submit detailed project reports showing technical capability, indigenous expertise, global tech tie-ups. An interministerial group supported by IREL, Bhabha Atomic Research Centre and Council of Scientific and Industrial Research will be constituted to frame the eligibility norms and evaluation criteria. The government is likely to consider proposals from companies ready to invest 1,500 crore rupees for a 1,200-ton plant, while the smaller 600-ton projects may also be assessed. Around 25 companies participated in the consultation phase, including magnet makers, auto component firms as well. Currently, only a handful of companies, including Entellus, Ashwini Magnets, Midwest, make rare earth materials in India. The government wants to establish rare earth permanent magnet manufacturing facilities in India and build a domestic supply chain to reduce reliance on imports. According to official data, India's rare earth imports rose 23% from FY20 to 2,270 tons in FY24, with 65% of those imports coming from China. Joining us right now is the Managing Director of Sona Comstar, Vivek Vikram Singh. Thank you very much for joining us, Vivek. Could you give us a sense if Sona Comstar has a plan to enter rare earth manufacturing, and would you be interested in applying for this scheme?
So this is a great policy. As you know, we are India's largest rare earth magnet consumer, importer. For us, secure supply chain is very important as we make more and more traction motors for the future as India electrifies. We will play a part in this policy in some form or the other, as a primary applicant or a secondary applicant jointly with somebody. But we are very interested, and I genuinely think this is one of the best policies to have come out in recent years, because the criticality of rare earth magnets is immense. I mean, it can be measured by the fact that China, by doing rare earth magnet export control, got US back to the negotiating table and almost made them submit to most of their terms. How powerful that leverage is, you should know that how important the commodity underlying that leverage would be.
Absolutely. Vivek, could you also give us a sense of what is the kind of capacity India needs in the next 5 to 7 years if we really want to be independent? And also, what is the kind of technology that we would need in the country? Do we have that kind of technology in the country at all?
Both great questions, Parikshit. So one, as of today, India imports about 3,600 tons of rare earth magnets. I think some of it was replaceable by either lighter rare earth magnets or ferrite magnets. And now the necessity has forced some people to switch. People have switched. But I would say, given the rate of electrification that we are seeing, in 5 to 7 years, India would need about 6,000 tons. And I think the government has been very far-sighted. They've taken inputs from the industry. We as a company, I personally have given my inputs to various ministries on this subject. I think that is why we are planning 6,000 tons. Second is technology. As you know, outside China, there are only 3 or 4 companies that have the technology. They are either in Japan or Germany. So it is very small pockets of excellence, and the technology required is actually quite complex. First process is the metallization, which is probably easier, but from the metal to magnet, that technology is where the tricky part is.
Right. So you're saying that there are only a few companies around the world who have this technology. So global tie-ups will be extremely crucial for the success of any such scheme. Are the incentives which have been pointed out, are they enough right now for a starting point?
So the OPEX incentives are more than enough. Frankly, they are exactly on the lines of what US has done. And again, I have to praise MHI, Mr. Rizvi, Dr. Qureshi, the Niti Aayog people, Ishtiaq sir, they've done a brilliant job. Actually, the price differential is about $30 per kg, and I think the subsidy covers it adequately. I could argue, as someone interested in the scheme, that the capex subsidy is a little lower than we would have liked. But then we are free to get incentives from states or other governments. And the second point you mentioned about international cooperation, look, it's in the best interest of a lot of countries to collaborate on this. So Japan has the technology. We have the rare earth oxide stock. We have the feedstock. They don't. Australia has the heavy feedstock, but they may lack the light or the technology to do it. And obviously there is US involved to direct us all in this initiative. So if you look at the Quad Rare Earth Initiative, all 4 countries have a part to play here so that we can build a supply chain that benefits all of the 4, and we can have an independent parallel supply chain to the one that is currently dominated by China. And I think India plays a pivotal role here because we have the largest feedstock of neodymium oxide, and if we can step up our mining, we can increase it manyfold.
Right. Now, what would be your recommendation to the government from here on? We do not have refining capacity in the country right now. In terms of getting the equipment needed to manufacture these rare earth magnets in the country, also to get the raw materials in time at the best possible rate, would you also request the government to bring down the basic customs duty? What is the duty structure right now? And does that allow companies like yours to bring in equipment?
So, one, Parikshit, we have given all our recommendations to the government in multiple fora, and we have been not just listened to, almost all of the points that we have made, which were sensible, the government has already incorporated. Raw material is not an issue, as I keep saying. IREL Limited is producing about 1,300 to 1,500 tons per year of neodymium oxide. They can always produce more. We did not have any real use for it in the country, which is why they weren't stepping it up. It is the equipment, you're right. There is equipment available. It will be Japanese and German equipment. I think that's where our differences are, that the capex subsidy is lower than what we would have liked, because China has also restricted the export of magnet making equipment. Hence, the capex will go up. Right? But no other recommendations are remaining. I think government gets a lot of flack from industry for half-founded reasons or sometimes just selfish narrow interest. The government has to listen to multiple parties and figure out something that's fair for everyone. I think they have been exemplary in how they have gone through the consultations for this policy, how they listened to every quarter and figured it out.
Right. And finally, could you tell us how the restrictions of rare earth magnets imposed by China are impacting Sona Comstar right now? We believe that there were some importers who got those licenses, but those shipments have not reached the shore, the Indian shore as yet.
Yeah, Parikshit, and if you actually talk to the 4 people who got the licenses for what quantities, it is the minutest fraction you can think of. I mean, out of the 3,600 ton that we used to import every year, I don't think it's even a percent, some basis point. So it hasn't really slowed. It remains the same. As we mentioned in our earnings call last quarter, we have switched to mostly light rare earth magnets. We are also attempting to do ferrite magnet-based motors, and we will keep trying to diversify away and move to technologies or solve through engineering what is primarily a supply chain problem.
Right. But you've managed to ensure that the production remains on track, or you feel that production is below targets?
No, I think production's actually not just on target. We have also gained market share because, not to boast, but if you have engineering capability and you can move faster than others, you can actually take their share as well.
Vivek Vikram Singh, thank you very much for joining us here on News Center. With that, it's a wrap on this edition of the program. More updates on the other side.
Talk Money.
Hello and welcome to Let's Talk Money. I'm your host, Surabhi Upadhyay. India has finally ushered in a new era of labour regulation, a long pending reform that is aimed at improving worker welfare and boosting the ease of doing business in the country. On the show today, we will understand how exactly these 4 new labour codes impact us, corporate employees, what happens to our salary structures, what happens to our take-home pay, and do our retirement benefits actually improve? Well, joining me to shed light on this very important subject are Sonu Iyer from EY India and Vaibhav Bharadwaj of Khetan & Co. Ladies and gentlemen, thank you so much for joining in. You know, last couple of days, so much has been said about what happens, and there's been a lot of talk of whether we get our gratuity early or not, and whether PF goes up, but our take-home salary comes down. So plenty of excitement for obvious reasons. So thank you for joining in for this. And I want to start by getting your opening thoughts, because this indeed is a landmark reform. And these codes were actually, I think, set up in way back in 2019 or 2020, if I'm correct. Sonu, so let's open with you. Your first thoughts.
Thanks, Ruby, for having me on the show. So as you rightly said, long time coming. We've ushered in an era of new labor laws, which was really needed. I'd say in one word, these are game changers. It is the beginning of the new era of labor laws, which was much needed to modernize our workplace in sync with the modern workforce, as also making much more stability, uniformity. I mean, the whole idea of 29 fragmented laws coming together, being compressed into 4 labor codes. Simplification is the game. Universal wage, trying to bring in social security for the informal sector, gig workers, platform workers, which is the modern workforce. So, game changer for women, allowing them to work for night shifts with their consent and ensuring safety and ensuring that security is there, transport is arranged. So, and gender neutral policies, equality in recruitment at the time of salary fixation, retention. So that gender neutralization is a great thing and really sets the way to get to a $10 trillion economy that we want to become.
And change in our labour laws has been one of the long-standing demands from India Inc. as well, Vaibhav. I'm sure you'll agree. So what do you think? I mean, now that we have these 4 new codes, are they more industry friendly or are they more employee friendly, or do they manage that fine balance?
No, I think it will be able to. It's a balanced reform, and honestly speaking, it's a very welcome change and a welcome reform. Because if you look at our legislation, some legislations even date back to our independence era. So, and of course, given the fact that over a period of time, the businesses have changed, the business model have changed, but unfortunately, the dated legislations never thought through about these legislations. And that was one of the reasons why there were several legislations specifically as far as labor is concerned. And with these changes coming in, of course, there will be uniformity. But still, there is a long way to go. It's a long journey because implementation is the key aspect. As Sonu has also pointed out, there has been a lot of welcome changes, specifically with respect to recognition of gig workers, gig economy, because gig economy has grown exponentially in last 6 to 7 years. And the biggest issue was that the gig workers were never protected. There were no laws regarding gig workers, and now with labor codes coming in, there have been something in place wherein, yes, there are safeguards in place. They will be subject to certain benefits. There will be health insurances and so far. So far, it's a welcome change, but the biggest challenge is on the implementation part.
Yeah, and we need to see if all the supporting legislation, how quickly it gets underway, when are the final rules notified, actual rules and the details that will operationalize these codes. And there are 4 codes, by the way. So let's just have that graphic up on your screen. And a lot of these changes that we're speaking of, whether it's women working at night, whether it is the definition of wages itself, all of them come under one of these 4 codes. The first one is the Code on Wages 2019. Then there is a Code on Social Security 2020, the Industrial Relations Code, the Occupational Safety, Health and Working Conditions Code, which among other things, by the way, one of these codes, I think is the last one, which mandates health checkups for employees who are over 40 years of age. So lots of new things coming in and generally lots of good things for employees. But Sonu and Vaibhav, I want to start right there. The definition of employee and the definition of worker, right? Just tell us from our perspective, and a lot of people who watch this show they are working with the corporate sector or maybe even with the public sector, but they end up being salaried employees. So do we need to go into this nuance of employee, worker? Is there anything new that we should be aware of? Sonu?
So, definitely we need to focus on this change. Definition of worker is same as the definition of workman under Industrial Disputes Act. Why this becomes critical is the worker being defined across all codes uniformly is to say that anyone who's not in a managerial or supervisory role is likely to be treated as a worker. If someone is not in a managerial or supervisory role, will become a worker, and therefore job descriptions, roles and responsibilities all need to be well defined to ensure who's an employee, who's a worker. Because workers have additional benefits, they are entitled to overtime. They get additional compensation on being asked to leave. So there are benefits that are attached to workers, which we need to be mindful of.
This is important. Vaibhav, come in on this, because even in corporate organizations, I mean, if I'm not a team leader, if I'm a team member, and therefore I don't have any managerial responsibility, then do these new laws mean that I'm a worker? In which case, like Sonu was saying, then, overtime pay, a lot of other benefits come into the picture. So what's the interpretation?
Case as well, because worker is equivalent to a workman under the Industrial Disputes Act, which was the erstwhile legislation. So yes, on-ground role and responsibility and actually what the employee is performing on ground is the key factor to assess whether a person is a workman or not, or worker in the present case. And now if you look at employee versus worker, employee is a larger definition, or it's an umbrella definition under which a worker would fall. So yes, there are certain legislations and there are certain provisions which will only be applicable to worker, and such as retrenchment compensation, which was earlier in the Industrial Disputes Act and now it's in Industrial Relations Act. So that will still extend, but that would only be for worker. So there has been no change from that perspective. Yes, but they have aligned the definition with what was in the erstwhile legislation.
And what about overtime benefits? I'm sure that's a phrase that caught everyone's attention. But does anything change? And I'm talking about, again, this question pertains to salaried employees who do not have managerial roles, who are in execution roles. So what about provisions of overtime?
So I'd say that workers are entitled to overtime, and overtime is 200% of your wages. So it is not everybody who gets overtime, it is. But I think the other good thing that has happened is rationalization of working hours. So the overall governance around 48 hours in a week has been maintained, but there's much more flexibility for the employer to be able to set working hours according to that. But a lot of work needs to happen for harmonization of all of this, because state governments will come out with their own specific rules. There are already Shops and Establishment Act which have working hour conditions, etc. But work, as we spoke about earlier, the good thing is that the framework has been given, but a lot more needs to happen from a detailed perspective in operationalizing all of this. But yes, the codes say that working hours will be capped at 48 hours in a week, 125 hours in a quarter, which is towards rationalization and ensuring there is much more governance around working hours.
Okay, all right. So that's something that we're going to watch out for, all the final rules as they are operationalized. Now we come to the crux of this, the definition of wages and the 50% cap, which has been now imposed through these labor codes when it comes to exclusion. So we need to start understanding our salary structure very carefully. So Sonu, if you could just illustrate this, because anyone's total cost to company has a lot of components. There's a basic, there could be an HRA, there could be a special allowance, etc., transport. Will salary structures need to change because of the new codes?
Okay, I'll answer this in a way. Right now, in our sort of the outgoing labor law framework, definition of what should be considered as a basis for calculating benefits was different for different things. You had a different way to compute gratuity, you had a different way to compute leave encashment or other retrenchment compensation, etc. So the reform is to have a consistent definition of wages across all such retirement benefits and payments, so that we have consistency and nobody uses different this thing. Now in a salary structure, what they're saying is that the employers will also have to look at it from a perspective of workers' right being protected, that exclusions that can be excluded from the definition of wages to compute benefits will be capped at 50%. So like we have exclusions like house rent allowance, conveyance allowance, statutory bonus. All of these are excluded from the definition of wages for computing, gratuity, etc., as per the new law. But the cap is at 50% of these exclusions are permitted only.
Sonu, let's take an example. Your numbers always help illustrate this point. If we can actually just break this down, like I said, someone will always have different components to that salary structure. So how will this 50% cap be calculated, and what could be the change in the wage itself? If you could give us one or two examples.
Okay, so if you would want me to look at an example, I then have to look at my notes. So base salary, say if I have basic salary of 20,000 and I have a house rent allowance of 10,000 and a conveyance allowance of 8,000 and a special allowance of 12,000, which adds up to 50,000, right? Now, if I were to say that my total salary is 50,000, let's look at it as per the definition. And right now on example 1, what can be excluded from the definition of wages? House rent allowance can be excluded, conveyance allowance can be excluded. So my exclusions are 18,000 rupees. What is 50% of 50,000, which is the comp salary? That is 25,000. As per law, I will be able to exclude from the definition of wages whatever is the amount of exclusion or 50% of salary, whichever is lower. So in this example, it's 18,000, which is excluded. For the remaining, you have to pay, compute gratuity and benefits on that definition, which is basic and allowance, right? Earlier, many of these allowance benefits were computed only on the basic salary. So to that extent, there is a cost increase that is happening for the employer. You look at the second example, which is where, which is more telling, where it brings out what is really the change. When I'm talking about the fact that, if my basic salary is 20,000, the house rent allowance is 14,000, conveyance allowance is another 14,000, and special allowance is only 2,000. Now, if I add up the exclusions, which is HRA and conveyance allowance, that adds up to 28,000 in this example. Now, if that is the case, if you remember the 50% of the total remuneration, 50,000, which is only 25,000 rupees. So when I compare 28,000, which is my exclusions as per the structure, with the 50% of the total remuneration, I will be capped at 25,000 only. So irrespective that my HRA and conveyance allowance are adding up to more than 50% of CTC, but as per the new definition, my exclusions will be capped at 50% and rest will be added back to basic salary and allowances to compute the benefits.
So essentially, in cases where the exclusions have been very high and the basic salary has been low, that's where there's likely to be a change. And some of those high exclusions will be plowed back from the exclusions bucket into the wages bucket. So the actual wage ends up being higher. It cannot be lower than 50% of total compensation. Got that point? We need to take a break, but we'll dive a little deeper into this. And we need to understand then what this change in the definition of wage, what does it mean for our benefits? We'll discuss that after the break.
Let's talk money. Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing the all-important brand new 4 labor codes that have ushered in a new era of labor reform in the country. Now, we've just understood how the definition of wages itself is changing. And let me go back to our guests. Of course, Sonu Iyer of EY with us and Vaibhav Bhardwaj of Ketan & Co. also with us. Vaibhav, this question to you, because Sonu just explained to us how the definition of wage will change and the calculation could change if your employer has been giving you too many exclusions as part of your CTC. But the other worry is that with a higher definition of wages, what happens to my provident fund? The worry is that I'll be, a lot of my salary will go into PF. I won't have enough to spend right here, right now. Is that the way the law is being worded?
Yes, from a long-term perspective, there are huge benefits. But just to explain to you, the definition of wage, I would say it's one of the instrumental change under the wage code. And just to take a step back, there have been judicial precedents, and it's a settled position of law that the allowances that are universally payable to everyone should be included as part of basic wages while calculating provident fund. Now, this is something which is a settled position of law, and in fact, the Supreme Court has also recognized this particular matter. Now, with the wage definition, it has become extremely clear that what allowances can be included, and if the allowances are over 50%, then the remaining portion or the extra portion need to be included as part of basic wage for the purpose of calculating all retirement benefits, because now it's a uniform definition. So whether it's PF, whether it's gratuity, whether it's ESI, everything has to be calculated basis the definition of wages. So, of course, the impact is twofold. The employer contribution would also increase. So there will be an increase in the financial burden of the employer. And from an employee perspective, their take-home salary would reduce. But ultimately, the employees would be better off from a retirement perspective, because their corpus will be accumulated at the time of the retirement.
I am sure this debate is not going to end anytime soon, but Sonu, weigh in on this. And also the original definition of the calculation of PF, right? It used to be that 12% of basic, and then I contribute that much, and the employer contributes that much, and that's how you get a nice little PF kitty. But now it's not necessarily the pure term, the basic pay, right? Because like you explained to us, that if you have any retainership allowance, the DA, all of that is wages. So will PF be paid on this wages, which could be a bigger number itself? Is it still 12%? Will the employer still contribute as much? I mean, just tell us what we can expect on the PF front.
Okay, so maybe just add in on what Vaibhav said. First of all, the fact that, the government has been, working on a larger stated objective of social security for all, and ensuring that as longevity of lives is there is a retirement kitty. So provident fund towards is that one major benefit that employed workforce and now the informal workforce through social security, we are aiming to create a retirement kitty. Keeping that objective in mind, the government wants to be able to make sure that there is a resizable corpus available to employees once they retire. What is changing right now in labor codes, there is, of course, the new definition of wages, which will be used across Code on Social Security 2020. But on Provident Fund, I think there's a lot more that needs to come in, because what the code says is that it will be 1 year from the date of notification of Code on Social Security 2020 that we will see a new scheme of Provident Fund come in. As things stand today, whilst we have a definition of wages which is applicable, but because in the existing Provident Fund scheme itself, we have, 15,000 rupees is a salary for reference for calculation of Provident Fund, which will continue until the new scheme is notified. So in the short run, I do not expect any changes on the take-home salary because of anything going up, because this is still something that is work in progress. The rules will be notified, the schemes will be notified for Provident Fund. So we expect to see final word coming only once the scheme is notified. So there should be an impact, but in the long run, it is a reform that is intended to bring in greater financial security and a larger corpus of retirement fund available to employees. So it's a positive change, and because there is rationalization of definition of wages, it ensures that anyone who is working is able to create a sizable kitty for themselves towards retirement.
Vaibhav, just come in on this, this whole PF calculation. Now, like Sonu mentioned, that the actual cap, the mandatory sort of threshold for corporates is only, I think, 15,000. They have to pay PF on a 15,000 salary. Over and above is, depending on your salary structures. Just explain how this could play out, because in most cases, even the employer's contribution to PF ends up being part of your CTC. So is it really going to be hitting the corporates? Will it really add to the wage bill at all? And once again, on PF, what would your 2 points be right now? I think you're mute.
Sorry. So as Sonu also pointed out, it will be interesting to see how the PF schemes comes through. But yes, as of now, of course, the employer contribution is only capped at 15,000, and more than 15,000, and some employer wants to contribute, it's as per the discretion of the employer. But yes, purely from a PF perspective, I would say in the long run, the take-home salary would reduce because the PF contribution would increase because of the change in the definition of wage, and a lot of allowances will be included as part of basic wages.
Okay, all right, got that. Which brings us to another important subject, and that's gratuity. Now, good news if you're a contractual employee, because I think here, Sonu, now instead of waiting 5 years and then finally getting gratuity, even if you've worked on contract with a firm for 1 year, even then you're entitled for gratuity. Is that right?
Okay, let me sum up the changes in gratuity, because there are all kinds of interpretations in gratuity. As we understand it, the two changes which are relevant from a gratuity perspective is, in case of fixed term employment contracts where you have a contract for a fixed term of employment, gratuity will become payable after 1 year of employment. So gratuity comes in for fixed term employee, which was not there earlier. So it's a very positive benefit. There is also, of course, parity in all kinds of benefits for fixed term employees as is available for permanent employees. Now, in case of permanent employees, the eligibility for gratuity only kicks in after 5 years of working. And what is changing there is that the calculation of gratuity will be on the new definition of wages. Up until now, gratuity was computed only on basic salary and dearness allowance, if any. But now it will be on the new definition of wages, which we just discussed, which is basic salary plus allowances, exclusions being capped at 50% of the remuneration. So that's the change on gratuity. Again, currently the gratuity ceiling is also capped at 20 lakh rupees, but there will be a new notification that will need to be issued under the newly notified Code on Social Security 2020. So we'll see if the gratuity ceiling goes up, but the current 20 lakh ceiling continues, as was the case under Payment of Gratuity Act.
So sounds good. I think the sum and substance of this is that this is a good reform. It's good for employees and perhaps not too bad for employers either. So win-win in that sense, perhaps, truly speaking. Thank you so much, Sonu and Vaibhav, for joining in and making sense of these all-important labor codes for us. And thank you, viewers, for watching. If you still have any more questions, please keep writing into us and we'll make sure that they are answered in the coming shows. See you next week with another theme.
Let's talk money.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty hit a record high after 14 months. Both markets give up most of their gains, end barely in the green though. Bank stocks lead the rally today. The government is all set to fast-track the incentive scheme to bolster rare earth manufacturing. Sources say the notification is likely in 15 days. Bids will be invited over the next 2 months. That's an exclusive. A Niti Aayog panel proposes scrapping licenses, permits and no objection certificates in a regulatory overhaul. Sources say a high-level committee is proposing prior approvals only for high-risk cases involving national security, public safety and environmental harm. That's another exclusive. Tata Power is likely to resume production at its Mundra plant 6 months after suspending operations due to poor demand. The Gujarat government reaches an in-principle understanding on a supplementary power purchase agreement. Sources say Tata Power could use this as a precedent for pacts with other states. The Income Tax Department launches a new initiative asking taxpayers to disclose foreign assets acquired in FY25 by the end of December. The Tax Department identifies high-risk cases where foreign assets appear to exist but have not been reported so far. Tech giant Apple takes India's competition regulator to court, challenges the law allowing penalties of up to 10% of global turnover for market dominance. The law exposes the company to a potential penalty of $38 billion. Apple's global smartphone shipment could outpace Samsung for the first time in 14 years. Counterpoint Research says the positive response to the iPhone 17 series is a major catalyst. At least 55 people dead and hundreds missing after an apartment complex in Hong Kong goes up in flames. The blaze tears through 7 of the 8 tower blocks. 3 construction company executives arrested so far. 2 U.S. soldiers shot and critically wounded near the White House after an attack by a lone gunman rattles Washington. Officials identify the suspect as an Afghan national who's currently in custody. The U.S. stops processing immigration requests from Afghanistan after the attack. Ahmedabad gets ready for a massive infrastructure makeover ahead of the 2030 Commonwealth Games. Big opportunity for developers with land near game venues, athlete village and pre-transport corridors. The airport link development could boost inbound travel and demand for hotels as well. Well, let's start with the day's market action. The Sensex and the Nifty did hit a record high, but then finally closed the day largely flat. The Sensex crossing 86,000 and the Nifty surpassing the 26,300 mark for the first time, closing absolutely flat. 110 points higher on the Sensex, though coming off its intraday high. The Nifty Bank up by about 200 points and flat close for the Nifty mid-cap as well. Bank stocks, as you saw there, leading the rally. Hormuz is standing by to decode what triggered the rally today. Hormuz hitting new highs, but finally closing off the intraday lows.
It finally happened, didn't it? And 14 months is what it took. 27th of September of 24 was last time when the Nifty was at these levels, and we finally managed to cross that. But the bigger talking point is that from the lows that we made in 2025, which was in April this year, the index is up 19%, yet we remain underperformers compared to the rest of the globe. You talk about contributors, the usual suspects of Bharat Electronics, Bajaj Finance, SBI, but Eicher Motors is the top gainer here, gains of anywhere between 25 to 45%. But the losers are the bigger here. Trent, Street Darling at one point of time has almost halved. Bajaj Auto, Coal India, TCS, NTPC, all of them down anywhere between 25 to 30% in the last 14 months. But if you take a look at the gainers from the April lows, you see BEL is up almost 50%, but the post-GST rally seen in M&M is the talking point here. Eternal has done well, as has Geo Financial Services. But if the Nifty made record highs, the broader markets is where the pain lies. The mid-cap index has done precious little over the last 14 months. The small-cap index is down 7%. And more than the gainers, you look at the losers here. You look at the mid-cap losers, Colgate is down 42%, as is IndusInd Bank, no longer a part of the Nifty. Tata Tech, another hyped IPO, down 40%. RVLN and Ireda, the high-flying PSU stocks of 2023 and a better part of 24 as well, down 40% each. The picture in the small-cap space is even more grim. Ola Electric is down 60, as is Tejas Networks. You look at Jindal Saw, add another 11% to Whirlpool's 46% drop. So overall, the Nifty may have made a record high, but it is the broader markets where the actual underperformance and the actual pain lies.
All right, many thanks, Hormuz, for joining us. Moving from the equity market action to the rupee, largely steady against the dollar in trade today. The currency remains closer to its record low and above the 89 mark against the greenback. Now, last night, the International Monetary Fund reclassified the rupee to what it calls a crawl-like arrangement after the currency moved more freely. Sources in the money market say a crawling peg is closer to a market-determined rate. The fund went on to say that India is well positioned to allow greater flexibility in its currency, which would help absorb external shocks. The Finance Ministry said that India's economy is on a stable footing on the back of encouraging inflation expectations, sustained public capex and strong rural and urban demand. The Ministry's monthly economic report highlighted that the economy is positioned to navigate emerging risks and preserve its growth momentum through the remaining months of this fiscal year. The report further highlights that global uncertainties, including shifting trade policies, geopolitical frictions and financial market volatility, are potential headwinds. The Ministry of Statistics has given us a glimpse of the main changes in store when the GDP, inflation and IIP will be calculated on the revised base year of FY23 from the current base year of FY12. Lata joins us now with the major changes in the formula. Lata, what will this mean? What can we expect?
Oh, well, the conference gave us a lot of fodder saying how they are going to, the MOSPI, the Ministry of Statistics, is going to increase its sources and improve the methodology of calculation of GDP, CPI and IIP. Just remember, the base year is going to be changed from the earlier 2011-12, or rather the current 2011-12. The new base year will be 22-23. But the first CPI will be announced only on Feb 12. Which means two monetary policies don't have to bother about a new CPI. The budget also will not have to bother about a newly calculated GDP. You know, it can throw things out of gear. So both the next two policies and the budget are out of danger of any, numbers being rewritten. The big changes that MOSPI announced is that for non-financial, that is manufacturing and such other companies, they are going to use corporate data activity-wise and not enterprise-wise as it is currently used. Very quickly, to give you an example, for instance, Maruti would be originally and in the counted as manufacturing, but now they will take out manufacturing. If they're doing any trading, they will treat it separately and put it in the appropriate categories in the GDP. Now, this could mean that manufacturing may look a little smaller when the new series comes, but there are this kind of fine-tuning that they're doing. The other thing that the MOSPI said is that they're going to use GST data to corroborate the corporate sector data in terms of revenue, etc. And the GST data will also be used for regional allocation of the GVA. Now, last couple of years, the Ministry of Statistics has also started unincorporated companies survey that is called as-used survey. That will be used to give for the annual GDP calculation the amount coming from the informal sector. You know, the formal sector GDP is counted quite easily. Informal sector will be counted through this. But this data will not be available quarterly. Only the annual GDP can be done on this fashion. The quarterly GDP will only extrapolate the informal from the formal as it does these days. The MOSPI has also told us that for manufacturing, they will use double deflation. There was a lot of criticism about the single deflation. That is, they will deflate output prices, input prices, and then give you the exact value add in the manufacturing space. But for the non-manufacturing space, they will have to continue with either the single deflation method or what they call the single extrapolation method, which is still a very sophisticated and internationally accepted method of calculating value add. Very quickly, coming to CPI, the Ministry of Statistics said that they're enhancing the number of markets, towns and items that they are covering. They're going to include fresh administrative data as well as online data. That's very important. That's a new set of data that they're going to include, since so many of us buy so many things online. Also, they're going to give more granular details. So the number of items for which you will get CPI will be more. The new CPI release, which will come on February 12, 2026, will therefore even look very different because there will be more items. Coming to IIP, the focus is again going to be more healthy sources. For every item, they want at least 4 factories, establishments producing it. And also, they're going to continue to replace, if one factory is not giving them data or it has become non-operational, they will quickly replace it in real time with another factory so that the data is always robust. There is a new way of calculating, more robust real-time way of calculating called chain-based indices. that is work in progress. Eventually, that and seasonally adjusted IIP will also come, become available to us.
All right, Lata, many thanks for joining us. GDP, CPI and IIP all set for a change. Now, the Income Tax Department has launched a fresh drive to track down high-risk undisclosed foreign assets. Timsy standing by with the latest. Timsy, take us through what the Tax Department now intends doing.
Well, the Income Tax Department has introduced, again, a second drive towards undisclosed foreign assets. They said that this is, again, a non-intrusive measure that the government is taking, and this second drive is now called Nudge. It will be on the entire December. The drive ends on 31st December, and they say that they already have a list of about 25,000 high-risk cases that will be targeted through non-intrusive measures, asking them to come up clean on their undisclosed foreign assets. And to be fair, they say, according to sources, what we pick up from the tax department is that the big corporates whose employees have foreign assets and have not disclosed are also onboarded towards sensitizing. They've also onboarded ICAI and many other tax professionals organizations, asking them to speak to their clients, to come on board, take the benefit of this particular drive. And just to remind you, last year again in December, the government had come up with similar drive where they identified about 1,080 cases, which raised a demand of about 40,000 crore rupees till June 2025. So Income Tax Department saying that there is a non-intrusive drive that has been started again against undisclosed foreign assets which have been identified by them through the automatic exchange of information through various countries in financial year 2025, and sources say that they already have a data of about 25,000 such high-risk cases. And if these 25,000 people do not take up this opportunity, then what comes to their demand? Well, Black Money Act prescribes penalty of 10 lakh rupees on non-disclosure of foreign asset, apart from tax of 30% and penalty of 300%, and other consequential other measures such as searches, etc., which government has already taken in cases who did not come clean in the last drive. So this is another measure to try and unearth foreign assets under Black Money Act, which are still yet to be recovered and yet to be identified under the income tax returns. Let's see what happens in this particular drive, which will be on for a month.
All right, Timsy, many thanks for joining us. Now, Tata Power is likely to resume production at its Mundra plant 6 months after suspending operations due to poor demand. Sources tell us that the Gujarat government has reached an in-principle understanding with the company on a supplementary power purchase agreement. Tata Power could use this as a precedent for pacts with other states. Shares of Whirlpool India declined after 11.8% of the equity changed hands via block deal. Sources tell us that the company's promoter, Whirlpool Mauritius, is likely to have sold 7.5% equity worth around 980 crore rupees. The floor price of the deal was set at about 1,000 rupees per share. Now, the Reserve Bank has granted a certification of authorization to Paytm Payment Services, the entity owned by Paytm's parent 197 Communications. It can now operate as a payment aggregator. The company had applied for the permit in March 2020. However, the approval was stuck due to certain compliance-related issues on account of foreign investments in the company. The Enforcement Directorate has arrested online money gaming platform Winzo's founders on allegations of money laundering. Soumya Singh Rathore and Pawan Nanda were arrested after being questioned at the zonal office of the Federal Probe Agency. They were initially sent to a one-day custody after being produced before a local court. The arrest comes after the ED's recent searches at Winzo's premises. The government will notify the 7,300 crore rupee rare earth permanent magnet manufacturing scheme in the next 15 days. Sources tell CNBC-TV18 the government could invite bids for the scheme by the 31st of January. Parikshit is standing by with the details. Parikshit.
Well, the government is likely to notify the scheme for manufacturing rare earth magnets in 15 days. Thereafter, the government could invite bids for the scheme by 31st of January next year. Interested bidders will have to submit a detailed project report to show that they are technically capable. They have either indigenous expertise or they have global technology tie-ups to deliver on the promises they are making. An interministerial group supported by India Rare Earth Limited, Baba Atomic Research Center and CSIR will soon be set up to frame the bid criteria, and this interministerial group will choose and select the applications also. Startups, established companies, first-time players are all likely to be invited to bid for the scheme. All applicants would be free to have global tie-ups for technology but must manufacture in India. The government may consider companies who can invest rupees 1,500 crores in setting up a plant for 12,000 ton of rare earth permanent magnets. Smaller players who can set up capacity for 600 tons of permanent magnets may also be considered. During the consultation phase, 25 companies, including magnet makers, automotive component manufacturers, participated in the meetings. As of now, companies like Entellus, Ashwini Magnets and Midwest make rare earth materials in India, but no one does it at the scale that is really needed, or where you can say there is import substitution. The government seeks to establish rare earth permanent magnet manufacturing facilities in India and build a domestic supply chain to reduce reliance on Chinese imports. In order to strengthen domestic supply chains, Department of Atomic Energy has also asked state-owned India Rare Earth Limited to expand capacity for manufacturing NdPr oxide, which is a crucial raw material for manufacturing rare earth magnets.
All right, Parikshit, many thanks for joining us. Apple has moved the Delhi High Court challenging India's amended antitrust penalty regime. The iPhone maker told the court that the law may be subject to as much as $38 billion in fines. This, as the new regime allows the Competition Commission of India to impose penalties of up to 10% based on a company's global turnover rather than its revenue from India. So Apple taking CCI to court. And staying with news from Apple, it is set to ship more iPhones this year, more than its rival Samsung for the first time in 14 years. Counterpoint Research tells CNBC-TV18 that the iPhone maker will ship around 243 million units this year. In comparison, Samsung's estimate of 235 million units. Apple is also likely to end up with a 19.5% share of the global smartphone market, while Samsung's share will be at 18.7%. CarTrade has said that its proposed deal to acquire CarDeco will not move forward. In a statement, the company said that the two companies had mutually decided not to proceed with the proposed transaction at this stage. The transaction was estimated at over $1.2 billion. Remember, CNBC-TV18 had confirmed that CarTrade was in talks to acquire CarDeco and BikeDeco, that deal falling through. Let's take a short break, but up next, at least 55 people dead and hundreds missing after an apartment complex in Hong Kong goes up in flames. That and more when we return. A panel constituted by Niti Aayog has proposed scrapping licenses, permits and no objection certificates. Sources tell us that the panel has recommended third-party and risk-based inspections. Shivani joins us now with more details of the proposed changes. Shivani.
Well, yes, sources have told CNBC-TV18 that a high-level Niti Aayog panel led by former Cabinet Secretary Rajiv Gauba has called for a complete end to what is described in the country as the inspection raj. The committee has recommended scrapping most licenses, permits and NOCs except in high-risk areas like national security, public safety, health and the environment as well. Under the proposed framework, routine inspections will now move to accredited third parties selected through risk-based computer-generated systems. That's what sources are telling us. Now, the panel is also pushing a new trust-based approach, the Jan Vishwas Siddhant, where any activity not explicitly prohibited by law will not need prior approval. It has also called for stable policies and tax regimes and for every regulation to clearly state the compliance cost for businesses and enforcement burden on the government. And in a major shift, the committee also has proposed that criminal penalties reserved only for serious offences, including threats to national security, fraud or major environmental harm, with a full review of all such provisions across laws. If these proposals are accepted, of course, these are right now just on the proposal stage, they could mark a significant reset in how businesses operate in India and how India regulates its businesses. Back to you.
Shivani, many thanks for joining us. The big international story, at least 55 people have died and hundreds are missing after an entire apartment complex caught fire last night. Officials allege that bamboo scaffolding and foam material used during maintenance work might have caused the rapid spread of the fire. The fire tore through 7 of the 8 tower blocks of the building. Firefighters were continuously trying to douse the fire, attempting to rescue the trapped residents inside the burning building. This incident has been touted as the deadliest fire in Hong Kong in decades. Authorities have said that the firefighters managed to put out the fire in 4 buildings and operations were continuing in the remaining 3. A task force has been set up to investigate the cause of the blaze. 3 men from the construction company, including 2 directors and 1 engineering consultant, have been arrested. Ukraine claims Russia has carried out 41 airstrikes, dropping more than 100 guided bombs across the country. Kiev has also said it hit a Russian plant involved in missile and drone production, along with several other military positions. This comes as the Kremlin called on the US brokered peace talks serious, but warned that Moscow would offer no major concessions to Kiev. 2 US soldiers were shot and have been critically wounded near the White House after an attack by a lone gunman rattled Washington. Officials have identified the suspect as an Afghan national who is currently in custody. The Trump administration has stopped processing immigration requests from Afghanistan after the attack. President Trump has asked Japanese Prime Minister Sanae Takaichi to dial down her stance on Taiwan. As per reports, both leaders spoke over a phone call where Trump told the Japanese leader to not escalate tensions with Beijing. This comes after Prime Minister Takaichi sparked a diplomatic row by suggesting that a Chinese attack on Taiwan threatening Japan could justify a military response. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more. A 90-year legacy, in many ways a third-generation entrepreneur, but with a startup into the renewable energy space. What was that about?
As they say, business was in our blood. Dad was very clear that renewables is the future, and I'm talking of 2006. But the experience was a disaster.
You know about the curse of the third-generation entrepreneur, right?
Of course, it took me a year and a half to fight with Dad.
To get 20 crores?
10 crores. So what's the worst that's going to happen? I'm going to blow it up.
Inox Wind was your startup.
Sure.
And then you were at a point where it was almost on the brink of a disaster.
We were working closely with the ministry, with the government. Unfortunately, as happens many times in India, implementation on the ground takes time. Unfortunately, that went on for 2.5 years.
Is there somebody, or maybe there's more than one person who you look up to?
I primarily look at Gautam Bhai, and I would say he's one person I always go to for advice.
What have been some of the toughest pitches that you had to make where you were trying to get somebody on board on the cap table?
Oh, the Inox Green IPO. I had a broken foot. I thought when they look at my broken foot, they'll have some sympathy and give me some money. It never worked out.
I wonder what you're thinking when you see a company like Grow list and go to 1 lakh crore rupees virtually within a week of its listing.
Today, I think these new so-called listings are just hitting the roof. I don't know how long a lot of this is sustainable. Under the IPP arm, once I've built and commissioned an asset with a central PPA, it's locked in for the next 30-35 years. When you look at Inox Green, our annuity business, when I sell a turbine, I have a 25-year O&M agreement. So you're married to me for those 25 years. There's no divorce in this business.
From steering billion-dollar clean energy bets to taking 2 companies public before turning 35, this next-gen leader has helped transform a 90-year-old legacy group into one of India's most diversified and fastest-growing renewable powerhouses. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. As Executive Director of the $18 billion Inox GFL Group, Devans Jain oversees one of India's most diversified green energy portfolios, from fluorochemicals and EV battery materials to wind, solar and renewable power. Our Carnegie Mellon graduate who launched Inox Wind at 23, he's weathered the collapse of India's wind sector, rebuilt from a near bankruptcy phase and driven the group's market cap towards 2 lakh crore rupees across listed and unlisted businesses, and is now setting up the world's largest battery chemical plant outside of China. Devang Jain, many thanks for joining us here on Young Turks Reloaded. It's great to have you. Lots there that's been packed into the last 20 years that you've been around and working with the group. But I want to go back to what I started with. A 90-year legacy, in many ways a third-generation entrepreneur, but with a startup of your own to your credit. At 23, the decision to not just get back to business, but also decide to get into the renewable energy space. What was that about? What was that bet for you about?
First of all, good morning, Shireen. It's a pleasure to be with you. I think, as they say, business was in our blood, right from an early age. Breakfast, lunch, dinner conversations, were always hearing numbers, hearing Dad talk about work, building businesses, the risks, the challenges. And so right from an early stage, that was always clear. I wanted to build something of my own, not just come back and get into a cushy job. That's also the reason I did a dual degree and came back in 3 years and didn't work outside. There's a lot of pull and push. You should work outside, get experience.
Your mom wanted you to work outside.
My mom wanted me to work outside.
Yeah.
Dad was open. But, I really thought if you don't work out for 3-4 years, it didn't make sense. And I wanted to come back and unleash whatever pent-up energy I had into something which I could build, create, and so on and so forth. But when I came back, there was this opportunity where GFL, Gujarat Fluoro, had significant free cash flows. And we were looking at deploying it into a new sector. And we were working closely with McKinsey to identify a couple of sectors. Dad was very clear that renewables is the future. And I'm talking of 2006, not currently when renewables is the hottest subject. So, at that point in time, we put out a business plan which said that we'll own assets, build our own wind farms, and so on and so forth. So we started building a couple of them with some of the OEMs which existed at that point in time. But the experience was a disaster. From whatever IRRs were expected, we were getting single-digit IRRs. So we went back to the drawing board. What do we need to do? And that's when, this whole concept of controlling our own land banks, our own evacuation infrastructure, eventually controlling our own turbine came in. And then, I spent the next 3 years, studying the wind sector, spending a lot of time in China, technology partners, and that's how Inox Wind was born. Of course, it took me a year and a half to fight with Dad.
To get 20 crores?
10 crores.
10 crores?
10 crores. And I said, I don't know, it was again, so what's the worst that's going to happen? I'm going to blow it up. At least let me do something. And I'm not saying 10 crores is phenomenal, but at that point in time, it was a princely sum. And, it's a different matter. I mean, that 10 crores that Dad put in from the family office and 10 crores from GFL eventually gave them back about 1,500 crores. We obviously created a huge wealth, wealth out of that. But yeah, it's been a hell of a journey.
I want to pick up on something that you said, that you were always obsessed about wanting to build something. And I'll put this in the context of a comment that Uday Kotak made a while back, where he said that this current generation of business families is struggling because the next gen doesn't want to actually run anything. They want to run family offices, they want to invest, but they don't want to actually build anything. And he held that out as a note of caution for what that could potentially mean as far as the Indian economy at large is concerned, but also Indian business. As someone from this generation who chose to build as opposed to set up a family office and invest, how do you look at that debate?
Look, I kind of resonate with that thinking, simply from the perspective that when we look at a lot of my friends who are from business families, a lot of them are, frankly speaking, extremely comfortable where they are, cushy. Their dad's certainly gone out, or their grandfather's certainly gone out and built large businesses. But I don't think they want to...
As did yours.
It was large, but I think the scale at which we operate today is a different ballgame. And having said that, I mean, I've always seen Dad working. I mean, even today, he's always pushing. You achieve something, you kind of, you want to celebrate for a day, but Dad just comes in and then pushes you to the next target. So ours is a different relationship. I would also say the past 5 or 6 years, right? Pre-COVID, COVID, and then the huge scale up in valuations. Or, 100 rupees went down to 10 rupees, and now that 10 rupees is back to, say, 150 rupees. People have had it so easy, and no one really wants to slog it out. You've got a lot of the new first-generation entrepreneurs who are building phenomenal startups with whatever capital they have, or by raising private equity and so on and so forth. But a lot of the legacy business houses, I think, the next generation people, honestly, are extremely laid back, cushy, don't want to push, don't want to achieve things. I think that's an opportunity in itself, because a lot of those businesses now are coming on the block. So a lot of the larger, more aggressive families or startups or private equity guys are now coming in and acquiring a lot of those verticals.
Let's talk about that difficult phase. Inox Wind was your startup. It was your baby in many ways. And then you were at a point where it was almost on the brink of a disaster. You were losing money, 500 crores in losses?
A little bit more.
More. Debt of 3,000 crores as well. To pull yourself back from that, of course, there were larger issues pertaining to the sector, but to pull yourself back from the brink and restart, what was that like?
It was a policy issue, transition from preferential tariffs to auctions, which led to a temporary disruption in the sector. And nobody knew the disruption would last 5 years. Honestly, if someone came and told me that it's going to take 5 years, I would probably have done things differently. Having said that, we were working closely with the ministry, with the government. The intentions were all good, so there was nothing wrong with that. Unfortunately, as happens many times in India, implementation on the ground takes time. So, when we went through that pain, it just became ek aur quarter. Bus policy aa rahi hai, bus we've sorted it out. Unfortunately, that went on for 2.5 years. And you went so deep in that, honestly, there was no option. You had to come out. Now, unfortunately, at the end of 2.5 years, when we started seeing the light at the end of the tunnel, as they say, COVID hit the world. When COVID hit the world, as other businesses were struggling, everyone was on the same boat. So everyone said, okay, we're all on the same page. Everything shuts down. Fine, we're all on the same. We had shut down for 2.5 years prior to that. And as we started coming out, we again got into a coma, as they say. So for us, it was, it was a perfect storm. It went on for 4.5, literally 5 years. But then, when you look at the situation at the end of 5 years, we had literally 35 or 36 players fold out. You were down to 1 or 2 players in the sector. One odd player who survived with, $2-3 billion of haircut. We survived with 1,000 crores, 700 odd infused from our family office. That's what was left. And if you now look at the situation we are in, at that point in time it was zero, and this is not too far away. This is 2022. We're today at 25 end. In 3 years, from being virtually zero or negative, if I may say so, our entire renewable arm, the listed and unlisted piece, would be worth north of 1 lakh crores. But survival of the fittest, as they say, and there is no gain without going through a lot of pain, as they say.
Yes, Inox Wind is of course listed. Inox Green is as well. Inox Clean likely to be listed sometime soon. You've already filed for that. Explain to our viewers how all of this comes together, the different pieces, the 5 different arms that actually come together that give you your differentiated moat.
Sure. So very simplistically put, when you sell a wind turbine, someone needs to make the wind turbine. Someone needs to do the EPC work, which is the transmission line, the foundations, the erection. And then post that, someone needs to do the operations and maintenance services. So these are the 3 parts of a wind turbine business. Inox Wind supplies the wind turbine. Inox Green does the O&M services. And a company called Inox Renewables Solutions, which is being demerged and should be listed soon, does the entire EPC, the land banking, the evacuation. So these are 3 pieces of the wind part. As many people understand today, there's something called RTC, round-the-clock power, hybrid power, which basically means you're using the same grid, the same infrastructure to put wind and solar or batteries together. Because as you have large-scale deployment of renewable energy, you need to ensure the grid is resilient so that you can add wind and solar together.
Right.
Here comes Inox Solar. Solar does the solar module and cell manufacturing for us. So for a customer, let's say a third-party customer, setting up, say, 100 megawatts, they come and say, look, we want a 100-megawatt hybrid project. Inox Wind comes and sells the turbine. Inox Solar comes and sells the solar module. Inox Renewable Solutions does the EPC. And Inox Green does the O&M services. In the context of Inox Clean, we're a power generator. So if someone now wants power as well, Inox Clean comes in and says, I'll supply the power to you. You don't need to do the capex. Or we also supply power to central PPAs like SECI, NTPC, SJVN. But effectively, why we call this a very strong integrated approach is because in the wind sector, at least, they're really a duopoly kind of a scenario.
It is a duopoly.
Right.
Yeah.
So every time we sell a turbine, which is, say, 8 crores a megawatt, solar, the module piece is less than 2 crores a megawatt. So for customers, they come and say, listen, if you're doing the complex bit and the EPC arm is yours, why don't you just do the solar piece for us as well? That's how we forward integrated into solar. And then we have GFCL EV, which is setting up the largest battery chemical complex outside of China, which makes the heart of the EV mobility play and the energy storage systems.
the government has targeted putting in place 500 gigawatts by 2030. We're about 29, 30 gigawatts annually. That is the run rate that we've been working with in the last few years. So the headroom for growth is significant. Now, how much of that share do you believe you have the capability to be able to draw towards the five arms of this group that you just took us through?
Look, honestly, I think the scale is unprecedented. The opportunity is unprecedented. What we can do is what I can do is overseeing Inox GFL is position each of these companies, be it with the management teams, be it with capital, be it with the ability to take quick decisions and risks. And what do I mean by that? I mean, in Inox Green, for example, we've now become 12.5 gigawatts of O&M assets. We've acquired multiple companies, a lot of risk-taking, which we did. And we are poised to become India's largest green O&M services company. We've now created something which is not been done until now. We would, over the next couple of months, become India's largest green O&M services company. People have not appreciated that or not understood that yet. At 12.5 gigawatts moving to much larger numbers, we've publicly stated we'll be 17 gigawatt in the near future, possibly much larger. At that scale, you're talking of making almost 1,000 crores a year of profitability with zero capex, zero working capital, and escalating at literally 20-25% every year. It's something which I would call a lovely, easy business within the group. Doesn't take any pain, no headache, because everyone pays, right, for servicing. You can't run away from that.
Yeah.
I think, but in terms of the larger opportunity and the context which you spoke about, we've built out Inox Green. We're building Inox Clean rapidly. On the wind side and the solar side, I think we've positioned it very, very strongly. It's all integrated. Again, as I said, we've recently announced an agreement with Longi, which is one of the largest Chinese players. In fact, I got a question from the ministry. कि आप उनको बेच रहे हैं कि वो आपको बेच रहे हैं? I said, sir, मैं बेच रहा हूँ क्योंकि domestic content requirement है. हम तो उनसे खरीद नहीं सकते हैं. हम ही उनको बेच रहे हैं. So I think I wouldn't give percentages in terms of necessarily we want to capture 50 gigawatt or 10% or 20%. All that we're trying to do is become the largest O&M service provider. Try to become the most profitable wind turbine company. Become a huge solar player and become a very large IPP player. What I could clearly say is, I think in the next 2-3 years, clearly our ambition would to be a 10 gigawatt IPP arm, which would be unprecedented.
How much have you already done?
Multi-gigawatt. Thanks to the public document, I can't talk more about it. But clearly what's in the public domain is we would be 4 gigawatts in the near future.
So what is the kind of capital requirement that we're talking about specifically as far as your ambition is concerned? I mean, you're looking at a possible listing also as far as the clean business is concerned, but across the group at this point in time, I mean, what kind of capital requirements do you foresee?
I think over the next 2 years, if I may say, I think we would be looking at a capital deployment of close to 50,000 crores, possibly more, but it's a function of when we list, as we list. That gives us scale to grow much faster. But I think what's in the works, what's clearly visible for us is a large play out on the clean side. There's a large battery chemical piece we're building out as well, but that's 5,000-6,000 crores. That's not 20, 30, 40,000 crores. Bulk of the capex is going to go into Inox Clean. And I think the way we've structured it with solar under it, solar is a cash cow. Throws up huge free cash flow for the next 1, 2, 3 years at least, given the domestic content requirements. And a lot of that cash is going to get deployed into the IPP arm.
But, I want to also talk about the ambition as far as the battery plant that you're envisioning as being the second largest outside of China. And you keep talking about the domestic requirements, and the policy has or is trying to ensure through many ways that domestic content, domestic value add is now factored in as far as business plans are concerned. How much of that is driving the kind of ambition that you have, especially on things like batteries?
Look, I think each company is building out its own journey, charting out its journey on its own. Having said that, I think what's driving the battery business is basically fluorine. So Gujarat Fluoro is one of the largest fluorine players globally. When you look at IRA in the US, or when you now look at the one beautiful, beautiful bill by Trump, effectively what
He doesn't find wind turbines beautiful at all, though.
Well, there's still a lot of deployment. He doesn't like solar as well.
Yeah.
But it's one of
wind
opportunities.
Wind particularly, were you surprised with that?
Look, to be honest, we're not in the US market. Wind is a completely domestic play. But, it's I'm undiplomatic. I shouldn't be saying this, but, it's as if you don't get a good night's sleep, you lambast on something else, and then you do something else. So I don't want to talk too much about it, Shireen. I don't want to get into trouble. But I think given our leadership position in fluorine, I think that had the foresight to move forward into battery chemicals. And this started about 4 or 5 years ago, not today. It's a long journey. It's a painful journey, again. And today, the unique opportunity we have is thanks to IRA and OBBP, the entire battery supply chain, which was in the US, which was 95% dependent on the Chinese, is moving out. And that's where we've stepped in. So it's an unprecedented opportunity for GFCL EV. Obviously, in the beginning phase, because EV is large in the US, China, no, and in the other developed parts of the world. India scaling up. It's probably going to be 1, 2, 3 years before we see a much larger play. And eventually then domestic content requirement naturally kicking in. You already have that for certain components. But because it's so small today, you can't necessarily do it for each of the key raw materials. But as we play it out in the US and in the other developed parts of the world, and we build out that business, India will start taking off as well. So in our larger scheme of things, I think over the next 3 or 4 years, we would expect the developed world, US and others, to be almost 70% of our business plan. 30% would be India, and then obviously India's share would keep moving up. So we're not dependent on DCR in India today because it's gradually going to kick in. But naturally, we will capture a big chunk of the Indian market. We already control the fluoropolymer market in India and GFL, and we would control the battery chemical market in India as well.
A lot of these businesses are also businesses that are dependent on government policy, i.e. subsidies and so on and so forth. As you build out your plans, have you factored in a world without subsidies? Have you been dependent or reliant in your business plans on subsidies? Because, you see this clamor. We're coming up to the budget and you'll see this clamor coming in, extend the PLI, give more tax breaks and so on and so forth. How have you factored the uncertainty of what policy may or may not do as far as your business plans are concerned?
It may sound out of the box, what I'm going to say. But frankly speaking, I think the government has done a phenomenal job with respect to PLI, no PLI, with respect to the renewable ambition, with respect to the Make in India, Make for the World ambition. I think Modi ji is India's champion, and I think that's it's phenomenal, the amount of marketing, the positioning they've created for India. Now, as industrialists, if we keep asking forever, ye bhi de do, ye bhi de do, ye bhi de do, mangte hi rahenge, there's no end to asking. And I've said this openly, candidly, multiple times. I don't think we need anything. We need policy stability. We need no interference when we're building things out. If you look at the renewable piece, we don't depend on any subsidy. There's no GBI, there's no accelerated depreciation, there's no PLI, there is no tax break whatsoever. When you look at the chemical arm, there has been zero government support whatsoever. Yes, when it comes to the battery chemical system, if India wants dumping from China forever, then naturally we'll only be supplying to the US because the US has become an inward market thanks to IRA and OBPP. But if India wants to bring a resilient domestic supply chain and be Atmanirbhar, certain businesses need protection in the beginning, right? Because the Chinese keep dumping, having said that. And that's happened in solar, that's happened in steel, that's happening in, you name that industry, adhesives, it's happening everywhere. So naturally, EVs and so on and so forth. If India is going to build a large domestic supply chain across the entire ecosystem, not just कि आपने गाड़ी assemble कर ली और काम हो गया. You need to have the raw materials for that. Otherwise, it's just you're bringing in all the key materials and assembling it together. There you will have to have anti-dumping or domestic content requirement. And I think the government is walking the talk on that across the board. But other than that, expecting more from the government, I think is wrong. At least at Inox GFL, each of our businesses looks at a situation where we have no support, nothing from the government. Yes, naturally, if something comes in for the industry, it's good. No one is going to say,
no one's going to say no to that.
And I'll give you a case in point. We're building out a very large solar complex in Orissa. And we chose Orissa because the capital subsidy program is phenomenal, as opposed to a Rajasthan or a Gujarat or a Tamil Nadu. Now, if that happens, our returns become that much more attractive. Have we factored that in the capex outlay plan? No.
You haven't?
No. Because, as has been seen many times, You never know when that subsidy will be paid out. Now, if I assume my capex is $100 and 40 rupees is coming in at the end of every year, as they say, and it doesn't come, what happens? You'll fail, you'll collapse. So at some point in time, surely it may come in.
That's the bonus.
That's the bonus. Yeah. But we can't plan keeping that in mind at this point in time.
You talked about the lessons that you've learned from your father. What about your father-in-law? He's also, somebody who's managing a large conglomerate, a very diversified conglomerate. Do you have conversations with him, about what you should or shouldn't do as far as work is concerned?
We have conversations, but with Dad, 99.9% of the times is work. With my father-in-law, I think work is 10% of the time. So it's a bit like my brother-in-law, my sister's husband. Dad and him barely discuss work. So it's always the son-in-law, who's kind of easy. I don't know about Shashwat. But clearly, our side is always discussing work. We bring work home. Whereas at my in-laws, work doesn't come back home. I think it's different. It's different there. But clearly, I think they've done a phenomenal job across very diversified businesses. It's interesting how he's been able to manage the situation he manages sitting out of West Bengal.
Yes.
It's a very untouchable area to some extent, and you're still controlling huge chunks of the country from there. With my dad-in-law, I think he's my cheerleader as well. He keeps rooting for me, keeps pushing me. Obviously, when there are situations which I can't handle, the two fathers are the people I go to, my dad and my dad-in-law. So I think I have a lot of support from them.
Speaking of painful learnings, and you spoke about, of course, what happened as far as Inox Wind is concerned, but I also want to understand from you as an entrepreneur and as a leader, when business families go through splits and you've gone through one, what that also teaches you and what have been some of the big lessons and learnings from that experience for you of how to build businesses, how to keep teams together, how to create a culture of ownership yet collaboration?
I certainly believe we must keep family and business separate. Simply because as families expand, whether it's girls or boys, different people have different ambitions. Some people are extremely ambitious. Some people are ruthless. Some people want to become a musician. Someone wants to become a painter. Nothing wrong with that. Or some people just don't have the ability to scale up, build up, take bets, or don't want to have building or creating value is painful. It's not easy. You just see the numbers and you get excited, but all the pain and the sweat which goes behind that cannot be forgotten. Don't want to get into the specifics of what happened with us. I think it was extremely painful. It was in the private domain, very civil. But 3 years ago, I can just tell you, when it happened, our group EBITDA was zero. Negative maybe. Our market cap was, say, 5,000, 8,000 crores. Today, the listed, unlisted arm is 1.6, 1.7 lakh crore, moving towards 2 lakh. We would exit the group on a run rate basis north of 5,000 crores. We are net cash across the board. We've built it out in 3 months because we've always been building companies. Dad built GFL, Dad built other entities. I built Wind. We came out of it. And look at the new ventures we're building out. EV will be bigger than GFL. Clean will be bigger than the entire renewable arm we've built so far. So, to be honest, I'm young, I'm not that old, so I can't give you so much gyan around it. But I just think everybody should be given their piece and don't do this hum saath saath hai. It does not work. And then when splits happen, it's very unfair. No one is ever happy.
Is there somebody, or maybe there's more than one person who you look up to in terms of how they've been able to build out their businesses or what you've learned from them in their own approach to scale and speed?
Look, certainly a couple of people, right? Like I always say, Dad. I always look at Dad. Obviously, my dad-in-law's been there as well. But I've said this earlier as well. I primarily look at Gautam Bhai. I think I've had the fortune of spending some time with him. I always, once in a while, speak to him, go meet him to get gyan, advice.
What's the gyan that Gautam Adani has given you?
The last time I was with him, I was asking him, I'm doing this on battery. On the IPP side, I'm thinking this, I miss solar. He said, solar is a huge opportunity. तूने miss कर दिया. तुझे ये करना चाहिए और अब तू battery को ऐसे कर. So I came back thinking, battery anyways, we're building one of the largest pieces. Why have I missed the solar piece? How do I get the solar piece right? And mind you, we've now gone out to build one of the largest solar platforms in less than 6 months in India. And I'd publicly stated we'll never get into solar because I never wanted to get into a business which is dependent on the government. Then we realized the payback period, and then we realized the integrated approach. Had it not been with Gautam Bhai, I don't think I would have been in the solar business.
Thanks so much for joining us here on the Young Turks podcast. It's been an absolute pleasure speaking with you and understanding what the renewable ambition is and how you're leveraging your capabilities to make use of this energy transition. Thanks very much for your time, and we wish you all the very best.
Thank you, Shireen. It was a pleasure to be with you.
Well, with that, it is time for us to wrap up this edition of the Young Turks Reloaded podcast. If you enjoyed the conversation, do send us your feedback, your comments and suggestions. We always like to hear from you. From all of us here on the team for now, goodbye and many thanks for watching. The two most powerful warriors of patience and time. Leo Tolstoy's words ring true for my guest today. For 40 years, he's patiently built one of India's most diversified financial services conglomerates, spanning banking to asset management. A first-generation entrepreneur, he's always been a believer in the India story. He's not just built an institution, but has also been the force behind many significant institutional reforms in the country. A stickler for the governance premium, he was roped in by the government to avert a financial crisis when he was brought in to clean up the IL&FS mess. A man who's taken India global and brought foreign capital to India. It's been a long, steady and impactful innings for Uday Kotak. What has been your leadership language?
History has what you would call as lessons of history. You also have baggage of history. Therefore, being able to decipher between lessons and baggage is a very important part of leadership.
The name, Kotak Mahindra, I mean, that was your decision, right?
When I read books when I was growing up, it was about some of the leading financial institutions in the world. And the names were Goldman Sachs, JP Morgan, Merrill Lynch, Morgan Stanley, all of whom were family names started by founders and who said we must put our name onto the company's name to give a confidence of trust for all the customers and investors.
What's the perspective that you have on where banks should start to disrupt themselves?
First, I think banks should not think about themselves as banks. They should think about themselves to be in the business of serving customers. The mindset is, oh, we are a bank, and therefore we have the right to be lazy. We have a right to have the moat. I think that is the most dangerous thing because the pool of savings in banking is under threat. The banker of today and the future needs three human qualities: prudence, simplicity, and humility. We were never scared about being a small player in a large market. We were ready to take on the big guys, even when we were small. In the 90s, I was one of the 3 junior Ks. The 2 senior Ks were Kothari and Kampani. And I was this little two-wheeler trying to make his presence in the giant truck market.
But now you're the truck. You're no longer the two-wheelers.
I'm a great believer in this 4-quadrant theory. Ram quadrant, Krishna quadrant, Duryodhan quadrant, and Ravan quadrant.
Good morning,
Good morning.
sir.
How are
you? Good to see you. Good to see you. Have you got your steps done for the day?
No, I haven't. I wish I was as meticulous as you.
How have you been, sir?
Very good.
What has been happening?
Enjoying?
Enjoying?
I was in US about a week.
You told me.
What about you?
What have you come ready with? What are you?
I don't know what you.
What acronyms are you throwing my way today?
I don't know what you're going to ask. So I'm coming with an open mind.
What acronyms have you got ready?
I just feel as good as
40 years ago. As you felt when you were 26.
40 is the new 20.
I totally agree.
And 60 is the 40.
I totally agree with you. I'm completely on board with that. We have to be. We have no
Absolutely.
choice.
They don't have one which we did a long time ago.
Which was?
Which was professional entrepreneur.
Yes.
I'm a great believer in that.
Yes. Yeah, here it is.
Which year was it?
2006-7.
Yeah. This is before the global financial crisis.
I want to start by talking to you about this 40-year journey that you were marking, Mr. Kotak. And I want to go back to your 26-year-old self and the audacity of hope, the audacity of ambition. What was it that made you believe that you could take this idea forward and build an institution with it?
We were a startup at Kotak long before startup got formalized as a structure in the financial markets. And we were on relatively small shoestring budgets. Raising capital was not easy, but there was hope and aspiration of an India on the verge of change. Therefore, 1985 was the time when India was on this cusp of really being different. And at some level, we were lucky to be at the right place at the right time.
Yes, right place at the right time, but really getting things started, from the NBFC to eventually getting the first bank license for an NBFC in India. If I were to ask you today to map out the most significant milestones, the milestones that really stand out in your mind as being not just memorable, but also impactful in turning the journey and pivoting your journey to where you are today, what would those be?
First is the timing of when we started. Banking was 97% state-owned. There was a concept of borrowers not being able to raise more than 5 crores of debt. The rate of interest was fixed by the RBI for all borrowers at 17%, and depositors got around 6%. So here was a marketplace where small companies supplying goods to large, well-known companies like Tatas and Mahindras found it difficult to fund themselves even at 17%. So we started our lives as doing bill discounting, where the rate of arbitrage between banks, which banks enjoyed, which was 11%, we said, let's give it to the consumers and the customers and build this business. So we started giving bill financing to SME and small business customers at 16%, who used to supply to large, well-known companies, and went to individuals to rediscount these bills and gave them 12% instead of 6%. So 6 to 17, we made it competitive, 12 to 16, and actually funded a lot of small and medium businesses who had problems of cash flow supplying to large buyers. That was the first relatively open game which enabled us to grow our business in 1985-86. That's the time I met Anand Mahindra.
Yes.
And he was just back from Harvard. and into his company, Mahindra Eugene Steel Company. He was designated General Manager Commercial. And I gave this scheme to Anand that we could provide him financing at competitive rates so that his suppliers can get funded. That really worked. Anand then became a shareholder of the company, and the rest is history.
Yes, in many ways, as you said, you were a startup and he ended up being the first VC to come on board.
Absolutely. And then we started with a total of 30 lakhs capital. I borrowed some money and put in a little over 13 lakhs, 13.5 lakhs. Anand also put in, I think, 15%, around 4.5 lakhs. And then we had friends and others who chipped in a little bit. And we started this with 30 lakhs capital.
And the name, Kotak Mahindra, I mean, that was your decision, right? That you wanted both names to be there on the signboard, essentially.
And Shireen, there's a little bit of history to that. Because when I read books when I was growing up, it was about some of the leading financial institutions in the world. And the names were Goldman Sachs, JP Morgan, Merrill Lynch, Morgan Stanley, SG Warburg, all of whom were family names started by founders and who said we must put our name onto the company's name to give a confidence of trust for all the customers and investors in the company. And therefore, putting our name on the line was a part of a belief that we are putting on the line our names to be able to give trust and confidence to all stakeholders.
But it's also interesting that in a way that this was a founder-led institution, but you've been a big believer in the idea of professional entrepreneurship, which is something that you have nurtured here at Kotak Mahindra Bank. Take me through what it takes to be able to operate with the founder's mindset, have that ownership mentality, and yet be able to professionalize the institution.
I think entrepreneurship is a very important quality, but as you grow creatively, the need to put process and professionalism is key. Therefore, many entrepreneurs don't really make it because they find it difficult to move to professionalism. Many professionals are outstanding professionals, but at times do not have an entrepreneurial mindset. Therefore, the concept of a professional entrepreneur has been deeply embedded at Kotak right from the beginning. As soon as we started the company, we kept on getting high-quality professionals. And there's one thing I tried to inculcate in them is a spirit of entrepreneurship. And for me, it was a learning I was also qualified as an MBA to really ensure that entrepreneurship and professionalism blend. And there are many instances about how we made it quite a journey. So in 1989, not many people remember, India used to sell more than 75 or 80% Maruti cars by then.
Yes.
And there was a 6-month waiting period. So if you wanted a car, it took 6 months. And for the first time in India, Citibank started a car financing scheme, which was a 13% higher purchase rate, which if you converted to IRR, was 39% per annum. But Citi had the financing scheme, but there were no cars. So I recollect, we saw this opportunity where the bank cost of funds was 16% or around, and IRR was phenomenal. So I remember making a trip along with a colleague of mine, Jairam, and we went and met, then I think Mr. Bhargav was there in his early days.
And he's still there.
Yeah, 1991, I think, around that time.
Yeah.
And telling him that, Mr. Bhargav, what if we gave you interest-free money for 6 months? Will you allow us to book 5,000 and 10,000 cars with your dealers? He says, wow, I'm going to get free cash flow. And in the days of 16 to 17%, 6-month interest-free. So we started booking cars, and therefore we had cars available for our customers whenever they wanted delivery. Our competitor, Citibank, could not do it because New York believed that is, they are not in the business of inventory. They're in the business of financing. Therefore, we were the only game in town. We could offer our customers immediate cars. And being very reasonable financiers, we said our financial terms will be the same as Citibank. So we were the car finance business built. Post that, of course, our partnership with Goldman Sachs in the 90s, which was a great learning for us because Indian capital markets were a little bit like a small well. That gives us ability to see how the global capital markets worked. We partnered with Ford Credit in the car finance business. We started thereafter from the NBFC. We started an asset management business in 1998, a life insurance business in 2000, 2001, and then banking opened up. And I remember talking to some of my friends at Goldman Sachs, and they said, Uday, why do you want to get into low ROE banking business? And my answer was, we want to be close to our customer, and customer centricity happens if you have a bank account of the customer. And that's why we want to get into it. So we got into banking in 2003. Global financial crisis hit in 2008. We sustained it. We realized we needed to grow. We acquired ING Vaishya Bank and merged it into Kotak in 2015. Post demonetization, we saw the digital wave coming. So we are very, very bullish about the future of digital. Therefore, we started 8/11, which is really 8th November, which is the date on which we thought about this idea. And I am a great believer that India is on the cusp of major ability to have a say in the global finance situation.
You know, I want to go back to some of the lessons that you've learned along the way. And I want to come back to the comment that you made that there are professionals who sometimes are not entrepreneurial enough, and there are entrepreneurs who are not as professional as they ought to be. And we've seen that play itself out specifically in the banking sector. What have been some of the non-negotiables for you as a professional entrepreneur as you grew the bank? I'm sure that there have been dilemmas on how fast you should grow, the choices that you were forced to make or perhaps not make in order to ensure that in the long term you could sort of stand tall. Take me through some of those dilemmas that you've had to face and the choices that you then made.
I do believe the banker of today and the future, as in the past, needs 3 human qualities. First is prudence, which is ensuring that you are stable and sustainable over long periods of time. 2, simplicity. Do simple products. Do not do things which are so complex that neither the customer nor the banker himself fully understands. And third, at times bankers begin to believe that they are the masters of the universe. And the most important quality for a financial sector professional and a banker is humility. Therefore, the key to building long-term financial institution is prudence, simplicity, and humility.
And how have you worked on each of those and developed a culture of humility, simplicity, as well as prudence within the organization? And has there ever been temptation to sort of try and move faster, try and grow the bank faster, which could have perhaps made you take choices that you were not ready to take at that point in time?
No, I do believe in the concept of risk-adjusted returns. Therefore, we have to take the risk, but we need to ensure that the returns are commensurate with the risks. And that balance is one of the most important aspects of banking and finance. The ability to get that mix between risk and returns is critical. It's not about conservatism, it is not about aggression. If you are aggressive, are you pricing in the aggression in the what if? And at times, because bankers sit on large pools of money, they forget this first principle. It is not their money. It is other people's money. It's depositors' money. You just have the right to put it properly and ensure that money comes back. Because what people forget is the banks are perceived to be the safest institutions where people park their surpluses. But the structure of banking is much more leverage than any corporate business. Therefore, a highly risky business has been packaged as the safe place for people to park their money. And this dichotomy is the core to good banking.
take me through some of perhaps the riskiest bets that you made that have turned out to be beneficial to the bank. I remember at the time that ING was going through 2015, so almost 10 years on, it was like, is it too big for Kotak to be able to digest? And those were the questions being asked at that point. Take me through some of the risky bets that have paid off for the bank.
I think there are quite a few. First is venturing into an area as soon as it opened up. So think about each of the businesses we got in. Take life insurance. We did not know much about life insurance, but it was a very simple principle that if a new avenue in financial intermediation opens up, Kotak will get into it and acquire the knowledge and expertise as it moves on, and if required in the short run, get a partner. Therefore, getting a partner in life insurance in the early stages, which was Old Mutual, was a part of learning for us to be able to acquire expertise in the life insurance business. In the capital markets business, in the 90s, the concept of international financing did not exist. So we went out and sought a partnership with Goldman Sachs. And the purpose was clear. We need to learn, acquire expertise through the joint venture, and ultimately do what's right for our stakeholders. Therefore, the risks we took were in many ways well calculated with the objective of learning. And that is the key to be able to do what I said, risk-adjusted returns. The partnerships and joint ventures were ways to learn about the business. Of course, we took some very interesting bets, like our distress asset business, which we started in the early 2000s, and which has given phenomenal IRRs. We started a tractor financing business in 2005 from scratch. Today, we are amongst the largest or the second largest lenders of tractors in India. And we have a market share of over 12% of all tractors produced in the country. That's how we finance. It was a business which didn't exist. And it was not a business where we were naturally comfortable historically, which is down to the farmer. But we built it from scratch and have made it into a significant business. Therefore, there are many, many areas where we have ventured at early stages, not fully sure about knowing this business. And we took bets on our people. People, we threw them into the deep end and said, this is a new business we want to do. None of us have learned it. Go ahead and do it, explore, make your mistakes, but get going. And I think the entrepreneurship culture in our professional teams was one of our successes. And that is important because one of the risks is as institutions grow, the entrepreneurship angle in the professional at times tends to become more bureaucratic. And in a very tight regulatory framework, you then have a very easy way where professionals start moving away from entrepreneurship to say, this is how it is. And we have to do it right from a compliance point of view, but we need to test the rubber band before we say it cannot be done.
But, that's interesting. And I'm glad that you brought up the rubber band analogy, because how do you test just the right amount before you actually snap? And I'm sure that there have been many instances where you've had to face that. And this is, of course, a highly regulated business. So how do you test just enough, so that you don't actually end up snapping the rubber band?
Of course. I think the issue there is India is an evolving financial market, or has been an evolving financial sector market. And we have to ensure that as weather changes, we are able to change ourselves with the changing weather, but being ready to ask the questions about what is right in substance versus form. And that's what takes me to the fact that I am a great believer in this 4-quadrant theory, which is the 4 quadrants are Ram quadrant, Krishna quadrant, Duryodhan quadrant, and Ravan quadrant.
Okay.
The Ram is the one who does everything right in letter and spirit. Krishna is who does it right in spirit, but is a little more pragmatic on the letter. Duryodhan never gets it right in spirit. And Ravana was perceived to be not right in letter and spirit. We must operate in the Ram quadrant, but if at all we need to move, Krishna is fine.
You know, so talking about the Krishna quadrant, and then again, it's a beautiful analogy that you brought in, because of course, while you stay focused, you also have to have the ability and the muscle to be able to respond to things tactically and perhaps even opportunistically. Take me through some of those tactical, opportunistic moves that you made that really changed the trajectory as far as the bank is concerned.
I think the most important tactical moves we made was getting into businesses which were new to us, which is what I said, and saying, let's go for it, okay? The chances of success we don't know, but we'll make it happen. The other one is we were never scared about being a small player in a large market. We were ready to take on the big guys, even when we were small. And we had a certain level of adventure. I still remember in 1993, for the first time, I remember going to Godrej Soaps and Adi Godrej and telling him, Adi, you must take your group public. It was a closely held group, and we convinced him to take Godrej Soaps, which is now Godrej Consumer, into the public markets. The markets were rocky, and we started with the concept of safety net for investors who bought into the issue. The bet hit us financially, but we established a very strong relationship with the Godrej Group, and it has continued ever since. So we are ready to stretch ourselves, take those calls, and be by our customer, even in areas which we were not traditionally comfortable. Give you the example, another example. You aware of Good Night?
Yes.
So Good Night is a story. In 1990, I think it was 1995 or something, Good Night used to be owned by a company called Good Night Mohan. And he came to us, and he came to me and said, Uday, I want to take my company public. So we filed a prospectus. SEBI was in the early days, and we filed a prospectus valuing the company at 80 crores. Few weeks after we filed, I got a call from Mr. Keki Dadi Seth, the then chairman of Hindustan Lever. Hey, Uday, you're taking this company public. I want to buy it. I spoke to Mohan, and he said, okay, I'm ready to sell at 100 crores. Keki said, no, not 100, 95 I will buy. And I just need to go to my headquarters in London and get approval, because this is a different category. He went to London, and London said, no, we can't get into this category. Here was Mohan. He was wanting to sell the business. The buyer who wanted to buy it is gone. I went to Adi Godrej and said, Adi, this is the terms on which we were going to do a deal with Levers. That deal is not happening. On the same terms, you can buy it. Godrej bought it. And Godrej said that I have only one due diligence requirement. Uday, at the same price as I'm buying, you will buy 10% of the company, which we did. Next year, Adi came back to me and said, Adi, Uday, I'm going to sell this company with a partner, a foreign partner. But before that, I want to buy you out. And I'll give you double the money. I said, Adi, this relationship matters. I will not argue with you. I will sell you the stake since you want it back. And we sold it in a year. So these kind of things really endeared us to many of our customers. And we were always ready to do more for the customers and do a breakthrough and go out of the box. For example, in our mutual fund, we started the mutual fund with the first gilt fund, G-I-L-T, in India.
I'm glad you spelled it out.
And nobody had done that then in the debt side. So we started again with a differentiator, and then of course we went into a whole host of funds. Therefore, always ready to do and test the limits of what Indian markets can take, but keeping in mind the needs of customers.
You know, not many people actually recognize the fact that you're perhaps one of the most astute deal makers that we've had over the last 40 years as well. You've been involved with many deals, and you gave us an example of some of them. Which has been the most memorable deal that you've been part of, Mr. Kotak?
I think there have been many. I think it's unfair to choose the...
Okay, take your top three pick.
I would say the first, of course, is the many deals we've done for ourselves. For our joint venture with Goldman, joint venture with Ford, buying out Goldman, buying out Ford, doing the acquisition of ING Vaishya, getting into, recently, as you know, we gave up 70% of our business in the non-life to Zurich. So those actually have been quite exhilarating. Our deep relationships with some of the global institutions who we sort of build deep connect, which is CPPIB, GIC, and many others. Therefore, there is a long, long history of deep relationships. And in deal making, it's not just about doing a deal, it's about making sure that it creates value for both. And that's something which, and you are aware of the history that in the 90s, I was one of the 3 junior Ks. The 2 senior Ks were Kothari and Kampani. And I was this little two-wheeler trying to make his presence in the giant truck market.
How hard was it then? And what does the story look like today when you talk to foreign investors? And, you know, at least as far as the banking sector is concerned, banking clearly seems to be the flavor of the season as far as FDI is concerned.
So, first of all, I've lived through the 90s when India was not on the radar of the global investors. And I remember a statement I made that India is finding it very difficult to build domestic savings into equities, and global investors are still biting India very carefully. From there to a point of time when Indian markets became completely dependent on FPIs, then known as FIIs, and domestic savings were not going into equities. And I credit successive governments, and in particular, the government for the last 10 years, for really nurturing the Indian saver becoming the investor. One of the biggest transformations I've seen in the last 35 years of my journey is a nation of savers has become a nation of investors.
Speaking of this transformation, what kind of opportunities do you believe that this opens up for the sector? And I would imagine that that's what the foreign investors are buying into as well. This transformation from a nation of savers into a nation of investors, what does it now mean for the landscape?
Let me just, again, in that context, first zero down on the financial sector. It is transformative. One, the intermediation process in the financial sector has completely changed. And the dominance of banks as standalone largest intermediaries is changing. You're seeing the intermediation process create many, many new winners. The mutual fund industry, the securities industry, the investment banking industry are the clear winners of this transformation of saver to investor. If at all, the banking industry is going to find the nature of the water in its well not growing fast enough. And even the color of the water is changing from stable, long-term savings into money in motion, which is more volatile. And the banking industry needs to be ready for this change. And this transformation of lazy money remaining with banks is going to get tougher and tougher and tougher. And it is reflecting in the growth of deposits versus the growth of mutual fund AUMs. If you look at 2020, that is just before COVID, the mutual funds were about 15% of bank deposits. If bank deposits were 100, mutual funds were 15. Today, mutual funds are 35% of bank deposits. And I'm ready to say in the next 5 years, mutual funds will double as a percentage of bank deposits.
with the perspective that you have, sitting outside, so to speak, and not necessarily as an insider, what's the perspective that you have on where banks should start to disrupt themselves? How and what should they prioritize?
First, I think banks should not think about themselves as banks. They should think about themselves to be in the business of serving customers at the lowest possible intermediation cost for the risks they take. The mindset is, oh, we are a bank, and therefore we have the right to be lazy. We have a right to have the moat. I think that is the most dangerous thing, because the pool of savings in banking is under threat.
So, Mr. Kotak, in this landscape where you're up against other banks, you're up against fintechs, you're up against NBFCs, and now you're also up against technology companies who are trying to get into the same space, the landscape has changed completely. If you were to start up again today, would you do it?
I would be a digital evangelist with having a strong technology foundation and specializing in the domain of finance with deep understanding of risk. What is the challenge today is the digital evangelists of today are not as familiar with the risk management side. You really need to be at the cutting edge of digital with a strong, resilient foundation. Combine this with the unique risk management ability which finance provides. If you can combine this today as a startup, it is a winning combination.
You know, speaking of digital evangelism, is this perhaps a disappointment? Regret is too strong a word. Is this perhaps an area of disappointment that you believe that you ought to have moved faster on and accelerated the pace of change, pre-demonetization? Demonetization, of course, forced the entire ecosystem to react. But is this something that you believe you could have done better on?
Without a doubt. What happened was in 2015-16, we acquired ING Vysya Bank, which we were still in the much more physical world. And it took us a few years to really integrate it. Then you saw demonetization happen. So it all got delayed to 2018-19, and then COVID hit. COVID basically front-loaded the need for digital and technology platforms much faster by about 3 to 5 years. And that was a time when we got into the time crunch. And having said that, I'm a believer that Kotak must embrace digital and in a manner with a sense of evangelism, that this is the future. I'm not saying physical goes away overnight. And there are three important parts of the journey before you come to the fourth. First, we have seen a world which was only physical, which then has transformed to phygital, which is physical and digital. We are now in the world of what I call as digital first with physical. And the fourth stage is only digital. So currently, I believe we are in stage 3 of the evolution.
But do you believe that we will move to stage 4, that we'll only be digital, we won't have bank branches? Do you foresee that future?
Shireen, let me give you the example of the largest market cap company in Brazil, of all of Brazil, not the banking sector. It is a digital-only bank called Nubank, valued at $80 billion. A Revolut today is valued more than Barclays. Therefore, this is a journey. You have to leverage the physical presence for trust and confidence. Therefore, I don't think we need to go away from what physical we have. Therefore, we should continue with that.
But not build on it.
But you have to be careful. You have to build on the digital at a much faster pace.
What have been some of the big lessons from the IL&FS debacle and what it could have done to the Indian financial sector and what you helped avert? What are the big takeaways from that for you?
IL&FS was not an event of 2018. It was building up over the last 25 to 30 years of its history. The company started in the 90s and it eventually blew up in 2018. It had 347 companies. It was a pyramid. And at some level, it was quite amazing how the system allowed this kind of an animal to proliferate. And this is the challenge of conglomerates as well. The risks are sitting in very different parts of the group. And the regulatory system was looking at some parts of it. And IL&FS is a failure on 6 counts of the checks and balances in the system. 1, management. 2nd is board. 3rd is institutional shareholders. 4th is auditors. 5th is rating agencies. And 6th is regulators. So it is quite amazing how all the 6 layers of checks and balances in the system failed at the same time. In many ways, we saw an extreme tightening of regulation coming out of that. Therefore, it inevitably happens. That's why I said the regulatory system is also evolving. We were at one end of the curve. We probably went to the other end. And maybe we are now moving towards equilibrium.
You talked about your own journey as a startup. Let's talk about what's happening in the startup ecosystem today. I don't think that we would have imagined, maybe even a few years on, that we would be sitting here today with a listing after a listing from the startup ecosystem. What do you make of that story?
I think it's a great progress India has made, and I would only venture to say that let startups have a mindset of frugality. Too much money can spoil you too early. Therefore, that's the only sort of message I would give to startup entrepreneurs. Just because you get it money easy, value it, because there comes a time where you need to start showing at least green shoots in a reasonable period of time. I know you need to invest now. You don't need to be focused on short-term P&L. There are 2 areas where I would strongly urge Indian entrepreneurs to think about a little deeper. 1, India is now the 4th largest economy in the world. I would love to see more global Indian consumer brands. When I think about it and scratch my head, I can't think about probably any seriously.
Why do you think that's the case? I mean, we've seen what China's been able to do. Why do you think India hasn't?
I think India is a very protected domestic economy. We have such a large domestic economy. We are not threatened. We have not been threatened for businesses and entrepreneurs to innovate for the world. We have innovated for India. I mean, if you look at Zomato and Swiggy and Zepto, 10-minute delivery is an innovation across the planet Earth, but in India. I think it's the nature of our marketplace, large domestic population, and relatively protected, which has made it easy for Indian entrepreneurs to make it big in India. But at global scale, both on the consumer side and absolute global scale on creativity, India lags. What does it take for India to have, or Indian business, to move away from quarter se quarter tak to significant investment in research and innovation, which will pay over 3, 5, 7 years? I don't think we are doing enough of that. Even the large businesses, the spend on research and innovation is a fraction of what global companies are doing. And that is bringing us to the stark reality that 70% of global market cap is in the United States. And the top 10 companies there are 40% of that market cap. It's hugely concentrated. But when the US companies talk, the top 7 or 10, they talk about $400 billion of investment in a year. And India's large companies talk about $10 billion and think it is big.
You know, as you look at what you've been able to achieve, and I ask you this in the context of how you define success today versus what you thought of success, maybe 10, 15 years on, how do you look at success and winning today? What is more important to you?
I think we have to look at life as a journey, not a destination. And I'm very passionate about India. And if you ask me, India has made progress, but we have a long way to go.
Do you think that we're moving fast enough?
We need to move much faster, because I also am concerned about a world where the rule of 2 is coming in most businesses and most countries. And if that rule of 2 gets stronger on a country basis, India has a tough task ahead, considering where United States and China are. So for India has to be that hungry entrepreneurial country that we have to really think differently, because top 2 slots look like they're taken for a long time.
I want to use a cricketing analogy because that is actually what you was your first love and which is what you wanted to do, but you had to give up because of an injury. How would you map out, in cricket parlance, your innings so far, and what you believe, who or which captain's innings do you believe that your journey is most closely reflected by?
I think that's a very tough one. I can talk about my coach, and I always savor it because my cricket coach was a gentleman called Ramakant Achrekar, who many years later coached Sachin Tendulkar.
Yes.
And he was always of the view that be relentlessly focused on what you're doing at the moment. Handle each ball on its merits, not who is bowling the ball. And that is the core to building a cricketing innings, a cricketing team that merits over everything else. And a team spirit, which is extremely powerful. And India has had many captains, but if you look at it, many people have been much more successful as batsmen, but not captain. So there are cases of both. Therefore, when you're looking at cricketing analogy, for certain situations you need the best batsmen, for certain situations you need the best bowlers, and captains have to be able to build the team culture. But no captain can survive if he himself is not performing. Therefore, you need a performing captain, but you also need outstanding team players who you can nurture and grow and give space.
Mr. Kotak, talking about collaboration, talking about partnership, and that has been integral to the Kotak story, as you explained to us through many of your businesses. What has been the key ingredient of successful partnerships, of successful teamwork as well?
Learnings of a joint family.
You grew up with what, 63 people, I believe?
63 people, one home, uncles, cousins, and you had to learn to build together and live together. Therefore, an Indian family culture is a very powerful tool for building an institution. And think about it like a family, but based on merit and professionalism. In pure families at times, the family emotion gets ahead of professionalism. Therefore, that is the small difference you need to make to the family culture model. And I think that's a winning combination for building institutions over generation.
What is Uday Kotak passionate about outside of work, outside of building this institution? What's keeping you ticking at this point? And we were talking about how 40 is the new 20 and 60 is the new 40. What's keeping you going today?
No, I'm enjoying a sense of space. I'm spending a little more time for my younger son Dhaval as well. We are seriously evaluating buying medium-sized businesses outside India through the overseas direct investment route, and building operating businesses for him as well. And at a certain level, I am a great believer that the best way of looking at the future is never have FOMO.
So no FOMO about anything.
FOMO.
No FOMO about anything. Uday Kotak, always a pleasure. Thank you so much for joining us here on The Leadership Language. It's been an absolute pleasure. We look forward to more conversations with you, but thank you very much for your time today.
Thank you.
With that, it is time for us to wrap up this edition of The Leadership Language. If you enjoyed watching that conversation, do send us your feedback. We'll be back again with more. Till then, from all of us here on the team, goodbye and many thanks for watching.
Hello and welcome to India Business Hour. I'm Arundhati Ramanan and here are the headlines that we're tracking for you this evening. Sensex and Nifty hit a record high after 14 months, but markets give up most of the gains to end barely in the green. Bank stocks lead the rally. Government is all set to fast-track the incentive scheme to bolster rare earth manufacturing. Sources say notification is likely in 15 days and bids will be invited over the next 2 months. That's an exclusive. A Niti Aayog panel proposes scrapping licenses, permits and no objection certificates in a regulatory overhaul. Sources say a high-level committee is proposing prior approvals only for high-risk cases involving national security, public safety and environmental harm. That's another exclusive. Tech giant Apple takes India's competition regulator to court, challenges the law allowing penalties to up to 10% of global turnover for market dominance. The law exposes the company to a potential penalty of $38 billion. Apple's global smartphone shipments could outpace Samsung for the first time in 14 years. Counterpoint Research says the positive response to the iPhone 17 series is a major catalyst. Tata Power likely to resume production at its Mundra plant 6 months after suspending operations due to poor demand. The Gujarat government reaches an in-principle understanding on a supplementary power purchase agreement. Sources say Tata Power could use this as a precedent for pacts with other states. Ahmedabad gets ready for a massive infrastructure makeover ahead of the 2030 Commonwealth Games. Big opportunity for developers with land near Games venues, athlete village and key transport corridors. Airport link development could boost inbound travel and demand for hotels as well. At least 65 people are dead and hundreds missing after an apartment complex in Hong Kong goes up in flames. The blaze tears through 7 of the 8 tower blocks. 3 construction company executives arrested so far. 2 U.S. soldiers shot and critically wounded near the White House after an attack by a lone gunman rattles Washington. Officials identify the suspect as an Afghan national who is currently in custody. U.S. stops processing immigration requests from Afghanistan after the attack. Those were the headlines that we're tracking for you this evening, but let's start with the day's market action. Sensex and Nifty hit record highs, but largely ended flat. Sensex crossed the 86,000 mark and Nifty surpassed the 26,300 mark for the first time ever. Bank stocks led the rally. Hormaz Fatakia tracks the Nifty's 14-month journey to these record highs.
It finally happened, didn't it? And 14 months is what it took. 27th of September of 24 was last time when the Nifty was at these levels, and we finally managed to cross that. But the bigger talking point is that from the lows that we made in 2025, which was in April this year, the index is up 19%, yet we remain underperformers compared to the rest of the globe. You talk about contributors, the usual suspects of Bharat Electronics, Bajaj Finance, SBI, but Eicher Motors is the top gainer here, gains of anywhere between 25 to 45%. But the losers are the bigger here. Trent, Street Darling at one point of time has almost halved. Bajaj Auto, Coal India, TCS, NTPC, all of them down anywhere between 25 to 30% in the last 14 months. But if you take a look at the gainers from the April lows, you see BEL is up almost 50%, but the post-GST rally seen in M&M is the talking point here. Eternal has done well, as has Jio Financial Services. But if the Nifty made record highs, the broader markets is where the pain lies. The mid-cap index has done precious little over the last 14 months. The small-cap index is down 7%. And more than the gainers, you look at the losers here. You look at the mid-cap losers, Colgate is down 42%, as is IndusInd Bank, no longer a part of the Nifty. Tata Tech, another hyped IPO, down 40%. RVLN and Ireda, the high-flying PSU stocks of 2023 and a better part of 24 as well, down 40% each. The picture in the small-cap space is even more grim. Ola Electric is down 60%, as is Tejas Networks. You look at Jindal Saw, add another 11% to Whirlpool's 46% drop. So overall, the Nifty may have made a record high, but it is the broader markets where the actual underperformance and the actual pain lies.
So the broad market underperforming. Many thanks for those details, Hormaz. The Indian rupee was largely steady against the dollar in trade today. The currency remains closer to record low and above the 89 mark against the greenback. Last night, the International Monetary Fund reclassified the rupee to what it calls a crawl-like arrangement after the currency moved more freely. Sources in the money market say a crawling peg is closer to a market-determined rate. The fund went on to say India is well positioned to allow greater flexibility in its currency, which would help absorb external shocks.
The Finance Ministry has said that India's economy is on a stable footing on the back of encouraging inflation expectations, sustained public capex and strong rural and urban demand. The ministry's monthly economic report highlighted that the economy is positioned to navigate emerging risks and preserve its growth momentum through the remaining months of this fiscal year. The report further highlighted that global uncertainties, including shifting trade policies, geopolitical frictions and financial market volatility, are potential headwinds. The government will notify the 7,300 crore rupee rare earth permanent magnet manufacturing scheme in 15 days. Sources tell CNBC-TV18 that the government could invite bids for the scheme by the 31st of January. Parikshit Luthra joins us now with all of those details. Parikshit, tell us more about the contours of this scheme.
Well, the government is likely to notify the scheme for manufacturing rare earth magnets in 15 days. Thereafter, the government could invite bids for the scheme by 31st of January next year. Interested bidders will have to submit a detailed project report to show that they are technically capable, they have either indigenous expertise or they have global technology tie-ups to deliver on the promises they are making. An interministerial group supported by India Rare Earth Limited, Baba Atomic Research Centre and CSIR will soon be set up to frame the bid criteria, and this interministerial group will choose and select the applications also. Startups, established companies, first-time players are all likely to be invited to bid for the scheme. All applicants would be free to have global tie-ups for technology but must manufacture in India. The government may consider companies who can invest rupees 1,500 crores in setting up a plant for 12,000 ton of rare earth permanent magnets. Smaller players who can set up capacity for 600 tons of permanent magnets may also be considered. During the consultation phase, 25 companies, including magnet makers, automotive component manufacturers, participated in the meetings. As of now, companies like Entellus, Ashwini Magnets and Midwest make rare earth materials in India, but no one does it at the scale that is really needed or where you can say there is import substitution. The government seeks to establish rare earth permanent magnet manufacturing facilities in India and build a domestic supply chain to reduce reliance on Chinese imports. In order to strengthen domestic supply chains, Department of Atomic Energy has also asked state-owned India Rare Earth Limited to expand capacity for manufacturing NdPr oxide, which is a crucial raw material for manufacturing rare earth magnets.
So this is a great policy. As you know, we are India's largest rare earth magnet consumer, importer. For us, secure supply chain is very important as we make more and more traction motors for the future as India electrifies. We will play a part in this policy in some form or the other, as a primary applicant or a secondary applicant jointly with somebody. But we are very interested, and I genuinely think this is one of the best policies to have come out.
Shares of Whirlpool of India declined after 11.8% equity changed hands via block deal. Sources tell CNBC-TV18 that the company's promoter, Whirlpool Mauritius, is likely to have sold 7.5% equity worth around 980 crore rupees. The floor price of the deal was set at about 1,000 rupees per share. Tata Power is likely to resume production at its Mundra plant 6 months after suspending operations due to poor demand. Sources tell CNBC-TV18 that the Gujarat government has reached an in-principle understanding with the company on a supplementary power purchase agreement. Vivek Iyer has more.
Well, that's right. So, one of the most important plants, in fact, one of the largest plants in India, and especially for Tata Power, the Mundra UMPP, which is the ultra mega power plant, which is 800 into 5 megawatts, which is close to 4,000 megawatt, and this particular plant has actually been in operational since July 2025 when Section 11 was not extended. So now, it's been inactive since July, and not only that, there was absolutely no visibility as far as long-term PPA is concerned. But now what we are understanding from our sources is that the company as well as the Gujarat state government have reached an in-principle understanding to go ahead and sign a supplementary PPA to resume operations and to start procuring power from the Mundra facility. Not only that, remember the original PPA was signed with 5 states, and we understand that once the Gujarat supplementary PPA is signed, of all of the 4 other states will use that as a precedent and go ahead and start procuring power from Tata Power at what will essentially be very similar terms and conditions. Now, we reached out to the management of Tata Power. So far, they have not yet responded to our queries. But just to give a sense of how important this particular development is for Tata Power, in FY25, the company reports a cluster, Mundra Coal and Shipping, and this particular cluster reported a PAT of 1,078 crore. It's reasonable to assume that majority of the contribution would have come in from Mundra itself, and it was just operating under Section 11, not a supplementary PPA. In Q2, on back of the fact that Mundra was inoperational, that particular cluster actually reported a loss of close to 362 crore. So, the importance of Mundra cannot be underestimated. It's an important development, and we will keep updating our viewers on the same.
Right, Vivek. Many thanks for those details. The Reserve Bank has granted a certification of authorization to Paytm Payment Services. The entity owned by Paytm's parent 197 Communications can now operate as a payment aggregator. The company had applied for the permit in March 2020. However, the approval was stuck due to certain compliance issues related to foreign investments in the company. The Enforcement Directorate has arrested online money gaming platform Winzo founders on money laundering charges. Soumya Singh Rathore and Pavan Nanda were arrested after being questioned at the zonal office of the Federal Probe Agency. They were initially sent to one-day custody after being produced before a local court. The arrest comes after the ED's recent searches at Winzo's premises. A panel constituted by Niti Aayog has proposed scrapping licenses, permits and no objection certificates. Sources have said that the panel has recommended third-party and risk-based inspections. Shivani Bazaz filed this report.
Well, yes, sources have told CNBC-TV18 that a high-level Niti Aayog panel led by former Cabinet Secretary Rajiv Gauba has called for a complete end to what is described in the country as the inspection raj. The committee has recommended scrapping most licenses, permits and NOCs except in high-risk areas like national security, public safety, health and the environment as well. Under the proposed framework, routine inspections will now move to accredited third parties selected through risk-based computer-generated systems. That's what sources are telling us. Now, the panel is also pushing a new trust-based approach, the Jan Vishwas Siddhant, where any activity not explicitly prohibited by law will not need prior approval. It has also called for stable policies and tax regimes and for every regulation to clearly state the compliance cost for businesses and enforcement burden on the government. And in a major shift, the committee also has proposed that criminal penalties reserved only for serious offences, including threats to national security, fraud or major environmental harm, with a full review of all such provisions across laws. If these proposals are accepted, of course, these are right now just on the proposal stage, they could mark a significant reset in how businesses operate in India and how India regulates its businesses. Back to you.
There are companies which are just wanting to shift operations from one country to the other. What does this mean from us? They're interested in India for 2 reasons. Domestic market, and we are one of the best low-cost destinations for manufacture. Having said that, we need to cut our paperwork. We need to cut our bureaucracy. The Prime Minister keeps talking about, minimum government, maximum governance, ease of doing business. Get out of the way of business. Make life easy. We don't want people to fly in with interest and fly back disappointed.
The Income Tax Department launches a new initiative asking taxpayers to disclose foreign assets acquired in FY25 by the end of December. Tax Department identifies high-risk cases where foreign assets appear to exist but have not been reported so far. Apple has moved the Delhi High Court challenging India's amended antitrust penalty regime. The iPhone maker told the court that the law may subject it to as much as $38 billion in fines. This as the new regime allows the Competition Commission of India to impose penalties of up to 10% based on a company's global turnover rather than its revenue from India. Tech giant Apple is set to ship more iPhones this year, more than its rival Samsung, for the first time in 14 years. Counterpoint Research tells CNBC that the iPhone maker will ship around 243 million units this year. In comparison, Samsung's estimate of 235 million units. Apple is also likely to end up with a 19.4% share of the global smartphone market, while Samsung's share will be 18.7%.
CarTrade has announced that its proposed deal to acquire CarDeco will be not moving forward. In a statement, the company said that two companies had mutually decided not to proceed with the proposed transaction at this stage. The transaction was estimated at over $1.2 billion. Remember, CNBC-TV18 had confirmed that CarTrade was in talks to acquire CarDeco and BikeDeco. A joint venture between Reliance Industries, Brookfield and Digital Realty will invest $11 billion to build a 1 gigawatt AI data center in Andhra Pradesh by 2030. This move has come a month after Google inked a deal with the state government to build an AI data center with an investment of $15 billion. Telecom giants have expressed concerns about the recently notified data protection rules. The companies have asked for clarity on security compliance, consent of minors, and audit obligations. Telcos have asked for an exemption for 16 to 18-year-olds looking to buy a SIM. They also said that alignment with sectoral laws remain unaddressed. Commonwealth Games is returning to India after 2 decades. Ahmedabad will host the 24th edition of the Games in 2030. The formal announcement was made at an event in Scotland's Glasgow. A delegation from India, including Indian Olympic Association President P.T. Usha and Gujarat Deputy CM Harshangvi were present. Moments after the announcement, Garba dancers and drummers entered the hall and surprised delegates with a cultural performance. Meanwhile, Ahmedabad is gearing up for a massive infrastructure makeover. There's big opportunity for developers with land near Games venues, athlete village and key transport corridors. Airport-linked development could boost inbound travel and demand for hotels as well. Sonal Bhutra gives us a lowdown on what we can expect.
Well, yes, the announcement that Ahmedabad will host the 2030 Commonwealth Games could open up one of the biggest real estate and infrastructure opportunity cycles the city has ever seen. Large sporting events don't just bring athletes and spectators, right? They trigger a wave of construction, urban development, hotel expansion, and long-term demand for residential, retail, and commercial real estate as well. So let's break down where the biggest opportunities lie and which kinds of companies stand to benefit the most. But first up, let's just look at the costs that have been incurred in previous Commonwealth Games. The numbers are for you on the screen. Manchester, Melbourne, Glasgow, Gold Coast, Birmingham, somewhere between 10,000 to 15,000 crore rupees is the opportunity which is available. Now, sectoral impact. First, real estate developers. The biggest near-term opportunity sits with developers holding land around key games avenues, the athlete village and transport corridors connecting them to the airport and the city centre. Hosting the games means new world-class sports facilities, upgraded highways, metro links and also an expanded airport. All of this sharply improves connectivity and land value and adjoining micro-markets. Developers with large integrated townships, mixed-use developments or upcoming residential projects in and around Ahmedabad and Gandhinagar could see accelerated demand as investors and home buyers, they look to participate in the growth story. Some of the big real estate players in Ahmedabad include Adani Realty, Arvind Smart Spaces, Godrej Properties, to name a few. There could be some opportunity in the airport link development as well because of improved international connectivity, plus terminal expansions increase inbound travel, hotel demand, premium office or retail near airport as well. Of course, Adani airports will be in focus because of that. Construction and engineering contractors, they'll also be in focus due to venue construction, road, metro, airport works and hospitality projects. So the likes of L&T, HCC, GMR and any other regional large contractors and players will be in focus. These firms historically won major game contracts in Delhi and elsewhere as well. Hospitality industry, of course, will be in focus. There'll be surge in visitor nights for the games and longer-term business travel. It will lift revenue per room for these companies, per available room, that is. There is a new ITC hotel there as well. So stocks like ITC hotels, Indian hotels, etc. will be in focus on the back of this. But of course, the key to track now will be formal project announcements and tender awards from Gujarat or state government and the organizing committee as well. But this definitely could be a big boost to a lot of industries.
Right, Sonal, many thanks for those details. On that note, it is time for us to head into a short break. But coming up on India Business Hour, at least 65 people are dead and hundreds missing after an apartment complex in Hong Kong goes up in flames. More details in just a bit. And you can also catch all CNBC TV18's news and updates on YouTube, Facebook, Instagram, X and Geo Hotstar. Do subscribe to CNBC TV18 Access for exclusive stories.
Welcome back. You're watching India Business Hour. Ukraine claims Russia has carried out 41 airstrikes, dropping more than 100 guided bombs across the country. Kiev also said it hit a Russian plant involved in missile and drone production, along with several other military positions. Russia's President Vladimir Putin says he is ready for a serious discussion on the peace plan brokered by the US President Trump's special advisor, Steve Witkoff, who is set to travel to Moscow to hold talks next week. 2 U.S. soldiers were shot and critically wounded near the White House after an attack by a lone gunman rattled Washington. Officials have identified the suspect as an Afghan national who is currently in custody. The Trump administration has stopped processing immigration requests from Afghanistan after this attack. U.S. President Donald Trump has asked Japanese Prime Minister Sanae Takaichi to dial down her stance on Taiwan. As per reports, both the leaders spoke over a phone call where Trump told the Japanese leader to not escalate tensions with Beijing. This comes after Prime Minister Takaichi sparked a diplomatic row by suggesting that a Chinese attack on Taiwan threatening Japan could justify a military response. The big international story: at least 65 people have died and hundreds are missing in Hong Kong after an entire apartment complex caught on fire last night. Officials alleged that bamboo scaffolding and foam materials used during maintenance work might have caused the rapid spread of the fire. The fire tore through 7 of 8 tower blocks of the buildings. Firefighters were continuously dousing the fire and attempting to rescue trapped residents inside the burning building. This incident has been touted as the deadliest fire in Hong Kong in decades. Authorities have said that the firefighters managed to put out the fire in 4 buildings and operations were continuing in the remaining 3. A task force has been set up to investigate the cause of the blaze. 3 men from the construction company, including 2 directors and 1 engineering consultant, have been arrested. Here's a report.
Firefighters continued to douse fires that engulfed the Wang Fuk Court apartment complex in Hong Kong on Thursday, over 24 hours since the blaze began. Nearly 300 people are still unaccounted for.
Actually, our major challenge is the temperature is very high in the fire ground, and the inside layout is very complex because the scaffolding is collapsed.
Authorities earlier said that in addition to the buildings being covered with protective mesh sheets and plastic that did not meet fire standards, they discovered in one unaffected building that windows were sealed with foam material installed by a construction company carrying out maintenance work. Eileen Chung is a senior superintendent with the Hong Kong Police.
We do not rule out the possibility that these foam materials contributed to the rapid spread of the fire.
The police have arrested 3 men from the construction firm on suspicion of manslaughter. Meantime, residents of the apartment complex are mourning the loss of their homes.
We bought this apartment more than 20 years ago. All of our belongings were in this apartment. And now that it is all burned like this, what's left? There's nothing left. What are we supposed to do? What we hope most is that the government will help us solve this problem. We don't have any other requests, just a hope that the government can help us resolve it.
Hong Kong is among the most densely populated places in the world, and also among the world's most expensive housing markets. Wang Fuk Court is one of many high-rise housing complexes under the government-subsidized home ownership scheme. It has 2,000 apartments in 8 blocks that are home to more than 4,600 people in a city struggling with a chronic shortage of affordable housing.
The Congress top brass has taken note of the rift between Karnataka Chief Minister Siddaramaiah and his deputy D.K. Shivkumar. Party President Mallikarjun Kharge has said he will convene a meeting with the 2 leaders and others, including Rahul Gandhi. The Congress government had crossed the halfway mark of its 5-year term in the state last week. The development came against the backdrop of an alleged power-sharing agreement between Siddaramaiah and Shivkumar. Earlier today, D.K. Shivkumar put out a cryptic post on X. The post read, "Word power is world power." Former AIA-DMK leader and 9-time MLA Sen Gotian joined actor Vijay's TVK party. This comes a day after he resigned as MLA. He was expelled from the AIA-DMK last month. He has been appointed the chief coordinator of TVK's high-level administrative committee. He is the first well-known leader to join the actor-turned-politician's new political party.
The BJP government in Assam has passed a bill to ban polygamy in the state. The anti-polygamy bill mandates a maximum prison sentence of 10 years, barring some exceptions. People belonging to scheduled tribe category and areas under the 6th schedule have been kept out of the purview of this legislation. During the passage of the bill, Chief Minister Himanta Biswa Sarma claimed the law is not against Islam as it is being perceived by a section of the society. Mahindra has launched the XEV9S, touted to be India's first 7-seater electric SUV at an introductory price of 19.95 lakh rupees. Bookings open on 14 January next year and customer deliveries begin on the 23rd of January. Tuhin Guha from Overdrive gives us a sneak peek.
Now what you see here is the Mahindra XEV9S. It's the 7-seater, 3-row derivative of all the Mahindra EVs that you've seen so far. Now we've been waiting for it for a long time. Let's see what it actually gives you. Now from the front, you notice that it's very familiar. It has that same big, wide LED signature, those big, tall lamps. Now from the side, you'll notice that this is where the most difference is. It's a much more traditional, upright, familiar shape that you see here. Now the wheelbase is again very similar to the other Inglo cars, 2762 mm, but the car itself is now 4.7 meters long, slightly over that, and 1.9 meters wide and just over 1.7 meters tall. So it has that big boxy shape to it. Now a lot of the other features you will know from earlier. For example, it continues with that same 79 kilowatt battery pack, which puts out 285 PS and 380 Newton meters from that single motor at the back. And range is also very good, over 600 kilometers